Right now, you're on one of two paths. Path one is the path of the losing trader. This is where you take trades randomly, hoping that you'll eventually become profitable with enough time. You're trading a strategy that you don't even know works. It's copied from 5 different traders, stitched together from 10 different YouTube videos. And every single week, you keep on learning more concepts, more strategies, but your results don't actually get any better. Now, path number two is the path of the winning trader. This is where execution becomes easy. Not because you have some secret strategy or more discipline, but because you finally started treating trading like a business. You have a clear strategy and edge backed by data. This is where trading becomes boring. You're just doing the same things at the same times every single day, and you're finally getting consistent results. You're passing your first prop firm challenge, getting payouts, scaling and hitting your first 5, 6 figure months. And this isn't because you're doing more, trading more hours, you're actually doing less. You're trading one strategy at one time, taking consistent trades, and so you're finally getting consistent results. And so if you're on path number one right now, this course is going to put you onto path number two. And it will save you years and hundreds of thousands of dollars worth of mistakes. Because this is something I wish I had when I first started trading. But maybe you've identified that you're already on path number two, but odds are you probably realized that you've hit a ceiling that you're not able to break through. And so this course will also help you break through those obstacles. And the thing is, this course is not just theory. This is built from actual execution from my last 7 years of trading. It's based off data collected from thousands of trades, and what I'm about to teach you has allowed me to take home over 7 figures in trading profit last year. And so this course will be covering 5 main sections. The first section is fundamentals. Here we'll be breaking down why 90% of traders fail and how you can avoid that. And we'll also cover exactly how to speed up your learning process to become profitable within months and not years. And then section 2, we'll be covering systems design. This is how we turn trading into an actual business. This is where we build our edge that allows us to have consistent and repeatable profits month after month. And then the third section is technical analysis. This is where I break down the fundamentals of price action, how to read market structure, candle behavior, and also exactly how I trade every single day. And then the fourth section is arguably the most important section, which is risk management. I'll show you the maths behind winning in trading and how to put odds in your favor to profit off long term. This is actually where you make your money in trading, not from your strategy, but from your risk management. And then lastly, for the fifth section, we'll be covering psychology. We'll actually be defining what it means to have good psychology and why 90% of traders actually don't have psychological problems. It's actually something deeper. And we'll also cover how to fix your trading problems without using any discipline or willpower, and instead using something even stronger. And so we're going to be covering a lot of information, but if you don't take action on any of it, nothing is going to change. So get out a pen and paper, get ready to take notes. And with that being said, let's get into it. Okay, so now we're going to cover how to actually become a consistently profitable trader. We're going to break down how to actually learn trading. First off, because most people fail at trading, not because it has anything to do with trading, but because they don't know how to learn. Obviously, if you don't know how to learn, it's impossible to learn how to trade. And this is what you call a meta skill. It's like a skill that underlies a more specific skill. So, the skill of strength, going to the gym, getting strong. Obviously, the stronger you are, that meta skill, the better you're going to be at maybe playing a sport like rugby or some other contact sport like that. And so it's like a force multiplier. The better you are at learning, the better you'll be at trading because you'll be able to learn trading quicker, easier, and faster. So we'll go through how to actually learn trading, and this should explain how I've structured this educational content. How I've broken it down and sequenced the learning steps to make it as easy as possible to get results and actually improve. So trading is like any other skill. It's like learning basketball, golf, poker, probably more specifically like poker. But when we're trying to learn a skill, like complex, like trading is a very complex skill, kind of like golf. There's lots of small little moving parts, like how you hold the golf club, how much force you use, or the hand positioning, and the swing. There's lots of little pieces that we need to collect in order to reach that goal. And so first off, in this system, I didn't come up with the system, it's from Tim Ferriss, but when we're trying to learn a complicated skill, the easiest way to do that is to first break it down into sub-skills. So in trading, we can break trading down into sub-skills. So the most important sub-skills are, we need technical analysis, so having an edge. We need risk management to profit off that edge, and then we need psychology to be able to execute that edge. And so we want to break things down and then focus on one piece at a time. If we try to do everything at the same time, we just fail. It's overwhelming. And you just want to focus on one thing. So what pieces do I need to reach this goal? for example, if I want to learn to drive a car, I need to learn how to steer. I need to learn how to press the gas pedal. I need to learn how to fucking turn the car on. So the selection, which 20% of these pieces lead to 80% of the results. This is kind of going down into the Pareto principle. You don't need to learn everything about a skill. You need to learn what is the most important parts of a skill. Obviously, being, the most important part of swimming is learning to float or like to not drown. So that is the most important part. If you just do that, you kind of most of the way there, then you can get into more breaststroke or, butterfly, the sort of different strokes around that. So we want to make sure we choose the most important pieces. That'll get us 80% of the way there. And then we want to make sure we're learning them in the correct order. So which order should I collect these pieces? Because, obviously you don't want to learn how to drift a car if you haven't learned how to turn it on. So you need to learn how to turn it on first, how to steer second, or, use the gas pedal. And then you can go into more advanced skills around drifting. And this is a big issue that people make when they try to learn to trade, because the sequence like of order is that most people think that trading is like 80-90% psychology. Yes, but psychology is 90%. Like 90% of traders don't have a psychology problem. They have a system problem. They don't know. They don't have an edge that is backed by data. They don't know that it works. They actually haven't done the work. Most people deserve to have bad psychology because they haven't done the work. They don't have a system. They don't know what they're supposed to be doing to get the results. They're just guessing and then blaming it on psychology. So we're going to focus on technical analysis first, risk management second, and then psychology a bit later on once we actually know what we need to do, and we'll break that down. So sequencing and then the stakes. This is really important because knowing and doing are two different things. You probably know how to have a six pack. You just eat less, you move more, and you eat high protein diets. But actually being able to do that, motivating yourself to actually do the uncomfortable thing is sort of the hard part of any skill. You kind of know what you need to do. It's just doing it is the hard part. So we want to set up consequences for not doing what we know we should be doing, and rewards to like incentivize ourselves to take the right actions. Because unfortunately, it would be nice, but we don't always act within our own best behavior, or what we actually want. So instant gratification, everything like that. So we want to set up consequences for not doing the right things, rewards for doing the right things, to incentivize ourselves to guarantee that we reach our goals as well. So trading is a very hard skill. It's very complicated, but people make it a lot more complicated than it needs to be. If we break it down, we select the right pieces, we sequence them in the right way, and we set up incentives to motivate ourselves to learn those different pieces, it's inevitable that we will become profitable. If I can become profitable, there's no reason why you can't become profitable. I'm not that smart. I'm kind of retarded, not gonna lie. I failed a couple courses in university. I'm not that smart. I've just spent a lot of fucking time and mistakes over the years. So the learning curve in trading, a big issue is that people expect their learning to be linear. So they start off and then just get better with the more time that they spend. But learning, especially in trading, in more complicated skills, is not linear. It's exponential. So in the beginning, you might start off quite good, but you'll actually get worse before you get better. So it's kind of like the Dunning-Kruger effect. The more you learn about something, the more you understand that you don't know that much. So you don't know how much you don't know in the beginning. So you actually get worse before you get better. You make mistakes, you learn from those mistakes, and then you correct those mistakes. Then over time, it compounds upon itself, and you become profitable. Only if you do the right actions, though, which we'll cover. A similar sort of learning curve is that you hit a bit of a growth spike, you get a bit worse, you plateau, growth spike, get a bit worse, plateau. And so learning to trade, the learning curve is more like this compared to like that. It's not very linear as well. So a big thing to understand, the biggest mistake that traders make is that they try to go from a new trader to a profitable trader. They try to skip the losing phase. That is the biggest mistake that you can make, because when you're learning, what is learning? Learning is all about error correction. So when you're learning, you're going to be wrong most of the time. When you're trying to learn a skill, you try to do that skill, you make a mistake, you learn from that mistake, you don't make a mistake in the future, you change your behavior, and then that's how you learn and improve. So if I'm, trying to get better at shooting 3-point basketball hoops, I take a shot, I miss, That's feedback for me. Then, okay, I used too much power or had the wrong, um, grip on the ball, and I need to change that. I try again. Okay, that worked better, and I'll change my behavior to do that in the future. So all learning is error correction. So when you're learning, you're going to be wrong most of the time, and so that's why you actually get worse before you get better. You want to make as many mistakes as possible as quickly as possible. The more you do that, the quicker you will learn and improve. So that is, we don't want to avoid losing. We don't want to avoid making mistakes because that's how we actually learn. All motivation in life comes from pain avoidance. If you're horny, you want to fuck, that's because you want to, that's like, because it's being uncomfortable, it's painful. If you eat food, it's because you're hungry, that is uncomfortable. If you go to your job, you don't want to go to your job, but the pain of being broke, is higher than the pain of going to the job. So you go do that. All motivation comes from pain. You need to make mistakes. You need to create pain for yourself to change in the right way. And so we need to make mistakes. We need to learn. We need to embrace that pain. And that's what actually pushes us forward to become a profitable trader and learn the right sort of skills as well. So when you're trying to get towards a goal here, you're going to do the goal. Problems are going to arise. You're going to diagnose those problems. And then you're going to design a fix to that. You're going to change your behavior to then try again. And you get a bit further. And then you go again. You get more problems. And then you keep going to the top right in this sort of loop and this spiral. And that's how actually learning works. It's all just through error correction. So when you're going from a new trader to a profitable trader, you need to first become an unprofitable trader. That is not a bad thing. That doesn't mean you're a bad person. You're dumb. Like if you're losing money, that is a part of the process. That's not an obstacle. That's not a bug. It's a feature. It means you're on the right path. So embracing being bad, being a losing unprofitable trader, and learning from those mistakes, you'll skip, so many years of failing if you just fail now and just learn from it. Don't try to avoid failure. Don't try to avoid mistakes because they are the most important things. It's only bad if you don't learn and change your behavior. I've blown multiple accounts. They were only bad. It's only a bad situation when I didn't learn from it. So, yeah, really, really important. But we also want to make sure we're learning in the right way. For example, there's different learning methods. We have more passive learning methods here. So, you're not going to get as much actual, learning from these sort of methods. So if you're watching a lecture or a video like this course content, it's helpful for information, but it doesn't lead to understanding or actually improving your execution. Like learning information, like reading, audiovisual, or even demonstration, which is a lot of content in this course. These are more passive learning methods. You're not going to be able to retain all this information. It's going to be harder. Active learning methods where you actually have to participate and you have to recall information that you have learned. Whereas this, there's no, you're not recalling any information. It's just you're just watching it. It's being, you're viewing it. In more active learning methods, you have to actually actively recall information that you've learned based on past experience or, videos that you've watched. So, group discussion, practicing by doing, like taking trades, executing trades, are some of the best ways to actually learn quicker. But the number one way, the biggest cheat code, if you want to become profitable as quickly as possible, is teaching. So, this course content covers a lot of information. Please, if you have anyone else that likes trading, any friends, any family members, give all my shit away for free. Like, I don't care. Just teach someone else because the person that, when in school, the person in the room that learns the most is always the teacher because trying to, convey information or explain something in a way for someone else to understand, you have to simplify quite a lot. And the act of simplifying that information not just simplifies and creates understanding for them, but it simplifies it and creates understanding for you. This is why I'm creating this course. This is why I teach. The best thing I ever did for my trading career was to start to teach other people because the act of trying to simplify and explain why I took certain actions created awareness and understanding about why I did certain things as well. Because having knowledge and actually understanding that knowledge is two different things. For example, if you've gone out to sushi and there's some wasabi there, let's say you have a kid as well, and the wasabi smells really nice. It looks kind of like nice and green, and the kid wants to taste the wasabi, and you say, no, that's very spicy. and they're okay, that's spicy information, but it smells really good. And so the knowledge and the understanding of what wasabi is, like you can give them the knowledge that it's spicy, but their understanding is that it smells good and it, looks kind of tasty. And so there's a difference between knowledge and understanding. As soon as they, let's say they put a bunch of wasabi on a sushi roll and then they eat it, and you just see their face go, "Wah!" Very spicy. That knowledge has now turned into understanding. How has that knowledge turned into understanding? Through experience. So we need to put knowledge into action through practicing by doing, trying to teach it to someone else, or group discussion. So knowledge turns into understanding through playing around with that knowledge, experiencing that knowledge, and tying emotion to it. And so this is why, like, you might watch a fuck ton of YouTube videos and then you go to trade the next day and you still make the same mistakes. You have a lot of knowledge, but you don't have understanding. You haven't played around with that knowledge to actually, have a deeper sort of sense of how it actually affects as well. Like, I've read Trading the Zone. A lot of people have read like books on trading psychology, and then the next day they make the exact same mistakes. They just know what, like, in more detail that they made a mistake. They don't actually know how to fix it, or they haven't actually gotten any better. So learning more doesn't mean you're going to get any better. You have to take action and use active learning methods. So teaching other people is by far the best and the easiest way. Everyone in my community that I've got to teach other people, they've had the fastest and the most growth. They're the best traders in the community because they teach other people. And so this is why in my mentorship, it's primarily revolving around group discussion, people taking trades, me giving feedback on their trades, and then me teaching others and people teaching us, like teaching others, having accountability, everyone teaching each other and getting better together as well. So really important, if you want to become profitable as quickly as possible, focus on active learning methods. You will become profitable in half the time. It's underrated. Like, it is the most important thing. It's so crazy. Trading is like any other skill. If you want to know something, read about it. If you want to understand something, write about it. If you want to master something, teach about it. Having people ask you questions about why you do certain things it has so much clarity, awareness, understanding that it brings for me, and I fucking love it. I get so many like aha moments when people ask me questions or I explain things like again and again and again, maybe in different ways as well. So yeah, that's sort of the learning pyramid. Focus on active learning methods. Make sure you break things down, sequence them in the right way. I'll give you all that. I'll do that all. I'm doing that all for you in this free course. And yeah, so another important thing is to make sure you're focusing on the right things. So we always want to focus on learning and not winning. I've done fucking hundreds of calls with traders. Some people became profitable within a year or a couple months. Some people weren't profitable after 5 or 6 years. There's a couple people that weren't profitable after a decade. And they all had one thing in common. All the people that weren't profitable after 5 years, over those 5 years, they always consistently focused on winning. They weren't trying to learn, they're trying to win trades, become profitable. And so when you focus on winning, you might have some immediate success. You might change things to try to win a trade here and there. I might remove a stop loss to try to win this trade. I might have inconsistent actions to try to force consistency of my profits. And I might try to, I avoid journaling my losses. It feels bad. I'm not trying to learn. I'm just trying to win. I might over risk, over trade, and I might have some, luck in the beginning, but inevitably you never learn. You never get better. You just plateau. And it ruins you. If you focus on learning over the long term, you journal all your losses. You embrace sucking. You embrace making mistakes. When you make a mistake and you lose, you don't try to avoid it. You look at why. Why did I lose that trade? Why did I make that mistake? Why did I blow this account? And then you learn from that. You embrace it, even though it hurts, and then you set yourself up to improve, change your behavior in the future. Because most people are just making the same mistakes, living the same 6 months over and over again for the rest of their lives. That's why they don't change. And it's kind of sucks, man. So if you just keep getting 1% better every single day, inevitably you will get better than the person who took all the shortcuts. And this is how you guarantee yourself to become profitable. It's impossible to not be profitable if you just keep getting a little bit better every single day. You embrace sucking. You embrace being bad as well. Because when you're trying to learn anything, like anything in life, there's 2 types of rewards. You have a external reward, such as money or profit. Then you have a internal reward, such as learning and improvement. And the work tends to work on you more than you work on it, if that makes sense. So there's always something to be gained from a trade. I never lose a trade. I lose money, but when I lose money or lose a trade, I gain an opportunity to learn from that loss and become better. So I perceive myself. I never lose really. Every trade I take is a win-win. I either win an opportunity to I either win money or I win an opportunity to learn. And so when you perceive that, like every trade I take is a net gain. I gain another data point in my journal to learn and collect more data to improve. That's how you focus on learning. That's how you focus on the long-term game, and you make it inevitable. And trading is also a lot less stressful when every trade you take is a win-win, because you just win money or you win opportunity to learn. So the guy focused on winning will get more external rewards in the beginning because he'll prioritize that. But he's not putting himself in situations where he could lose as well. So he's protecting himself from those losses, and so he's not going to learn as much because he's not making as many mistakes, or you know, as well. So you'll have bad habits such as over risking, removing your stop loss, over trading, all that type of stuff, and just enforcing those bad habits. When you detach yourself from the external reward, internally reward yourself for the actions that will lead to longer term results, such as journaling losses, putting risk on the line, just trying, and learning from mistakes. That is when you'll make it inevitable for you to just keep getting better over time as well. And unfortunately, again, so trading isn't linear, it is exponential. You will get worse before you get better because you need to make all the mistakes possible. You need to do everything wrong. Like a lot of like success in life, not just trading, is that you do everything wrong until it leaves what's right. So I make all the mistakes, I get all the bad things out of the way, and then okay, that just leaves what actually are the right actions to be taking. So I overtrade, I revenge trade, I over risk, I remove my stop loss. This all doesn't work. Okay, if I just do the opposite of that, I have a stop loss. I only take 1 or 2 trades per day. You need to do what doesn't work in order to find out what does. So you just like all experience, no experience is good or bad. The goal should just be to experience. If you do something and it doesn't work, amazing. Just stop doing that or do the opposite. If you do something that does work, keep doing that. And so you get worse before you get better, but and then eventually over time you learn from those mistakes and then you compound, you get exponential. And so in the beginning, you will always feel behind and you feel like, oh, I should be further ahead. It's taking longer. It'll feel longer. It'll feel like it takes longer and that's harder than it should be because of our expectations. We expect things to be linear when they're exponential. But when you cross this point here, like when I crossed this point where it started to become exponential and I just kept on getting better and better and better, nothing happens for years. Like I was a complete failure for years and everything happens within a couple of months. I lost thousands of dollars over years and then I made that back within a week. And so this is where the enjoyable part, you just have to stick with it long enough to reap these rewards. But once you do, holy shit, it's fucking rewarding. Nothing has been more rewarding than that. And the suffering kind of gives it meaning as well. But yeah, so trading is like any other skill. You need to actively experiment, try the skill. You have experience, so you might lose or win, and you reflect on that experience to conceptualize like, okay, I should trade this instrument, or I need to trade in this condition, and then you use that to experiment again. And that's how you get better. You learn, improve over time as well. And so, yeah, it's like any other skill. It's like basketball. It's like poker. I'd say it's more like poker. And yeah. Okay. And so all this is to say, we want to focus on taking as much action as possible. There's 2 types of knowledge in trading. There's implicit knowledge. There's knowledge that is gained from doing, internal knowledge. And then there's explicit knowledge gained from seeing or viewing, and that's external. So you're going to be consuming a lot of explicit knowledge, and that has a lot of information, but it doesn't lead to understanding. You need to take action on this knowledge in this course. So you can read a book about how to ride a bike. It doesn't fucking mean you're going to be able to ride a bike. You actually need to get on and get on the pedals as well, because you can read up on all this theory, but it doesn't really relate to how you specifically with your unique physical psychological traits are going to respond when trying to implement certain theories. Shit will happen as well. Okay, so now we're going to go over how to set the right goals in trading. Most people set the wrong goals. Obviously, we have sort of higher tier goals. So most people get into trading. Yes, you can make money, but the way you make that money is quite important. You don't have any, you don't have any bosses, you don't have any employees, you don't have any customers. It's just you in the markets. It's amazing. You can trade from anywhere, and it's extremely leveraged. You can trade only like I only trade an hour per day really, and I can make I've made over $1.3 million in the past year. So the time freedom and the location freedom and not having to fucking deal with people is, one of the biggest benefits of it. But in order to get towards that freedom, we have to reverse engineer into sub goals. So we might have like mini goals. So we have a 2-year goal of becoming a profitable trader, but first we might need to have a profitable strategy, have good risk management, have good enough psychology to be able to execute it consistently. So we want to break it down. And everything can, if I want to be a profitable trader so I can consistently make money trading, well, how do I do that? What are some actions I can take? I need to consistently take profitable trades. In order to consistently do something, I need to define what that actually looks like every single day. So everything kind of, comes back down into defining what a profitable trade looks like here, because, getting a goal or outcome becomes easy when we define the outcome we want into a consistent action to take. For example, if I wanted to be healthy, if I wanted to have a six-pack, most people fail to lose weight, not because they don't know what to do, but they haven't clearly defined the actions to take each day to make it inevitable to get what they want. For example, if I say, okay, I'm going to eat healthy for the next week, and then the next day comes and nothing changes, it's because like, yeah, I can eat healthy, but what the fuck does that mean? Like, if I'm trying to lose weight, that means I need to eat less. If I'm trying to gain weight, if I'm underweight, it means I need to eat more. It's not defined. It's not actually actionable. If I define, eating healthy into an action, so I eat, 3 eggs and a kiwi at 11 a.m. every single day, that is an action I can consistently take. That would make it inevitable for me to hit my goal. So it could be, I define the most important actions. So I weigh myself every single day. I eat the same meals at the same times, in a meal plan that is, in a calorie deficit, and I do 5,000 steps each day. If I just do that over time, it'll be inevitable that I hit my goal. So when you define the outcome you want into consistent little actions to take each day, that's when it actually becomes easy, inevitable to reach that goal. Most people don't become profitable in trading because they haven't actually defined the actions they need to be consistently taking to make it inevitable to reach freedom, making money, being a consistently profitable trader. They're taking random trades at random times using different strategies. And so if you're taking inconsistent inputs, you're going to get inconsistent results. And so, the holy grail of trade, like everyone wants to become a consistently profitable trader. But, that's broken down into two things. There's profitability, but then there's also consistency. Most people are profitable. They're just not consistent. Most people can take profitable trades. They just can't consistently take profitable trades because they're taking random actions at random times. They haven't defined what profitability means, and they can't consistently take it as well. So yeah, we have that outcome-based goal, but who do we need to become to reach that goal? And what is the daily process that we need to follow to make that goal inevitable? So what type of person, I need to become to have that? So that is probably the most important thing, because, trading reality is kind of a reflection of you, your beliefs, your identity. So identity-based change always leads to lasting change. So a big mistake that traders make is that they have a goal like, I want to become a 100K funded trader. I want to make 10K a month from trading. And so they solely focus on that goal. They don't break it down into the actions to take to get there. They just solely focus on that. So they might over risk to try to get like 100K funding. They might spend a fuck ton of money on accounts. They haven't actually defined a proper strategy. They don't actually have a consistent system that they know works, that's backed off data. They're just trying to gamble and trying to get there. And thinking, okay, once I have this 100K funded account, I have this big account. Okay, then I'll take it seriously. Then I'll journal my trades once I have that. And then I'll be a consistently profitable trader. So I'll try to hit this goal first, and then I'll do the right things. I'll have proper risk management. I'll use a stop loss. I won't over risk, and then I'll be a profitable trader. But that doesn't work because you never fucking get there as well, and it's inconsistent. You need to focus on the opposite. So who must I become who must I become who like what type of person has the things that I already want? So you are a reflection of what you do. Your reflection, you're pretty much just your daily habits, your daily actions. So what must I consistently do to make it inevitable that I have the thing that I want. If I journal 1,000 trades in as much detail as possible, I refine that like 5 times. I have a profitable strategy that's backed by data that I know works, that I have confidence in, and I use solid risk management, and that's consistent every single day. Over 2 years, it is impossible, pretty much impossible for me to not have that thing. But yet people try to take the shortcut. They just want this now, and so they put these off later, but then they just never get there. The quickest way to get what you want is to avoid all shortcuts and take the long route, because slow is smooth, smooth is fast, because you avoid all those big fuck ups and setbacks, such as blowing those accounts and digging yourself a deep hole. So the easiest way to become a successful, profitable trader is just to avoid failure. The easiest way to succeed in something isn't to try to be overly smart, it's to avoid being stupid. You'll beat 90% of people by not being stupid, not over trading, not over risking, using stop loss placement, all that type of stuff. So in trading, it's pretty easy. There's only 2 ways to fail. You either lose too big or you lose too often. And the thing is, losing too big is probably the easiest thing to fix. You just use simple risk management. You use a stop loss, always use a stop loss. You risk around 1% per trade, depending on your system. We'll go into a bit more details around that in risk management. And you maybe use max 1 or 2 trades per day. If you just use simple risk management, you can't lose too big. So this is like very easy to fix. Losing too often takes a little bit more work. We fix losing too often by having an edge. So let me just get this up. Okay, so pretty much an edge it just refers to probabilities or a factor or a set of factors that gives a trader a consistent advantage over others in the market. So you're kind of just having probabilities in your favor. It's kind of like you're the casino, and people are playing like roulette on your tables or playing your blackjack on your tables. You have probabilities in your favor. So it doesn't mean you're going to win 1 trade, but over 100, 1,000 trades, you will make money because you have basic probabilities in your favor. So you're being the casino, not the gambler. And most people think having an edge is quite hard to find. It's quite simple. We'll break down a little bit later in this course how to actually build an edge. But hard things, what we kind of talked about, hard things are just a series of easy steps. A marathon seems hard, seems like a big daunting thing, but how easy is it to place 1 foot in front of the other? Not that hard. It's pretty easy to do that. And so a hard thing is just a series of easy steps. So when you break it down, it becomes a lot easier. So having an edge, trading in general, is just breaking it down and answering simple questions. For example, we can break down trading into technical analysis, risk management, and psychology. If we want to break down technical analysis, it's like, okay, what pair or market do I want to trade? How many pairs? When do I want to trade? What type of style? Do I want to be a scalper, swing trader? And then, what type of strategy do I want to use? How do I find direction? Where I want to enter? When I want to enter? Using my entry model. Stop loss, take profit placement. It's all about just answering these small little questions, breaking it down, using data to answer that question. So each of these questions is kind of like a variable, and we want to think of it like a science experiment. And the easiest way to answer hard questions is to have data telling you that this is better than that. It's very easy. I'll give you a quick example of this. So for example, if I wanted to figure out when is the best time for me to trade, so it should be trading, let's say I'll get up my pair here. I'll make sure I have the right pair. So pair, yeah, I think I already have it up here. Hold up, let me find this real quick. Okay, so if I'm trading gold, I want to figure out, okay, when is the best time for me to trade? I want to answer that question. It's really easy to answer that question when I have good data. So if I have a look and say, okay, should I trade gold at the hour before Asia Open or the Asia Open? Here, so if I should trade gold at the first hour of Asia, here I have a 38% win rate. So I probably shouldn't be trading gold at the first hour of Asia. Okay, what if I trade gold at the second hour of Asia? Okay, I have an 82% win rate. So I have over double the win rate just by trading at a different hour. So it's pretty easy to answer that question when I should trade gold. I just want to trade gold at the second hour of Asia. Maybe I can also trade gold at the third hour of Asia as well, because of I can have a look at the win rate and see how these different variables affect the outcome. And it's really easy to take profitable trades when you define it by using data to answer those small little questions. And so an edge is like a series of questions that you've answered using that data. Okay, so yeah, trading is a lot like science, your hypothesis is like, if I take this trade at this time using this strategy, I will have this result. That's like your hypothesis. Your trading plan is your hypothesis. And think of like you collecting data, your trading journal as like collecting data around it to be able to see if it actually works, draw conclusions as well. And so, yeah, it's really easy to answer the questions when you have good data. So the Notion journal and reviewing that data, being able to categorize variables and see how they affect the outcome. There's a template in the WOP as well. I'll put the link below some of the videos when we cover trade journaling a bit later on. Because it's really easy to set up because you need to be journaling in the right way. Most people journal incorrectly. They journal for vanity, to make themselves feel better. And so when they go through a losing streak, they just don't journal their trades. But if you have the right journal and you journal your losses, that is like the best opportunity to improve. Because if if I trade the first half of Asia and I have a really shitty win rate, I just need to not do that and then I improve. Like it's you can improve through two ways. You can do more of what works, or you can do less of what doesn't, or you can do the opposite of what doesn't, as well. And so that once you do that, you can you have the edge. You can profit. You've defined a profitable trade. Yeah. And so, yeah, only two ways to fail. If you just avoid losing too big through risk management, losing too often through having an edge, which will cover how to actually build that edge later on. That's how you actually do it. So trading broken down as simply as possible. You have technical analysis to find that edge, put probabilities in your favor to avoid losing too often. You have risk management to avoid losing too big. And then you have psychology, having good trading psychology to be able to execute what works. So you just define one profitable trade, one profitable setup using data. You then manage risk over time to profit off those trades. So profit of 100 trades over time. And then if you just consistently do that, you consistently execute that profitable trade without deviating. That's how you make money. And so we're going to focus on building an edge first, risk management second, psychology third. If we do that, if we just break it down sequence in that way, it's inevitable that you'll make money, you'll become a profitable trader, you'll have all the freedom you want as well. And so, yeah, that's kind of the gist of it. It's not that hard to take it one good trade. It's hard to do it consistently. So that's what separates amateurs from professionals. So the goal is to try to be as consistent as profitable as possible. I'm not trying to be the most profitable trader. I'm trying to be the most consistent trader. Because anyone can take one good shot in golf, but it's the professionals that can do it consistently as well. So yeah, hopefully you enjoyed. So this is kind of the breakdown of how to actually become a profitable trader, how to learn trading. This is a lot of information. Take action on this information. Maybe set up the trading journal or take some notes as well. But hope you guys enjoyed, and I'll catch you in the next video. Okay, now we're going to talk about money, how to scale to 10K per month trading, how to use it to quit your job, how much money do I need or capital to scale and actually make a meaningful amount of money. How much can I expect to, what percentage of returns can I expect to make? How much money, all this sort of stuff. We'll answer these questions. So you need to understand that trading is the easiest vehicle to scale. Like inherently trading is a scalable endeavor. Making $10 on a $100 account is the same objective difficulty of making $10,000 on a 100K account. So you just do the same things. The leverage is the capital, the funds, the money. So the easiest way to make more money is to have a bigger account. But the biggest problem is that most traders are undercapitalized. Most people, like a lot more people, would be profitable if they just weren't broke and poor. It sounds a bit harsh, but I tried to, learn trading, become a profitable trader in university, and I was broke as fuck. And every time I bought a prop firm challenge, I'd lose 10% of my net worth. And so it was really like hard to pass a challenge because it meant so much to me. And so when you're undercapitalized, when money means so much and you have such a small amount to work with, it makes trading so much harder. And so you tend to over risk, you over-attach yourself to the outcome, and you force setups, you overtrade, revenge trade, and you lose that money, you fail because you just make it harder than it needs to be. Why is, trading on a demo account so much easier than trading on a live account? Because you don't fucking care. So how can I give myself as many reasons as possible to not care about this money, not care about this account? And so how can I enrich myself through other income sources to make this easier when I'm trying to make money from trading? Trading is like a force multiplier for your wealth. It's like, Trading is all about growing money. If you don't have any money or little money, it's going to be really hard to actually make a meaningful amount of money. And so the more money you have, the easier trading becomes. So having other income sources that you can feed into trading. So if I make like over my lifetime, if I have these, other income sources that come in, I think of trading as like a 10x multiple. Every dollar I make is like over my life is going to be, 10 times more valuable because of trading, and I can compound it very easily over the years or use prop firms. But there has never been a better time to get into trading. Like we're in the golden age of trading at the moment. So much information out there, so many access to like capital and prop firms, and using prop firms can be a way to fix this undercapitalization. The biggest issue throughout all the decades of people trying to become profitable traders was that they didn't have enough capital, so they had to over risk, over trade, and they blew their accounts. But now it's a lot easier. You can scale capital without scaling personal risk, without lots of money, and it's very low barrier to entry. But you can get fucking rinsed by prop firms. A lot of people have lost hundreds of thousands of dollars through prop firms through using them in the incorrect way. And I'll show you how to not get used by prop firms, but use the fuck out of those prop firms to rinse them and scale without spending a lot of money. So there's no cheat code to passing a funded challenge or getting payouts. You just have to be a consistently profitable trader. You have to have a defined system, a defined edge, and you need to have the the risk and the psychology to be able to execute that and make money. So if you can't follow your plan on demo, don't bother trying to pass a prop firm challenge. What you should follow like this. So trading is all about we want to prove that we're profitable on demo. And then we want to move on to a small prop firm challenge or a small live account. Ideally, I think a small prop firm challenge because it's easier to scale to a meaningful amount of money on prop firm challenges versus personal accounts in the beginning. Personal accounts are a long-term game, which we'll cover a bit later, but we want to focus on prop firms first. And so we want to first focus on a small prop firm challenge. You shouldn't go from 0 to 100K for your first prop firm challenge. You're just going to waste money. So we're going to cover this, but yeah, we'll cover this a bit later. But how much capital do I need for trading? First off, you need enough money to buy small prop firm challenges, and you need a stable income source so you're not emotionally dependent or attached to trading. You need those two things. So you need a bit of savings and you need a job. If you don't have a job, you make trading 10 times harder. If you don't have another income source, you make trading so much harder. When I was in university, I didn't really have a consistent job. I didn't really have consistent income sources. Trading was on hard mode, nightmare mode. As soon as I got a job, trading became a lot easier, and I started to get consistent payouts and scale prop firms. And so, how do we scale? How do we use our capital and deploy effectively? We want to have a bit of a buffer and start small. So, if you're trading futures, if you're trading forex, start with a 10 or 25K forex account or a 50K futures account. I'll cover this actually now. Okay, and so with these small accounts, these are so futures and forex accounts. So a 10K forex account is around the same price as a 50K futures account because they're kind of structured in different ways. But you can get a 50K futures account as low as $19 or around $50 up to $100. So it kind of ranges from around $50 to $100. You do have some activation fees, but in general, you could say it's around $100 at the highest point. If you don't have $100 per month to invest into your trading, you shouldn't be trading. You should be getting a job at Macca's. It's as simple as that. Like if you don't have, $100 is not that much money. If you don't have that much money, you shouldn't be trading. You should be doing something else. It's harsh, but it is the truth. We just want to go for, one of these 50K challenges. It's only $100. And we want to see if we can actually, pass that challenge and get a payout with, the system that we've been using. We want to prove that we're profitable on a demo account. Then once we are, we go on to trying to pass a 50K futures. It's only $100. If you lose $100, does it really matter in a month? No. So you want to be conservative. You don't want to full port it straight away. But the whole point is, passing the first account. Once you've passed it, it's quite easy to get a $1,000 payout. So you've, you know, you've invested $100, you've gotten an $1,000 payout, you've 10x your money as well. So think of it like that. We can then reinvest, that payout into more funded accounts, into another two 50K prop firm challenges. And then we can look to pass that and scale quickly. And you can see like over time, you can scale very, very quickly. And a lot of these firms have very high max allocations. So you can get funded with 450K on my funded futures, or over $6 million of max allocation on Apex, or 750K on Take Profit Trader. So you can scale very quickly using prop firms without much personal capital, without much personal risk, by first purchasing a small prop firm challenge, getting funded on that, getting a payout, then reinvesting that payout into more prop firm challenges and scaling up, compounding very quickly as well. And so for passing your first prop firm challenge, you want to be pretty strict with the risk management, be conservative, because you don't have much. Getting funded first is kind of the hard part. Once you get funded, once you get consistent payouts, it becomes a lot easier to compound and scale. So be conservative in the beginning, aim to get funded, get your first payout, and then buy a second or a bigger challenge to compound that over time. And if you fail that new one, you can always go back, use the existing profits, get another payout from the existing prop firm challenge to reinvest. You shouldn't trade all your accounts at the same time. You should trade them separately to diversify. And if you have a bad day, you don't blow all your accounts as well. So for Forex, you're profitable on demo. Okay, I'm gonna go for a 10K prop firm challenge. Okay, do I pass that? Get a payout? Yeah, I can reinvest that into 25K. I can reinvest that into 50K. If I fail that 50K, I can go back, get another payout from this to reinvest into that, and then go on to 100K. I kind of like futures prop firms a little bit better because they're a bit cheaper, and it's a bit quicker to pass as well. Compared to Forex prop firm challenges. The big trade-off is though that futures tend to have limits on your payouts, whereas Forex is kind of a bit easier. Like there's no real limits on your payouts, so you kind of get what you pay for. But in the beginning, this is probably easier, going for 50K futures for around $100, and then compounding to multiple 50K accounts over time. So you can have 150K. I can trade like this batch of 50K accounts here. So get a 50K, get a payout, get another 50K, get another payout, and then reinvest into two. There's two more again, and it snowballs very quickly as well. So yeah, don't go for the biggest account possible. That is a big mistake because you'd be too attached. You'll make mistakes on that and risking too much to pass as quickly as possible. Don't rush the process. Take it slow as well. Don't dig yourself a hole through trying to spend all that money on lots of prop firms. Think of the first prop firm challenge that you pass is like validating that you're profitable with money on the line. You're trying to validate that you're profitable with money on the line. And every time you pay for a challenge, think of that money is gone. Like it's gone. You've paid for the opportunity. You paid for the learning. You will blow accounts. That's okay. It's okay to blow in accounts. You kind of expect it. That's why we want to go for small accounts, because we expect to blow them and learn from those mistakes that we make to learn and get better. I blew 6 prop firm accounts before I ever got funded. But since they were all 10K prop firm challenges, I was still okay. I blew like $700. The first 10K that I got funded with, and I got my first payout on, I was able to be consistent on that for 3 months, and make all the money back from the challenge fees over those 6 blown accounts plus more. So I made around $900, 9% on that back. So I made all that money back plus more, and then I got that payout, and then I reinvested that into a 50K account, and that was actually too big of an account for me. I actually blew that 50K, so to go back to the 10K, get another payout as well. But yeah, so we want to avoid going all the way back to zero. You always want to have a small account that you can use payouts to reinvest into bigger accounts or other accounts. You're never actually spending money on trading. You're never putting your own personal money into trading. You're only putting your personal money into that initial account. Then you're using that initial account to scale into multiple other accounts. You avoid yourself wasting all of your money. You avoid digging yourself a big hole and ruining your life, which a lot of people do, because trading is very similar to gambling. It's a game of probabilities as well. So yeah, the first prop firm challenge is just to validate, can you trade your system properly when the risk is real? Because demo consistently doesn't equal live discipline. So passing one small challenge just proves you can execute under pressure, follow your rules, and manage daily loss limits and all that type of stuff, and consistency rules. And yeah, you need to validate before you scale as well. So yeah, trading is the most scalable business model. You can scale to the fucking moon and beyond. And it's a different type of work. So you get paid based on the quality of decisions, not the quantity of them. You're not doing anything differently when you're trading a $100 account versus a $1 million account. You're just doing the same things, but there's psychologically a bit different as well. So once you have the skill, it's the easiest money you will ever make. The hard part is getting that skill. So it's the hardest way to make easy money. But once you get over that, you have the system, you have the skill, you know it works. Money ceases to be a problem. You can just compound and build generational wealth through personal accounts, prop firms, and scaling. And there's no boss, no employees, no customers, just you and the markets, which is great. But also, something goes wrong, you are the only one to blame. The issue with scaling up is mainly a psychological one. Scaling up comes with more mental weight and more mental risk. Think of the bigger account you trade, the more you risk per trade, the more weight you put on the bar. So like every trade is a rep. The harder it is to complete a rep with more weight, more risk, more mental weight. But the only way to get better is to progressively overload risk over time, progressively overload that weight over time. But yeah, if you just do that, you'll be able to compound. I've made over 1.3 mil on my personal account. I like trading personal accounts more than prop firms because there's no rules, and I have the funds to be able to, have big returns. I don't need other people's funds. I can just trade my own funds. And that's kind of true freedom. But what I did in the beginning is prop firm stacking and personal account compounding. So you use the prop firm payouts to invest into other prop firms, and then use all that money to put into savings. So you care about that money less. You give yourself as many reasons as possible to not try to make money, to not care about money, and trading becomes a lot easier. So having lots of savings, diversifying into other long-term investments to diversify your risk, and then investing that into a personal account as well, which you can set up with a trade copier to copy to other 50K accounts, and you can have segments of different 50K accounts, and you can just scale to the moon. You can use those payouts from that 50K accounts to then reinvest into other long-term investments, reinvest into your personal account. You can compound your personal account very quickly by using payouts from the prop firms to fund that personal account. And then you can compound that account over time. So the thing is, for personal accounts, you're not trying to make money on personal accounts. You're trying to compound and grow wealth. So you're not trying to withdraw. You shouldn't be withdrawing money from your personal account, because that will interrupt compounding. You should only be adding money. Prop firms are about making money. Personal accounts are about getting wealthy, building generational wealth, and true freedom. I want a $1 million, $2 million account where I can just make 1% per month and I'm, set. I don't need to, there's true freedom from that. And prop firms can go down, personal accounts on regulated brokers, less likely, as well. And you can compound quite quickly. So I'll just get this up. Okay. So for one example, let's say you start with a $1,000 account, personal account, very small. And let's say we aim for 3% per month. You could very easily get 3% per month on a personal account if you're risking 1 to 2% per trade. You don't need 3R. So compounds monthly. We'll say over 10 years, a bit longer of a time horizon. And let's say we deposit $1,000 a month from prop firm payouts. So pretty low. You'll be making more from prop firms if you have a couple of 50K accounts. But we'll increase that by maybe 10%. So you scale up those prop firms over the years. So over 10 years, we would have $1.4 million in our personal account, just from $1,000 and payouts into that. So yearly compounded 42%, pretty good. And this is very conservative, only 3% per month on your personal account. You can increase this by increasing your risk per trade as well. But you've made over 3,000%. Even if we increase it to 4%, compounds a lot quicker. Now you're at 3 mil. If I'm making more money from payouts and I'm investing 2K per month from my payouts, you're at 6 mil. So like over time, you can compound very quickly. Let's say you have, $1,000 starting balance and you want to have higher risk on this personal account. So I'm going to risk 5% per trade. I probably need to have a high win rate. So let's say I have around a 70% win rate and a 1-to-1 risk to reward. We'll go 65% win rate. 0 break-even trades. We're taking 20 trades per month. Total months. This is over 2 years. We'll do 0 here. Okay, that's probably a bit too much. We'll go 12 months maybe. Okay, so with 5% risk, with a 65% win rate, with a 1-to-1 risk reward, which is very durable, with 5% risk, fixed risk, our max drawdown is 23%, so not too bad. Not too bad for risk management. And our initial balance is $1,000. This is higher risk, but the best case scenario is 119,000. That's a bit unrealistic. But by the end of the year, that $1,000 is on average around $20,000. And this doesn't take into account you investing more money from prop firm payouts as well, which can further compound this quite a lot quicker. But you might start to decrease the risk over time. Let's say you do 2% risk over, 24 months, 2 years. Still, you compound that pretty quickly over time. And this is like your max drawdown is 18%. So pretty good risk adjusted returns. Once you have the skill of trading, money ceases to be a problem. You can just fucking compound to the moon. If you know the statistics, obviously, 5% risk, maybe this is a bit too high. It's kind of based off your win rate, but 28% max drawdown is not too bad. And you're ending on average by the second year around, $100,000. So, once you have the skill, it's just a matter of time before you start to compound and make more money. And using prop firm payouts, you can get massive funding from different prop firms to reinvest into personal accounts to compound over time and all this sort of stuff. So really scalable. You just have to stay in the game long enough for that to take effect. It just takes time. Nothing happens for years. And then within a couple of months, everything happens. So patience is a hard part. Not rushing the process as well is quite a challenge. But yeah. And so you shouldn't just think about, I want to scale to 10K per month, because it sounds like a lot. Like this felt like a lot when I was first trying to, become a profitable trader, but very quickly you can scale beyond this. Trading is innately scalable and it's, so easy to increase leverage through capital. So you shouldn't really think about this. You should think about you can very easily, if you get to 10K, like 0 to 10K per month, trading is the hardest part. It's by far the hardest part. Once you get to 10K and you're doing the same, you just need to do the same things and you'll be able to get to 20K, 50K, quite easily, per month. It's just having a bigger account, more prop firm accounts, or a bigger personal account. You're just doing the exact same things that you are 10K per month at 50K per month. It's just, getting used to the risk and progressively overloading that risk as well. So you can make a lot of fucking money. The hardest part is just getting the skill, being patient with the process, and scaling over time. But once you have the skill, just getting more, the next goal is just getting as much capital under management as possible. So Kingmate is currently funded with 750K. He's going for $1 million in funding because it's so much easier to make 10K per month if you're just making 1% of $1 million. Making 1% of $1 million versus 10% of 100K, obviously one's a lot easier than the other. So, the goal is then capital allocation. How can you get as much money, under capital, that can manage as possible? So 6K, he's currently 750K funded, going for $1 million. So you can scale up very quickly using these prop firm challenges. This is mainly from prop firms, all from prop firms. And this, we have Shumba making 15K in 5 days, so 15K a week. He's averaged above 20K per month for the last 6 months now, all through prop firms. So, and a 50K prop firm challenge or 100K prop firm is around $100 to $200. So it's not that much capital that you're risking to be able to make 10, 15, 20K per month. You don't need a lot of savings or your own personal capital to make this money as well. So having multiple different prop firm challenges accounts, stacking that over time, you can scale very quickly to 10K per month. And when you have a system that you know works, you're just doing the same thing, just on bigger accounts, and you make more money. And that's what my students have been doing. And yeah, it's a lot easier when you know it works. So the hard part is just the beginning, getting to 0 to 10K. Getting to 10K is the hardest part. Once you get to that, to scaling from 10 to 20 to 30, 50, 100K per month is actually quite a lot easier. And it's almost actually less stressful as well because you've already done the hard part. It's just now, staying in the game long enough for it to compound over time. Okay, so how much time does it take to succeed in trading? How long is this going to take, man? I get asked that question quite a lot. How many years? Be profitable in the next 3 months. So here's the thing: the sooner you accept that it'll probably take longer than you want, the quicker you'll get there. The less you focus on how long it's going to take, and the more you focus on actually just doing the work, the quicker you'll get there. And it's impossible for me to tell you exactly how long it's going to take. I can give you like a range. I can tell you if you do this, this, and this, you will become profitable guaranteed if you just take action on this. But it's up to you to actually do it. And we want to be we want to have realistic expectations around trading, because trading is like any other complicated skill. To become a lawyer, it takes 7 years, a doctor, 8 to 12 years, engineer, 4 years. To fucking graduate high school or, university is like 4 years for most degrees. And, in these degrees, you have structured learning. You study frameworks, it's supervised, you get help, you get taught. For all these skills, you get, someone that teaches you, and you get feedback. They review your work, and you look hours under structure. And trading, you need to do the same things. Like trading, learning the skill of trading is very similar to learning all these other technical skills. But the difference in trading is that most people, there's no curriculum, there's no exams. You don't really get feedback on your work, so how you're supposed to improve and know what you're doing right and wrong. And no one kind of stops you from self-sabotaging. And you have infinite freedom, infinite ways to make money, infinite ways to blow up and lose money as well. In trading, that's sort of the hard part. You don't have any structure. You have to figure it out on your own. You don't have to. You can get help from other people who have done it before you. But your losses like losing money in the market is kind of like your intuition. So learning from those losses, all learning is just error correction as well. And so yeah, you can become profitable. It depends on how quickly you become profitable. You can either pay in time or money. So you can pay extra time, so it will take longer to become profitable if you try to do everything on your own. Or you can pay to get help from someone who's further along the road, to skip and learn from their mistakes. But you don't have to do that. You can learn on your own. It just take longer as well. But yeah, trading really isn't about how much time you spend. It's about how you spend that time. So doing the right sort of things. So I've done lots of calls with people over the years, lots of calls with traders, over hundreds of calls. And there's people that became profitable within around 1 to 2 years. So within the first 2 years, they became profitable. There's people that didn't become profitable after 5 or 6 years. And I was talking to, a couple of these people, and routinely I found that the people that have been trading for 2 years and became profitable, the calls I had with them, they were closer to becoming profitable than the people that were trading for 5 or 6 years. And the main difference was that the people that focused that weren't profitable for over 5 years and weren't any close to being profitable. They weren't close at all to becoming profitable. They were completely focused on making money and not learning. They were chasing shortcuts, and they weren't doing the boring, uncomfortable things that guaranteed they'll become profitable over the long term. So chasing shortcuts is the longest path to succeeding. Trading is the hardest way to make easy money. If you want quick money, don't fucking trade. Please don't trade. There's so many other ways to make money. If you want money quickly, do not trade. If you're chasing signals, copy trading, automation, bots, and such like that, if you're not willing to do the work, don't trade. You're just going to waste time and money. So the traders that became profitable within 1 or 2 years, they commit to one system. They don't strategy hop. They don't fucking use 14 indicators, trade random concepts at random times. They stick to one thing and they master it. One clear entry model, one clear, sort of trade. It could be continuations, reversals, one condition. Are you trading, trending conditions, ranges, trending ranges? And then you just do it again and again and again. if you're constantly switching strategies, you're killing the momentum. You get good at one thing and then, oh, it's not really working. I'll switch to the next thing. I need to get better again. I'll switch to the next thing. I need to get better again. So you never let, skill compounds over time. You need to stick with something long enough to make it profitable. So the people that become profitable earlier is that they start journaling earlier and they journal everything. They put more effort into journaling, reviewing, reflecting, and less into actual trading. A lot of people have been trading for 2-3 years. They've never journaled a trade. They weren't trading, they were gambling. You were just clicking the buy and sell button and randomly expecting to become profitable. But if nothing changes, nothing changes. Like, how are you supposed to learn if you're not tracking what you're doing? Seriously. If you're not journaling your trades correctly, you're wasting your time and your money. You should not be trading. Bit harsh, but it's true. So they journal everything, not just wins. If they go through a losing streak, they'll journal that. A lot of people journal until they go through a losing streak and I don't want to do that. That's a bit painful, uncomfortable, makes me look bad. You need to embrace sucking. You need to embrace being shit at trading. That is the only way to learn and improve. All learning is just error correction. So tracking and journaling everything is extremely important in as much detail as possible and doing it the right way. I will show you how to journal correctly. I will give you a template. I'll do most of the work for you. I'll give you the structure. But I've talked about how important journaling is, but still most people don't do it because it's tedious, it's boring, it's uncomfortable, because they don't actually want to become a profitable trader. They just want to make quick money. Like, do you want to be profitable in trading, or do you just want it? Like, I want to have a six pack, but I don't actually want the reality of having a six pack. I don't want to actually be hungry. I don't want to, stick to a meal plan. And so I don't do it. It's fine. Do you want the dream of trading, or do you actually want the reality of it? Are you willing to pay the cost to have that success? So very important. They also progressively overload over time. So they don't go straight from a demo to 100K funded. They do it like small sort of, scaling over time, 0, 10K, 20K, and so on. So not all or nothing. And then in general, they focus on the process and not money. If you just define a profitable trade, you consistently take profitable trades, you'll make money over time. If you're constantly focused on trying to make as much money as quickly as possible, you will not take consistent action. I'll remove my stop loss so I can avoid this loss, so I can make more money. I will overtrade when I'm in drawdown so I can get back into profit and make more money. You'll take inconsistent action to try to, get that thing, and so you'll have inconsistent results. Money is a lagging indicator. Focus on the process, focus on learning, and winning comes later. So, and then they also shorten the feedback loop as well. They learn from the mistakes and change the mistakes as quickly as possible. All learning is followed by that error correction and changing behavior. If you have a mistake and you don't change your behavior, you haven't learned. Nothing's going to change as well. You're not going to improve. And learning can kind of be broken down into 4 main stages. So competence, getting competence in a skill. First off, you have unconscious incompetence. So in the beginning, you don't know what you're doing wrong. And so it's possible you can't really change it because you don't know what you're doing wrong. This is where you can skip a lot of time. So getting accurate feedback, like, you need accurate feedback to learn. So having someone else who's further ahead of you, it could be one of your friends, or someone that you trust, who has experience, who's made the mistakes and can spot mistakes in your trading that you can't spot and give you accurate feedback, will save you a lot of time. The second phase is conscious incompetence. You know what you're doing wrong, but you can't fix it. So you might not know how to fix it. So I'm making this mistake. I keep entering too early. I get stopped up before price goes in my favor, but I don't know how to fix it. This is as well where you can get help from someone else who's been through the same mistakes and errors. You can research online, and you can go through lots of different resources to try to fix this. And then the third stage is conscious competence. So you have to actually try hard to execute that skill, but you do it the right way. And then the end stage is unconscious competence. So you don't have to try anymore. It's just automatic. You just automatically do the right thing. Think of this as like tying your shoelaces. That's when you master the skill, you get unconscious competence. You don't have to think about it. You just do it correctly as well. So feedback is the most important part for learning. You need to make sure you have good feedback to fix mistakes, and like first identify mistakes, fix them, know how to fix them as well. So methods to speed up. Again, learning alone versus learning with structure. Structure does help speed up that learning process. You don't need it, but you'll save a lot of years through having it. Because if you self-teach, you're accountable to yourself. You have to journal deeply, journal properly, back test, spend a lot of time, and build your own statistics, validate your own data as well. I fucking love having a community because I don't just review my journal. I review dozens of other traders' journals. And if I'm tracking like 1 or 2 trades per week, it takes a lot of time to build up enough data. I mean, in general, I tend to take like around 3 or 4 trades per week, but it can take a lot of time to build up enough data to make a informed decision on what's better to do. I can view dozens of traders' journals in my community, and see how they trade, see what's working for them, see if this person having this learning that they're trading at this time works better. Does this relate to this other person who does the same thing and is also having the same results? Like one thing is like all the traders that trade my approach all found that trading after 30 minutes into the hour, like not trading 22 to 30 minutes, trading 30 to 45, 52, they always had a higher win rate with that. And I had a look at my own journal. It reflected in my own trading. And we all learned together through feedback that this actually improves our trading and we became better for it. So having people to learn with, it could, having a friend is really important, or having someone to discuss, using active learning methods to, group discussion or teaching someone else, having someone you can teach trading will massively speed up the learning curve, understanding clarity as well. So having active learning methods as well. I would spend less time like watching videos, reading books. YouTube videos, reading books about trading is not that important. It's mostly a waste of time, actually. More time should be spent on discussion, experimenting, doing, journaling, reviewing, reflecting, and teaching others. If you spend more time on that, you'll get so much better. I spent the first 2.5 years doing this. I improved maybe, I improved like that much. I started to focus more on this. I started to improve a bit more. Once I started doing this, it went like fucking that. That's like my learning just 10x'd over time. So focusing on active learning methods will cut your time to become a profitable trader in half. If you want to understand something, so if you want to know something, read about it. If you want to understand something, write about it. If you want to master something, teach about it as well. So yeah, we kind of talked about unconscious incompetence, not knowing what you're doing wrong. Conscious incompetence, not knowing how to fix it. Getting help, really helps fix this, because you might not know what you're doing wrong or how to fix it as well. And so yeah, trading is very isolating. I got into trading because I'm kind of an introvert, but I think that held me back quite a lot. I could have become profitable a lot earlier if I, discussed more with others or got help. I think that's, something I kind of regret as well. Because, so how long will it take for me to become profitable? Will it take, years, 5 years, 6 years? In general, everyone in my community who's become profitable earlier has been active. So they've tried to help other people. They've tried to teach other people. They've participated in group discussion. That's why I have a community in the first place, because of group discussion. They get feedback. So I personally review every single trader's feedback in their journal, in their Notion journal process. And, I'll spot, they might not know that they're doing something wrong, or they might have, have a problem, but they don't know how to fix it. And so I can spot that and give them the fix because I've already made the mistakes. And me doing that actually makes me better because I'm teaching. And so I learn and improve more. And so it's like a self-fulfilling cycle. It's a positive flywheel. We'll just get better together, and it compounds over time. And so that's the quickest way to become profitable, is to use the right methods, is to get help, and teach other people. If you have any friends that want to learn trading that you can teach them stuff from this course. It'll make you a lot better as well. And yeah, so I've had a trader who was very active, put in a lot of hard work, constantly got his trades reviewed, that was completely new to trading. And within 40 days, they got their first payout, halfway funded to their next 50K funded challenge as well. So within the first 40 days, they got a payout, and they're halfway through the next 50K funded challenge. But they put in a lot of fucking work. They journal their trades, they ask for feedback, they were always in the calls asking for, and discussing as well. Like they were always there, and so they made themselves known. And so it's really up to you. You get to decide how long it's going to take to become a profitable trader. It can be, it can happen earlier if you put in the work. What is the work? What should be doing? Journaling your trades, taking lots of trades, like reviewing those trades, seeing how you can improve that using the journaling system that I'll show you, and I'll give you the template to do. And then refining, iterating, improving over time, building that edge. Taking a lot of fucking action. Volume, like takes so much volume, so much action that'll be unreasonable for you to not succeed. And then using active learning methods as well to speed up that learning process, getting accurate feedback as well, and that will speed up the whole learning process. Okay, so you probably know that 90% of traders fail. The vast majority of traders fail at trading. So should you actually, start it? Can you actually make money trading? There's a lot of discussion around that. Like, can you actually make money trading? There's a lot of limiting beliefs around this. That 90% of traders lose money. Should I even be doing this? A lot of people in the beginning think that they're different. When I got into trading, I was like, yeah, 90% of traders fail, but I'm smarter. I'm better than others. But I also blew 90% of my account in the first 90 days. So I was not smarter than the average person. I was a part of the statistic. And so only a small minority become profitable because only a small minority do the right things, take the right actions, staying within it long enough to get results. Because failure is the default in almost everything. Most businesses fail. 60% of restaurants fail within the first year. 80% of restaurants fail within the first 5 years. Like that's almost as bad as trading. And many industries are even worse. Around 50% of marriages end in divorce. 99% of relationships don't make it long term, don't succeed. Think about how many relationships you go through to find the one that you marry. And then half of those marriages fail. And so it's around 1% of relationships or dates that end up, finding the one. Would you just never go on a date because it's such a low chance of not finding the one? Or how can I increase the probabilities of me, succeeding? Because, the average is to fail. The average person fails. And the reality of life is that, failure is not the exception. It is the baseline. It is guaranteed. And you need to fail. It's how you look at failure. Like I failed a lot. I'm a failure in a lot of things. And I'm so grateful for it because failure teaches you what not to do. You need to fail a couple of times to learn that isn't the way, and then change and learn from those mistakes and improve. Most people that become millionaires, billionaires, have a business that works, go through around 7 businesses prior to that. So it's expected, The problem is that people quit early, they avoid discomfort, chase shortcuts, refuse to look at their own mistakes, take responsibility, accountability. People blame the markets. The only person to blame is yourself. Take responsibility for your life and your actions, and do not blame external things. As you're just making yourself a victim, you're taking power away from yourself. So when you hear 90% of traders fail, you understand that most people fail at most things. Most people fail at most things that require discipline. I think 89% of people that make New Year's resolutions fail within the first month. So to be human is to fail. To not fail is to go against your own human behavior, is to be the exception. So it's not just that trading, most people fail in trading. Most people fail in anything, relationships, business, anything that requires, I guess, like discipline or doing something that is challenging, they fail. So trading just exposes it faster. Trading is hard, but it's hard because we're human, not because it necessarily has anything to do with trading as well. So trading really isn't hard because of the charts or analysis. Analysis is quite easy. It's hard because of your loss aversion. Humans feel the pain of a loss 2 to 2.5 times stronger than the equivalent pleasure from gain. So losing $1,000 feels a lot worse. We'd much rather not lose $1,000 than make $1,000. So loss aversion really fucks with us. And so when we have that, we're a lot less likely to risk. We're not very good at risk as humans. And we hate uncertainty. Like, humans hate uncertainty. This is why, people tend to go for jobs over starting their own business, or stay with a partner that's not right for them, because they don't want to have uncertainty of, like, they'll settle because what if I don't find someone after this, or find someone as good or better? So, people avoiding uncertainty leads them to failing. Um, and so being able to lose, being able to suck, being able to embrace uncertainty, it's amazing. It's what it means to be alive, is to be uncertain. Anything can happen. We want to avoid boredom. And so to be a profitable trader, you must learn to go against your own human behavior, because you're fighting against your own human, instinct, and, like, you know, hundreds of thousands of years, like thousands of years of wiring as well. So yeah, the truth about 90% of traders who fail is that they don't journal their trades. I did a poll, I think, on my Instagram like a while ago, about how many people journal their trades. And I talk about journaling a lot. And the vast majority of people don't journal their trades from my audience. And that's really, that kind of fucking ruined my day. But they just don't do this. Like, how are you supposed to improve something if you're not tracking it? Like, if I want, yeah, it's insane. It's insane. How are you supposed to improve something if you have no feedback to learn from and improve? I'm flabbergasted. But yeah, they're impatient. They're constantly chasing shortcuts, quick dopamine, and they just chase fast money. And so it's just, the average person, as well. So you wouldn't open a restaurant with no experience and expect to succeed in the first 2 years. You're probably going to fail the first restaurant you open. If you learn from that failure, you open the next one, you're more likely to succeed. And so, yeah, starting a business with no systems, no tracking, is probably not going to survive. And if you, start a business, it fails, you learn from that mistake, start the next one, it'll be better. Because, when you fail, it's never a bad thing. It's only bad if you don't learn from that failure and you don't change your behavior after that. All learning is just error correction. You need to make mistakes, you need to fail in order to grow. You need pain to grow. So you need to go through a couple bad relationships to figure out what a good one looks like. I need to, find the wrong people in relationships to know what the right one is. They can only be good if you know bad. There's, you need contrast. You need contrast. Like, in order to have light, you need dark. And so in order to succeed, you need failure, and you shouldn't avoid it. You should willingly embrace it to make you better. But yeah. So becoming a top 1% trader is about becoming a top 1% human. Really, self-improvement in trade, like improving your trading, is all about improving yourself. It's very combined. To become a good trader means going against your human behavior. Becoming a person that succeeds where most people don't. So I was a failure in most things in life, but I learned how to improve myself. Trading was a vehicle for self-improvement. And once I, learned how to, control my own behavior, modulate my behavior, my emotions, and become a profitable trader, I learned the skill of learning. I learned the skill of success. So not just succeeding in trading, I took that success from trading. I put it into content creation, and I grew this big audience using the exact same things in trading. I just applied it to content. Yeah, I'm so grateful that I learned trading, because I don't think I ever would have become the person I am now, if I didn't start trading. Trading is one of the worst things that ever happened to me. It completely ruined my life for 2.5 years. But that suffering led to so much growth personally, and I never would have had that if I didn't try and fail. And so just try, man. Like, the goal is to experience, but no one leaves, the game alive. We're all going to die. So might as well go for it. Give it your best shot. The worst thing that can happen is that you learn. So yeah, got a bit sentimental there, but yeah, I hope you find this helpful. Just treat trading losses like a business expense. Think about the internal reward. Every single time you feel pain, how can you grow from that, become better? Most meaning in life comes from pain. the bad years is like I'm the most like the years I'm most grateful for were the bad years because it kind of built me into who I am. And so yeah, you know, finding meaning in pain and suffering and putting yourself out there and failing is really important. So yeah, hope you guys enjoyed, and I'll catch you in the next video as well. Okay, so now we're just going to talk about some software. We're going to cover different softwares to use. First off, we'll start off with charting. So for charting, I just use TradingView. It's by far the best. Um, yeah, it's pretty much free. You can go for higher tiers, but you can execute on this. I tend not to execute on TradingView. There's a little bit of like a delay on TradingView versus platforms like NinjaTrader, Trader8, MT5. So I'll tend to execute on other platforms, but I'll do my charting, my analysis on TradingView because it's so easy to use. I can like, you know, draw all these things, you know, um, yeah, so easy to use and chart, and I can have like all these custom indicators and stuff like that. So that's for my charting. For news, so you need to understand news. Forex Factory to understand, you know, red full of news, so we can avoid these big news events that will like spike the market. You know, you have these big volatile periods when news comes out, so we want to avoid this. So using Forex Factory here to avoid that. For trading plan, trading journal, this is sort of resources for learning, getting feedback, improving, visualizing things. So I use the Notion journal. There'll be a template. There's a template on the WAP under the trading journal where you can like fill this out, you know, get feedback. I can see how to improve my own trading. I can, you know, see what my win rate is and stuff like that as well, and, you know, track everything. Yeah. And then Miro is what, you know, I use for this. So Miro is for like mind mapping. I have my own, you know, trading mind map that I've filled out over a pretty big period of time. Where I've like, you know, tried to break things down and visualize, you know, what my most profitable trades are, break down trading into, you know, technical analysis, risk management, psychology, meta skills, you know, break down models and try to visualize what a good trade looks like as well. And like, you know, prioritize different confluences and, you know, try to get understanding through playing with information, like playing with knowledge to create that understanding as well. And so, you know, these two things are really helpful. Trade plan, trade journal for Notion to just try visualize or build a trading plan in the Miro is also a good idea. For prop firms, if you want to, you know, figure out which prop firm to choose, prop firm match. I'll put all the links below on this video as well in the description. So prop firm match can be good for comparing different prop firms for futures and forex. You can see, you know, spreads and stuff, the payouts. It's a pretty good resource as well. For trade copiers, for forex trade copiers, you can use Traders Connect. For futures, you can use Trade Syncer. It looks, yeah, Trade Syncer is pretty good. Trade Copier as well is another one you can use to copy different accounts. Backtesting, FX Replay. So if I want to backtest and do a bit of testing, I think FX Replay is probably the best for that as well. And I can, you know, see, you know, test my strategy on historical data. I'm not the biggest fan of backtesting. I like live trading a bit more. And then you can do Trader8 for different execution platforms. You can either do MT5, Trader8, NinjaTrader. Like, so this is Forex, mainly Forex CFDs. And then this is mainly for futures as well. But yeah, those are sort of the platforms you can use. And most of them are like relatively cheap as well. But yeah, okay, so now we're going to cover trading systems and specifically define them, because most people think a strategy is their system for trading, but these are two different things. So what actually is a trading system and why don't you have one, even though you think you do? So a system is a set of interconnected parts that work together toward a specific purpose or outcome. And in trading, so a system is defined not just by the parts themselves, but by how these parts interact. That is the power of a system. You're not just looking at individual pieces, but how these pieces interact with each other and the relationships between them and the feedback loops, not just those, individual components. So if we want to treat trading like a business, we need to learn what a system is and how to actually use systems to have consistency in our process. Just like how a business has standards of procedure that the everyone follows. They have policies in trading. We want the same thing. We want standards of procedure. We want systems to follow. So we take the right actions, consistent actions. Because if we want consistent results, obviously we need to take the same actions. So a system is kind of broken down by 5 main parts. You have the input, the process, output, and the feedback. And then the 5th part is the environment in which the system takes place. Like a business, think of it like a factory. So you have raw materials are the input that gets processed on an assembly line. It gets turned into a product, such as headphones, where you might have like metal, raw materials, bit of plastic gets processed by these machines into these headphones, and then we sell those headphones, and we get feedback. So maybe we get negative feedback that these headphones are shit, sounds like ass, I can't listen to my beats, and that negative feedback. Okay, to improve this, I could either improve the raw materials. I could source higher quality materials, or maybe I could change the process to use the raw materials better, or I need more quality control, and so that improves the product. Maybe this time I'll get better feedback. People actually like the product, and so I just continue doing that. And then it's a virtual cycle. We keep on getting better, better, and better. And in trading, we want to do the same thing. So the raw materials in trading are the concepts that we use, such as market structure, market conditions, direction, entry models, areas of interest, anything like that, liquidity, all of these different concepts. Think of them as the raw materials that you use to build a strategy, a plan, a process, to have a product, an outcome, a certain type of trade. So, sorry, an output. Outputs are different from outcomes, but the output is your trade, and it could be you take 100 of these trades, and it results in you're losing money, which kind of sucks. But you've through the trading journal, hopefully you've collected that data, you've collected that feedback, or you to then either change. Maybe I need to change my concepts. I need to change the way I use my concepts. So I need to look for this entry model in this condition, or this sort of time frame. And so I take different trades. I have a different output that results in maybe a different outcome. That feedback here, I actually make money this time. So I either keep on doing what I have been doing, or I can refine the process even further. So trading is very similar to a business. You need a system so you can learn from what you're doing, and be able to identify what inputs should I be using, what process should I be using, what process should I be using these inputs in? Do I need better quality control, anything like that, to try to have good outputs, which lead to better outcomes. Outputs is like if I post a piece of content, that is an output. The outcome is how well that content does. Or me recording this is an input. So me recording this video is an input. This video is the output, and the outcome is you watching this, either liking it, hating it, calling me a bunch of names, or saying I'm amazing. It's up to you. So input, output, outcomes. We want to identify what inputs lead to the best outputs, so we can get the best outcomes, which is profit, making money, and like positive feedback, ideally. Negative feedback still fine to improve. But then the environment is kind of like this. So the factory that the business is running, is that in a certain country where the environment, you get invaded, that country gets invaded, it starts a war, the factory has to shut down. Or the general business environment, such as markets changing, AI, or that factory having to shut down because they can't have cheap enough labor to run that factory in a cost-effective way. It has moved to China, stuff like that. So that's the environment. In trading, think of this as your daily routine, your personal life. That is the environment that your trading inputs are set in, your trading system is set in. If you sleep like shit, if you eat like shit, if you don't exercise, that is a negative environment for your trading system. You're not really going to be able to execute this system well. So it's important to understand this, because systems thinking as a skill is extremely important for not just trading, but every other aspect of life and success in general. And so in trading, hopefully that is, gives you a better understanding about what a system actually is. We'll go through actually now how to use them in your trading process. Because if you want to scale, you need systems. If you want consistency, you need systems. People talk about setting systems and not goals. This is how you actually do it, and we'll cover it in these videos. So first off, here, the system can kind of be broken down. I'll cover, so you first have your trading plan. This is kind of like your process, what you should be doing. The trading journal is collecting data and that feedback around what you're doing. And so you need those two things. If you don't have a trading plan, if you don't have a trading journal, you're not going to be consistent and you're not going to learn because you're not collecting any feedback. The learning process is kind of broken down into a couple of different parts. So similar to any other skill, let's say basketball, you take an input here. So let's say, so you hold the ball in a certain way. Maybe you jump when you shoot, or you don't jump when you shoot. But the hand movements, the flick of the wrist, all these different inputs, it gets processed into your skill of shooting a basketball hoop, and then you shoot that hoop. That output results in an outcome. It could be a positive or negative. So maybe you miss that basketball shot, and that's actually feedback for you then to review and learn from that. Okay, maybe I used too much force or too little force. I put too much force into jumping, or I'm held it the wrong way, which you can then refine and improve. The inputs, maybe I need to hold the basketball in a different way. I need to use less force in my process, so I can get a better shot, a better outcome. So output, which then leads to a better outcome. And then if that shot goes in, okay, I won't change a thing. I'll keep doing that and refine and improve over time. The difference here is that inputs, outputs, so inputs into outcomes are kind of disconnected in trading, because trading is a probability-based game. You can take a good trade, but that trade can still lose. And so we need to have a big enough data set for the probabilities to not matter as much. So if I take 10 trades, they can be 10 good trades. I can still lose money if I have a 60% win rate. I might just be unlucky. Probabilities might just not be in my favor. If I take 100 or 1,000 trades over a period of time, and it's 100 good trades, it's a lot less likely for me to lose money, because if probabilities are in my favor, it's pretty much guaranteed. If it's with a 60% win rate, that result in a positive outcome. And so trading is different to other skills, where because it's based with probabilities, we don't specifically know if and a positive output won't always lead to a positive outcome, because it's a probability game. Like, you have a 6% chance of a good trade resulting in a winner. You still have probabilities in your favor. Doesn't mean you're always going to win. And so in order to get accurate feedback, because we can take a good action, it can lead to a negative outcome that can be negatively reinforcing a good behavior, which is what you don't want. So we need to have a trading journal so we can collect enough data points over a set amount of trades to have accurate feedback. This is why if you don't journal your trades, you're never going to have accurate feedback. You're always going to be making changes and decisions based off the last 1 or 2 trades, how you feel, and you'll just keep going in circles because you don't have accurate feedback. You will never improve. You'll keep learning more, but your results won't get any better because you don't have accurate feedback to learn from. You don't have a big enough data set to make a conclusion of. Treat trading like a science experiment. Your trading plan is your hypothesis. Your trading journal is where you collect that data and you see how variables affect the outcomes. And then you draw conclusions from those experiments. If you only take if you only have 10 data points, they can be all over the place. You're not really able to draw an actual conclusion or correlation from. The more data you have, the more accurate you'll be, and you have better feedback. So really important to have a trading plan, trading journal as well. So we'll go through trading journal a bit later, but you want a trading journal for feedback. To be able to find, what is the best process and what are the best raw materials, the inputs that I should be using in my process. So we can map it out and do all that stuff. So in trading plan, it's just specifically what am I doing? What am I trading? When am I trading it? Where, am I looking for an entry? All these sort of things we want to define in our trading plan so we can stick to it and be consistent. You want to externalize information, externalize your plan, and not keep it in your head. If you want to be consistent, you need to externalize it, because don't trust your brain. So the 4-step framework to identifying and building your trading system is, first, we want to define the outcome, the output, and the outcome as well. So the outcome is like consistently making money trades. So consistently making money trading. The output would be to consistently take profitable trades. So if we consistently take profitable trades, that will lead to us consistently making money trading with the right risk. Because why wouldn't it? Why wouldn't it? But we need to define the input. So, what inputs do I need to take? What process do I need to use to have a profitable trade? To take good trades, and that can only be done through data. Remember, we're trying to answer small little questions. It's really easy to answer a question when you have data telling you that this is better than that, instead of just guessing. You're making informed decisions. So what inputs lead to positive outputs? What inputs lead to a good profitable trade? Is it taking a trade at a certain time on a certain pair, at a certain area? What entry models lead to probabilities being in my favor? We can only define this through data. If you want to trade, with a probabilistic mindset, trade with probabilities, you actually have to fucking understand the probabilities. If you don't journal your trades, you will never understand the probabilities of your system. You're just gambling pretty much. So you might as well go to a casino instead. I journaled over 400 trades, analyzed them, and I found that reversals in ranges 30 minutes into the hour using a 1-minute shift gave me a 75% win rate. These are the inputs. That's my process that leads to the output, which is profitable trades, which leads to the outcome of me making money. Hopefully that's making sense for you. And so this is how you go from guessing, lacking confidence, to knowing. Confidence has to be earned. Confidence comes from having evidence that you are who you say you are. If you want to be a confident in yourself that you are a profitable trader, you need evidence that you are profitable. So you need data. So yeah, you're not trying to be perfect. You're just trying to be consistent. And consistency comes from following a system, and you'll be profitable over time through collecting that data, refining that system as well. So yeah, you get those inputs, you define the process, and you map it out. So I don't just take reversals. I have a checklist. I first identify if price is in a middle time frame range. I then wait for an alley candle to overextend for 20 minutes. And then I wait for it to come into 30 minutes into the hour, and then wait for a 1-minute type 3 shift. So these I define all the inputs here. So is it a range? Is it trend? The entry model, or, where in the range am I entering? What time? Is it 22, 37, 52 minutes into the hour? And then I use those inputs to put it into a process, which is a step-by-step process. If I see this, then I do this, which I can then just follow, and it makes trading a lot less stressful and easy. You have structure. Stress is like you're like a beam that's bent under pressure here, and the more pressure, pressure comes from risk. The higher the risk, the bigger the pressure, the more you're gonna break and crack. Having a structured system is like putting rebar in that stone beam, and so you'll be able to handle more pressure. The reason people can't scale their trading is because they don't have a defined system or structure, and so they break under pressure. You need to have a set system to scale. If you don't, you're always gonna be stuck. You might be able to make some money on a small account, but as soon as you start to increase risk, you start to add more pressure, you'll break under that pressure. You have no structure to fall back on. And the most important part of every system is the feedback loop. In the beginning, the system might not be profitable. That is amazing, great. The feedback will tell you what to change. Do I need different inputs, a different process to fix my outputs to have a better outcome? So journaling every single trade, tracking time, pair, entry model, every single little variable, reason for taking that trade, you want to track. Because how do you know what a good trade looks like if you don't define what good means? Does good mean taking it at a certain time? Does good mean taking it when it's ranging, not trending? Does good mean using a certain entry model? You need to actually have data to know that. You can't guess. You're just going to waste so much time if you try to guess. So yeah, this allows you to just find what works, do more of that. Find what doesn't work, do the opposite or less of that. It's That simple, pretty much. And so, yeah, I can have that, build that system. I can turn my trading plan into a process. So my daily NAS every single day, I hop on at around the second hour of Asia, around 20 minutes into the hour. I first define the middle time frame condition. Is it in a trend or a range? If it's in a trend, I do not trade. If it's in a range, okay, I'll wait for the hourly candle to open. Did price extend into high low of that range over 20 minutes? No. Okay, and then do not trade. Wait again. Yes. Okay, is price in an AOI? No, I won't trade. Yes. Okay. Does price have a type 3 shift 22 to 52 minutes into the hour? No, I won't trade. And then yes. Okay. Do we have a pullback to 50%? So do we have a fractal shift? Do we have my entry model? Again, no, I won't trade. Yes. So going into the markets, I'm never looking to take a trade. I'm never looking to catch a move in the market. I'm never looking to make money or be profitable. I'm only looking to make all my trades look the same. More often, I'm looking for reasons to not trade than to trade. And so that avoids me taking bad trades. Every single day, I'm looking for reasons to not trade. And so that just leaves the good trades that I know that are defined as well. So I'm not trying to be a profitable trader. I'm trying to be the most consistent trader doing what I know works. When you just focus on that, and when you have evidence to back up that this works, trading becomes a lot less stressful. You can actually detach yourself from the outcome and have confidence as well. So I have mapped out my full process, every single little thing, enter trade, stop loss, take profit, win, lose, journal, review, and then goes all the way back to the beginning where I repeat it again. So I've mapped out the process. That's how I can be consistent. Every single little step. I break down my trading into what, where, when, or what, where, how, when. And everything's defined as well. Not really, no more guessing. There's an important part to understand in your trading system though, because you might not know what you need to be doing, but you can't do it because it's too complicated. So you need to have a trading system that is simple. So you need it to be simple, so it's repeatable. For example, if you want to go to the gym, if you want to be consistent in the gym, or you want to be, consistently healthier, what's easier to consistently do? A 2-hour long workout with all these different exercises that you try to follow and is optimal, it is perfect, and you try to do that every single day, or you just go to the gym each day, you do how much work you feel like. It could be you do 30 minutes because you only have that amount of time, or you spend an hour or 2 hours on the weekend because you have more time, because during the week you might have limited time. And you might end up just not going to the gym for the whole week because you don't have the time. You don't have a full 2 hours to go to the gym. You only have maybe 45 minutes. And so most people think consistency is about doing the exact same things every single day. But consistency is about doing simple things and having flexibility around that. So one day I might do 30 minutes. The next day I might do an hour if I have more time. Exactly the same for eating healthy. It's easier to eat healthy when you just eat the same things at the same times every single day, because there's less decisions that you have to be making, less decision fatigue as well. So how can I do the same things at the same times every single day? And how can I do less and get more out of it? So yeah, you don't want to get to the point where you build a system, you define the inputs and your processes, your feedback, but then Monday comes, you sit down at the charts and you just still don't follow it. Most likely, this is because your environment is working against you. You can have the best strategy in the world. If you can't execute it, it doesn't matter. So you need to make sure your environment surrounding trading actually works for you, not against you. So your sleep schedule, your mental state, working on yourself, improving yourself, having a good, a distraction-free environment, trading at the right times, and having a good routine. The best thing you can do for your trading is to have a happy life, have a good state of being. The periods of time where I traded like shit was mostly because I kind of hated my life and I wanted to escape. And so I got into trading to I overtraded, I revenge traded to escape that. Or I took another trade to avoid boredom. Or, I thought trading was my way out of my shitty situation. And when you do that, you put so much pressure on yourself and you overtrade, you're too obsessed. And you're too attached to the outcome where you just ruin it for yourself. And so improving your own life, diversifying your mental capital, so having hobbies outside of trading,
When I first got funded after blowing 6 prop firm challenges, it was specifically because I was addicted to League of Legends. That is the sole reason I got funded, because I would take a trade, and then there was something that I wanted to do more than trading, which I didn't have that for like a full year prior. And so I'd just take my trade, I'd be done with it, win or lose, and I'd go play League of Legends, like because I wanted to do that more than trading. And that was the most enjoyable period of my trading career, because I was no longer forcing setups. I was no longer staring at charts for 5 hours. I was just doing high quality actions and then going and doing something else. So you need to diversify yourself, and improve your life in general. Like, it's going to make trading a lot easier. And so you need to keep the system as simple as possible. My current strategy works so well because it's so simple and it's so easy for me to execute. It's not the most profitable strategy, but it is the most consistent for me. And so the more you simplify, the easier it is to execute. The best way to improve your trading isn't through adding more in. Most people try to add more into anything to improve it. The best way to improve something is to remove all the shit that doesn't matter, to subtract. What doesn't matter? What is the 20% of my inputs that leads to 80% of the outputs, the outcomes, and just do that. So yeah. For me, I like meditation. I like journaling my thoughts, and reading. That helps me. But you just want to be in a good mental state prior to your trading as well. And the reason we want to limit the amount of variables as much as possible, I only trade reversals. I only trade them in ranges. I don't take any continuations at all. I don't trade any trends. I just do one thing around the same time on one asset. I only trade gold. That is my main pair. And the less I did, the more money I made. Simply because if you have two variables, you have one relationship. And in a system, it's not just about the individual variables, it's how they relate to each other. For example, taking a trade at a certain time in the hour is affected by the middle time frame condition for me, or the amount of volume there is. All these different little variables affect each other. So a certain entry model might be better on a certain pair, or a certain condition. And if you're trading all these different variables, they all affect each other and it'll just massively overwhelm you and confuse you. So if we go from 2 variables to 3, we go from 1 relationship to 3 relationships. So it massively increases the complexity. We go from 4 to 6, we go from 5 to 8, we go from 6 to 7. No, I don't even know how many fucking relationships we have there, but maybe more than 7. Definitely more than 7, because this was 8. I'm kind of retarded, but yeah. So the easiest way to improve your trading is not by adding things that adds in complexity. I could add things into my trading process that would make me more profitable, but it would make me less consistent, because it would make it harder to execute, and I'd make less money from that. I'm not trying to have the most profitable system. I'm trying to have the most consistent and easy to execute system that scales a lot easier over time as well. Because if there's 10 different steps in your strategy, there's 10 different points for you to make a mistake and fail. If there's only 3 steps, there's only 3 points for you to focus on and fail. And so it's a lot easier to not fail as well. So the hardest part of trading is never the strategy. It's not that hard to have a profitable strategy. The hardest part is always execution. And the number one thing that improves your execution is making the process simpler, making it easier to execute, simplicity. It's a lot easier to do 3 things than 10 things. It's a lot easier to remember 3 numbers than 10 numbers as well. So yeah, really important to keep it simple. That's kind of a breakdown of the system. I kind of just want to cover this as well. So trading systems are a bit different from strategies, and it's different from skill. So what actually makes traders profitable? Every profitable strategy or popular strategy system indicator gives you a perspective, a lens to view price action. So what I'll cover in technical analysis is a lens to view price action. There's no, holy grail in technical analysis. Trend lines, SMC, ICT, support and resistance, chart patterns, it's all a distraction from what is actually happening. You might actually realize that everyone kind of trades in the same way. They just have different names for things. And they all have the same thing in common. Pretty much everyone, apart from maybe order flow traders, just use basic market structure and candles. I mean, even order flow traders use market structure and candles. And so you can kind of get rid of most of this shit and just focus on actually what is the most important thing, which is market structure and candles, price action. We can, simplify our process quite a lot more. I don't trade patterns or really strategies like normal traders. Um, I trade based on my understanding of the market and trading the logic behind the pattern. A lot of people treat trading differently to any other skill, where people think you'll become profitable if you just memorize a certain pattern or strategy, which that just doesn't work, because every strategy fail, all strategies fail, including mine. My strategy fails as well when it is traded in the wrong condition. So if I'm trading my CBR, my reversal strategy in a trending condition, against that, it's going to fail. I'm going to lose money. And so a strategy doesn't make you profitable. You make the strategy profitable by applying it to the right condition. If you're taking breakout continuations, that's going to work amazing in a trend. But as soon as it's range bound and you try to take a breakout of the higher the range, you're probably just going to get stopped out. And so your skill as a trader is directly tied into your ability to identify the condition and adapt to it, to either not trade it or trade a certain different type of approach. And that's why I only trade one condition, using one strategy, which is reversals, in ranges as well. And so, yeah, trading is a lot like piano or a language. You think you'll become a good pianist by memorizing a song or watching someone else, else's hand movements. And you might be able to learn that song really well, but you don't know the notes, any music theory. You just know the hand placement. And you don't know how to actually read music or understand music theory. And like in trading, the market is kind of like the market kind of gives you a new sheet of music to play each day. And so you need to be able to understand how to read that music or read that market structure to then adapt and choose the right hand placements or the right strategy for that market conditions. You're never going to get there through memorization or collecting knowledge. You have to get there through understanding. So that's why we need to focus on implicit knowledge, practicing by doing, experience, teaching, group discussion. So you need to understand the basics of music theory, which we'll cover. I'm going to break down the basics of market structure, price action, candles, candle behavior in the technical analysis section. So you can read the music, of market structure and adapt and, play the right song. Or it's kind of like a language as well. Thinking you'll become fluent by memorizing a couple words in a certain language. Like, I'm a fluent Japanese speaker when I go to Japan. All I know is arigato gozaimasu, and that's the only thing I say. Or hi. Those, like, it's enough to get, it gets you pretty far, but you don't actually understand the language. You'll never be fluent by just memorizing words. You need to understand, grammar, phonetics, the basics, and the customs of that language to converse, like through actually just experiencing. And so you need to understand the language of the markets to be able to consistently make money through adapting to whatever their condition is, as well. So you already know enough to be a profitable trader. You just lack understanding. You don't have enough experience in, feedback, taking trades, journaling those trades, reviewing, and discussing that with other people. So getting better at identifying the logic behind the patterns, the why behind the what, made me a lot more profitable. And this kind of comes back into first principles thinking. And so you can't succeed by memorizing the answers at the back of the book. You actually have to understand the theory behind it, which we'll cover in the next sort of section as well. But yeah, so being able to identify, read market structure and identify the condition to adapt is the most important thing, because, like, all the patterns have kind of been automated. If it was purely like 100% mechanical, which my strategy is relatively mechanical, but it still relies on some discretion and intuition. You need to experience to build up that skill. So you need feedback. You need to practice by doing. That's why, like, all my students journal their trades and I give feedback on their trades, because they need that experience to actually learn and become a profitable trader. They can't just memorize it and become instantly profitable. It is a waste of time. You can't do it. Because, if it was 100% mechanical, why would someone sell it? You just code it and make money that way. Because it's not, you need the strategy doesn't make you profitable. You make the strategy profitable by applying it to the right condition, as well. So yet traders are still profitable. Why? Why are they still profitable if the strategy is 100% mechanical? I don't know if any of you guys have seen the Epstein video, where he talked about trading, how the best traders You ask them why they took that trade, and they can't really tell you. It was like some baseline intuition or feeling. But the thing is, as well, people over rely on intuition, over rely on feeling, um, and you don't just randomly look at the wall and I feel bullish, or I look at a dog and I feel bearish. At least you shouldn't. Maybe you're bit schizo, but you feel emotions for a reason. An emotion is in response to a stimulus. And so being able to identify what the stimulus is and what the emotion comes from that, and that actually how that ties into a positive or negative outcome is really important to improve your intuition, because it's not something magical. Like, you can have both good or bad intuition, but being able to understand, intuition in response to certain stimulus is really important. Um, so yeah, the system is good for pointing you in the right direction, but you need to get good at it. You need to improve your skill enough to make it work. So yeah, every popular system, strategy, indicator is just a perspective to learn price action. Everything is just based off price action, the movement of price. The only thing that matters is your skill to identify the right conditions and adapt, and building up that right intuition. So how you learn the only part of trading that makes non-mechanical trading work. How do you learn that? How do you actually learn the intuitive part? This is through that implicit learning, the learning through doing, and having an actual trading journal and a feedback process to refine that intuition, to give it the right feedback. Because your brain in trading is kind of like an algorithm, or like a bot, like you need to give it right feedback, give it the right information to train the model of your brain to trade well. And so not journaling every time you take a trade implies that every time you have an idea, have a learning, that you'll never forget it. So do you remember what you ate last Tuesday for lunch? Like, what did you eat last Tuesday for lunch? Do you remember that? No. So do you think you're going to remember every single little learning you have in trading? No, you need to write it down. You need to externalize it, because you're going to forget things. So yeah, most people think journaling is just about proving that something works, proving that you're profitable. Like, journaling isn't about proving that you're profitable. Journaling is about making you profitable, actually understanding why you're profitable, because it doesn't matter. Like, winning trades and not understanding why you won those trades is bad. Losing trades, understanding why you lost those trades is better, because you can actually learn, get feedback, and improve. Because you are the greatest strategy. You make the strategy work by applying it to the right conditions, by having the skill. So the only thing that matters is your skill, not your strategy. Your ability to learn, improve, and adapt is what will make you a profitable trader. Because a strategy is something that is fixed, which we'll cover. So we want to be, as traders, we want to be anti-fragile. Hopefully you've heard of Nassim Taleb. He was an options trader. Now he's an author. He wrote the book on anti-fragility, or black swans, and a lot of different books. But we want to be anti-fragile. What is fragile versus anti-fragile? Anti-fragility is about gaining from disorder. So when something goes wrong, how do we gain from that? And so think of strategy as fragile. When we're trading a strategy and we're solely reliant on that strategy and it fails, we take 5-10 losses. That means that the strategy is bad and it doesn't work. And so the strategy gets worse from disorder, from the negatives, from the downside. If we focus on our skill as a trader and we take 5-10 losses, that is good. We can gain from that disorder. Why? Because it sucks losing trades, but we can learn from that. It's flexible. It's not rigid like a strategy. Our skill is flexible, adapting to conditions, and we get better from disorder. So over time, if we gain from both positive and negative, we will always outperform something that is fragile and rigid. So we need some flexibility, some discretion, some intuition. It's kind of like being a tourist on a fixed schedule versus an adventurer that is just the goal is to experience. And so if those two people miss their bus, miss a train, or they get lost, the adventurer loves being lost, loves experiencing. The tourist panics and starts to cry. And it's like, oh, this is fucked. My vacation. As traders, it's all about profiting off uncertainty. So we need to how do we actually get better from when things go wrong. Be anti-fragile. And so that is all that skill. And so we want to focus on a skill, which is anti-fragile, where we get better, and not overly rely on a strategy which is fragile, and doesn't gain from disorder. So there's kind of three main parts. You have your strategy, which is your process. So this is your plan. This is your process. Your system is kind of like your trading journal, or like your environment, like the overarching. And then you have the feedback loop, which goes into your skill. So yeah, I guess like you have your plan, you have your journal. This is kind of like goes into your strategy, which is like the process. This is kind of like your process for the inputs. This is, you have your inputs, your feedback loops, your outputs, which ideally leads to the positive outcome. And so that feedback loop trains that skill, and refines the process, refines your strategy. So you need a system to improve your skill and improve your strategy through that feedback loop, as well. So yeah, that systems design kind of covered a lot. But it's the most important part. If you don't have a system, like a strategy won't make you profitable. A system will make you profitable though, because of that feedback loop. So you just need a better system. Your lack of discipline is a lack of clarity. Just do the exact same things every single. If you just do the same things, you get the same results. And so you want to make sure and figure out what are the right actions to take, to make it unreasonable that you would fail. So trading at random times from your phone while stressed without a routine, you will fail. You're just gambling. Every single trader I know that hasn't become profitable, it's simply because they either had no systems or bad systems. So, yeah, treat trading like a business, have standards of procedure, map your processes, have systems. That's how you scale over time, as well. And you stop guessing, you just do what you know works. It's a lot less stressful, a lot more enjoyable. You free up your mind to actually focus on executing, and you stop second guessing, as well. So yeah, defining everything, technical analysis, risk management, psychology, what, where, when do I want to trade, risk reward, win rate, all this sort of stuff. We want to define and systemize and get better. But yeah, so that's the trading system. Hopefully you have a better understanding about that. We'll then go into more detail about the trading plan and the trading journal in the next videos. Okay, so for a trading plan, it's pretty simple. This is probably the simplest part. In the description below this video, I've included the Notion template where you have the trading dashboard. We can just duplicate this into your own Notion. We just want to define what we're doing. So this is kind of going back to the previous, where we want to define the process. This is our strategy, our plan here, and make sure we're consistently following the process, as well with our strategy. Oh, sorry, with our plan. So this is kind of like a blueprint, or something that you can follow that is externalized. And so you're not just randomly taking actions. You're following a proven system, and trying to be consistent. This is external structure. So you're doing the same things at the same times. You're trying to remove as much uncertainty from your process, and minimize emotional or impulsive decisions. Because without a trading plan, you're just taking random actions. You're gambling, and doing random shit, as well. So with a trading plan, I think it is important to understand that don't worry about your trading plan being right in the beginning, because it'll evolve and iterate over time. The important thing is that we want to just be consistent first. So we want to standardize before we optimize. Make sure you're doing it consistently, following a consistent process before you try to optimize it and make it profitable. For example, if I want to get jacked, it doesn't matter if I do an amazing workout if I only do it once a month. I want to focus on being I want to consistently go to the gym first, get into the habit of going to the gym, and then optimize second. How can I have better workouts? So most people, in life, they're able to have a good workout, but they just don't do it consistently. So we want to optimize for consistency first, profitability second, because once we actually do the same actions, it's a lot easier to improve that over time, because we're already in the habit of doing that. So yeah, quantity of doing the same thing leads to quality. If you want to get good at something, you just do it a lot, and you get feedback and you learn over time. So we need to consistently do the same things to get good at that one thing. If you're constantly changing things, you're never gonna stick with something long enough to get good at it. You're always gonna kill that momentum. You switch to the next thing, switch to the next thing, right about as soon as you're getting good at it. Because no trading strategy, like every trading strategy has problems. There's no perfect trading strategy. Like you're always going to go through losing streaks, bit of drawdown. There's always going to be problems, and constantly switching, trying to avoid those problems, you're just wasting your time, and it's a big mistake. So it takes so much work, so many repetitions to get good at one thing, that it limits the amount of things that you can actually do. And if you're constantly changing things, you're never going to build up enough experience to be profitable with a strategy or with a system, a process. So stick to one thing for an extended period of time. Standardize before you optimize. So in our trading plan, we want to trade at the same times. Trade on the same pairs. I've traded gold for over 6 years, one pair, and I'm by far the most confident on that one pair as well. So we just want to pick one thing. Please just fucking pick one thing. Become, trading is very similar to League of Legends. Become a one-trick pony. I was hard stuck silver for quite a while. I started climbing when I just one trick to champion. I one tricked Rengar or Kane because trading is a game. Treat it like a one. It's a lot easier to climb in League of Legends when you're just playing one champion in one role. If you're playing lots of different types of champions and lots of different roles, you have to learn so much more stuff to climb and get better. So if you just do less, you'll get better because it takes so much work to just get good at one thing. And so just master that one thing. So constantly switching roles and champs just doesn't work. Master one champ for one role, master one asset at one time using one strategy, and you become so much better. So yeah, I only trade reversals. I'm pretty goated at them, not gonna lie. I've stopped trading continuations altogether, and I only trade gold from Asia session into London, because you don't get paid based on the quantity of your decisions. You get paid based on the quality of them. It's pretty simple as that. So you'll become more profitable by making all your trades look the same. So yeah, you'll become profitable when you make all your trades look the same. If you take consistent actions, you get consistent results. You're not trying to catch moves in the market. You're just trying to trade one repeatable setup as well. So it's kind of like in sports. Like when you play sport, are you constantly switching positions? No. You're most of the time switching, like playing one position for your whole career. Like I played number 8 in rugby for my whole career. I wasn't switching to winger, to halfback, or fucking prop. I stuck to one thing because that makes it so much easier when you're not changing shit. But with your trading plan as well, let's break it down. So how do we actually use our trading plan or set it up? You kind of just want to define all the different variables. So answer all these different questions. So like, when am I trading? Am I trading for one session, multiple sessions? How long am I trading each session? Your trading plan should answer all these little questions around what pair or market am I trading? How many different pairs at the same time? Or, what approach, what strategy? Am I scalping, day trading, swing trading? What time frames am I using? What strategy am I using? What are the entry models, direction, area of interest? What condition do I want to look for? Define all these things, answer all these questions. In the beginning, you won't know what the right answer is. Just pick one so you can define the variables, track them in your journal, and you'll learn over time what works and what doesn't. If you never stick to something, you'll never learn enough to understand or learn what works, learn what doesn't as well. So just define it. What am I trading? Where am I trading it? When am I trading it? So just answer those little steps as well. Because preparation, execution, evaluation, improving in the Notion. So you want to define, okay, when am I trading? What is the time here? What pairs am I trading? I trade gold. What is the process? So have a simple summary of your trading plan, like of your trading strategy. So for me, it would be like I would look for a middle time frame range as my step 1. Step 2 is wait for a 20-minute overextension. Step 3 is wait for my entry model. Step 4 is maybe look for some counter behavioral alignment. So have a step-by-step process that you can follow. Have what is your risk management process? how do I place my stop loss? How do I place my take profit as well? And you can have some like entry models here as well. Summaries of entry models, and then maybe some work-ons for you to improve, or a to-do list as well. So this as well, link below for this template. But yeah, so you just want to create a routine, something that you can just follow step by step. Because the more clearly you know what you're supposed to be doing, the easier it is to do it as well. Ideally, yeah, just focus on 1 or 2 trades per day. But a trading plan is all just about having a set of questions to answer. And the journal will tend to give you the answers to those questions, which we'll cover a bit later on as well. And please, 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 please make the trading plan easy to follow. Make your plan easy to follow. You shouldn't have 10 different steps that you need to check off before you can take a trade. You should have like 3 or 4. Less is more. So you can actually change the difficulty in trading. You can play on easy mode by having an easy strategy. So the biggest mistake traders make is that they try to create a strategy that is the most optimal and the most perfect. And so it's got 10 different confluences, 10 different setups, trade it at 5 different times. They're taking both continuations, reversals. I think, you should only take continuations, or you should only take reversals. You shouldn't do both. Specify. And so, yeah, they get to the point where they have this plan and they know that if they could just execute the strategy, they would be profitable. Like, you get to a point in trading where okay, if I just did what I needed to do, I'll be profitable. I kind of know what I need to do, but I know what I need to do. I just can't do it. Each day you go into your trading session trying to execute your strategy, but you always feel short. If you feel like you always feel short when you execute your trading strategy by a lot, it's not a problem with your discipline. Because if you know your strategy works, but you can't fucking execute it ever, it doesn't matter how good the strategy is. So you need to simplify it. You don't need the most profitable, you don't need the most optimal, perfect strategy. You need the strategy that you can consistently execute every single day, even when you're having a bad day. If you're hungover, you lack sleep that day, you can still execute it because it's easy. And so an okay strategy will always perform better than an extra. Sorry. An okay strategy will always perform better when it's well executed than a perfect strategy that is only executed well half the time. And so it's better to be consistently good than occasionally great. The best diet and gym program in the world doesn't work if you only stick to it half the time. So the goal is to be consistent first, optimal, profitable, perfect later on. So my goal in trading is not to have the most optimal, perfect strategy, is to have the one that is easiest and clearest to execute. For example, it's a lot easier to climb in League of Legends when you play Annie versus Azir. So playing easy champions makes it easier to climb. Simple as that. So trading got easy when they made the process simple and repeatable. So yeah. Also trade when the conditions are easy. You don't always have to trade. If it ever feels hard to find a setup, feels like you're forcing something, you need to put in a lot of effort to find a good trade, you should not be trading. When conditions are clear, it feels easy and effortless, that is when you should be trading. That's when you're most likely to win. And the less you trade, the more money you'll make. It's unrealistic to expect that you have a good setup every single day. Day trader does not mean trading every single day. So yeah, it's important to understand. So with your trading plan, standardize before you optimize, focus on consistency over profitability. Having an edge, having profitability comes over time. Like, it comes from time of doing the same things. So you need to collect data to make informed decisions on the same things. If you're constantly changing everything, you're never going to have enough data to make good decisions or have accurate feedback. So do the same things, make it simple. So remove options, remove steps to make it simple, make it easy, and just do the same thing. So it's simple as that. And just define all the variables and be consistent as possible with your trading plan. And you can, copy over this template, fill it out with your process as well. So that's trading plan. This is just so you're trying to follow this. You're trying to follow your trading plan. You're trying to be as consistent as possible. And then the trading journal is about tracking what you're doing. How well are you following your trading plan? And what can be improved in your trading plan, iterated over time. This is the feedback loop. So the trading plan is the process in the trading system. The trading journal is the feedback loop in the trading system. Okay, so now we're going to cover the trading journal. This is probably the most important part of trading because this is what your strategy, your system, and your skill will be based off. Trading is all about getting answers to these questions about when I should trade, what entry model, and all these sort of questions. If you want to get better at something, at anything, you first need to start with tracking it. You need to understand where you currently are in order to make sure you're heading in the right direction to get to where you want to go or the destination. Like trying to navigate a map, the first thing to do is find out where you are on that map. Because when you track something, it gets measured. When you measure something, it gets managed. And when you manage something, it gets improved. For example, losing weight. The best thing you can do when you're first trying to lose weight is to track, because it'll give you awareness, and subconsciously you'll take actions to improve the thing that you're measuring. There's been a lot of studies where people that just track their weight tend to start to lose weight without doing actually anything conscious, because they subconsciously take the right sort of actions that push them in the right direction. And this is the hard part of trading. Journaling your trades is fucking tedious. It's boring. I don't like doing it. And it's especially painful when you lose, because you have to confront that loss, embrace it, learn from it, dissect it. But holy shit, does this work better than anything else I've ever tried. It's the one thing that made me profitable and will continue to make me more profitable, continue to get me better and better results. But this is the hard part of trading. This is why 95% of traders fail, because they don't journal their trades, or they B, don't journal their trades correctly in insufficient detail. They don't actually understand how and why to journal. And so good journaling gives you good data, and good data makes it easy to answer tough questions. This is how you find what works. So this is exactly the way to find what works. Because that feedback loop, that is the part to improve. We need a big enough data set. We need more data points, like 10, 50, 100 trades, to actually figure out what works, what doesn't. Because trading is a game of probabilities. We can't trust the outcome of one trade. We have to look at the outcome over 100 trades and look at, if I take this entry model over 100 trades, does this improve my profits, or does it hurt, do the opposite of that? And so there's two main parts when you're journaling your trades. You have objective data. So this is data that can be defined and categorized. For example, the overextension times or the session time. This is very objective. Like, am I trading at the second hour or the third hour of Asia? This is collecting all these subjective data that can kind of be defined here. And so tracking the little variables, confluences, reasons, defining the middle time frame condition or the entry model, and like what sort of trades you're taking. This allows you to identify positive variables that lead you to win more, and negative variables that lead you to win less. So, for example, if I go into tracking, let's say condition, and I have a look at this variable here, and I say, okay, on average, I have around a 63% win rate here over 400 plus trades. If I put on volume, how does that affect it? So maybe just barely improves my win rate a little bit. If I trade counter trend, I have a lower win rate. So me trading counter to the trend negatively impacts my win rate. So I know not to do that. If I trade when it's ranging, 56% win rate. I guess this is for both continuations and reversals. But let's say if I trade within a trending range. Oh my God, look at that fucking win rate, 96%. Jesus Christ. These happen pretty less frequently, but if I'm trading like a pro trending range, like massive boost to my win rate. Or if I want to find, when is the best time for me to take reversals? Should I be taking like 20-minute reversals where I only have a 62% win rate? Or 30-minute reversals where I have a 80% win rate, 87% win rate. This can be like massively helpful for figuring out like what works, what doesn't. If I have DXY correlation, that improves my win rate as well. A big thing is so let's say I'm taking a buy into a high or a sell into a low, and that has a 40% win rate. So massively decreases my win rate. If I take a buy into a low, a sell into a high, I have an 89% win rate. So I can identify negative variables and do the opposite of that. I can either do like I can either avoid doing it, or I can do the opposite to identify positive variables and do more. Like this is so overpowered, and you'll understand why it's so overpowered. But this is how you improve. You just find what works, you do more of it. You find what doesn't work, and you just do less of it, or you do the opposite of that. And then that allows you to build at that edge over time and profit as well. You also have subjective data here, which I'll get it up. So for subjective data, this is kind of like the things that can't be easily defined. So this is like how you feel about this. So like if I look at this screenshot, so the subjective data in your journal are the screenshots. So when you're journaling your trades, you need to be adding screenshots of what the trade looks like before and after you took it. So I can look at this trade, I can look at the entry, and I can look at the market conditions. And this is like more subjective. I can't easily define this, but this might look like a good trade. Like I feel like this is a good trade. I can't really define why, but I have the screenshots tracking the subjective information, the screenshots of that. And this will be you'll be able to train intuition. You'll be able to look back at the past trades and say, okay, was this a good one? Was this a bad trade? Why or why not? And look for reasons behind the patterns to either, turn it into something that's more objective, and just, review it, refine, iterate. And so, this is the feedback loop. It allows you to actually learn and improve in trading. If you don't have feedback, this loop just doesn't work. As well. So how are you supposed to take profitable trades if you don't actually know what defines a profitable trade? You don't know when it happens, how it sets up, what condition, or what entry model it is. So how are you supposed to think in probabilities, like everyone tells you to do, if you don't actually understand the probabilities of your system? You don't understand your average win rate, your average risk reward, how different variables affect your win rate. Like I know if I trade in a certain condition, it will either help or hurt my win rate. I know if I take a certain type of entry model in a certain condition, it'll, the relationship between these two variables is, it will affect the probabilities. So it's very easy to think in probabilities when you actually understand the probabilities of your system through that data. And so when you attain a data-backed view of what a good trade looks like, trading becomes a lot easier. You're no longer guessing, you're just doing what you know works. And so you can lose and not care because you know it was the right decision. So DXY correlation increased my win rate by 17%. A type 3 shift increased my win rate by 16%. So I know these are the good sort of trades to be taking. And so win or lose, a big benefit of this is that every time I take a trade, win or lose, I gain. So I gain another data point. I gain another opportunity to learn what works so I can do more of it, or learn what doesn't work so I can do less of it. So I become anti-fragile. When things don't go wrong, when I go through a losing streak, that is an amazing opportunity to learn what I'm doing wrong, to either do the opposite or just do less of it. And so it's easy to disconnect from the outcome when you focus on a data collection mindset. So you're just focusing on the journal, collecting as much data as possible. Every single trade you take, you either win an opportunity to learn or you win profit. And learning is kind of more important because it compounds quicker over time and it will make you profitable. So it would be like, would it be unreasonable for you to not be profitable if you journaled 500 trades in detail? It would be unreasonable. If you journaled 500 trades and you lost the vast majority of those trades, in that data, you'd be able to find out what you were doing consistently and how to do the opposite of that. And so if you just had a 40% win rate on that system, if you did the opposite of what you're doing, you would have a 60% win rate. So iterative improvement, trading is a continuous learning process. Small refinements over time compound very quickly. And so use each trade, win or lose, as feedback for improvement. Journal those trades in as much detail as possible, collect as much data, and to iterate your trading plan based off the data and you reviewing it. And so you can test changes to avoid overcomplicating your strategy, or you might test something, you might try to do something new. It might result in worse outcomes. That's a good thing. You've learned what doesn't work. So you cannot do that. And journaling also provides awareness around your own actions. You might not even know that you're deviating from your plan until it comes time to journal. And you journal, you try to categorize all these little reasons for taking trade. And you realize, okay, I'm consistently entering too early, or not waiting for my entry model, or not even trading in the right condition that I thought it was. And so it provides awareness, and you can only change something, you can only improve if you're aware of it as well. So that awareness, self-regulation, ability to improve, thinking in probabilities. It also creates accountability. You're less likely to overtrade if you're journaling every single trade you take. You're not going to overtrade because having to journal 5 trades is fucking tedious, boring. I don't want to do that. So I'm not going to take 5 trades. I'm going to take 1 or 2. And so it kind of subconsciously improves the quality of the trades as well. And you understand the probabilities of a confluence. You actually know what works, know what doesn't. And engages your reticular activating system. So the brain's filtering system, it focuses on what you consider important. By tracking progress, your RAS starts prioritizing positive behaviors. So you set up your biology to work in your favor and not against it. And you start to decrease that fear of losing. The biggest thing that holds people back is the fear of losing. Either they fear losing money, or they fear being wrong. It hurts their ego. Those are the 2 main fears, and the fear of loss is 10 times worse than the actual loss. But when you journal your trades, you have that data collection mindset. It doesn't matter if you win or lose because every trade is a net gain. You always gain from each trade. It's a new data point. And win or lose, you always improve. It's a new opportunity to learn. And when you learn from every single trade, it becomes inevitable for you to be profitable because you just keep getting better over time. It makes it so much easier to focus on the right things, focusing on learning through journaling your trades. And this will fix 99% of your psychological problems because you don't lack discipline. You lack clarity over what actually works. Like you probably just don't know what works, and that's why you think you have a discipline problem. Because most people struggle with avoiding bad trades, but they haven't actually defined what a bad trade looks like. Is it a certain condition? Is it a certain time? Entry model. And so if you don't define what bad looks like, you will continue to take bad trades. Trading is a lot like you're in a competition and you're being scored on how well you pick out green M&Ms from a big bag of M&Ms. This is a shitty analogy. I'm not very good at analogies, but follow with me on this. How much discipline is required to pick out green M&Ms here? A little bit of discipline because I like M&Ms. I want to eat the whole bag. I didn't just want to have the green M&Ms, but not too much. It is really fucking easy to pick out the green M&Ms here because it's so clear. Like I can tell the difference between like I want this green one, I don't want the red one here. Because you know what decision, like what inputs lead to a good outcome over time. It's very clear how to win. If you're not clear on how to actually take profitable trades, what profitable trade looks like is defined as all the different variables, the probabilities behind it. It's like you're playing this game with a blindfold on, or you're just fucking colorblind, which sucks. And so you don't need more discipline. You need more clarity over what is green, what is red, what is blue, everything like that. So once you've defined exactly what a profit trade looks like, whenever it sets up, whenever you see it, you can just pick and choose it. You can pick, oh, that's my setup. I'll take it. Oh, and I'll, yummy. So, but most of you haven't actually defined exactly what a profit trade looks like. And so you're just randomly guessing, taking the path of least resistance. And you're just doing a less fun version of gambling. Go to the casino. It's a lot more fun. Get a bit drunk, get a bit boozy. So define what good and bad looks like as well. Track everything. All of your problems in trading can be solved by tracking the right things as well. Even the best sports teams track and watch back their games. So when I played rugby, I had statistics over how many tackles I made, how much I ran, like how many kilometers I ran per game, how many times I actually had the ball. So professional players, sports players track their process. Best league players review their replays, and journal. You can like track their CS and their kills and all that type of stuff. And so the best thing you can do in trading is to have a journal and also record your trading sessions, and you can review them. So you can watch the tape back, record your trading sessions with your face cam on, and you can review yourself trading, give you awareness over what you're doing right, wrong, and watch it back. Because I used to do that in rugby, did that in League of Legends. It makes it so much easier to improve and build awareness as well. But you need more clarity, always need more clarity as well. And so we're going to go through some more detailed shit as well. So I'm going fucking balls deep on journaling. It's the most important thing. So what is a confluence? A confluence is simply a reason for taking a trade. It affects the probability of a successful trade. Ideally, you want confluences that make you more likely to win, and do less of what doesn't work as well. Bit parched, but for example, time frame confluence, or market structure alignments, or an entry model such as a 1 minute type 3 shift. So these are all different confluences that have been categorized and journaled. And this can be a bit overwhelming in the beginning, trying to track all these different reasons, but over time you'll get better. This is a skill like trading, like any other skill. So this is why I tend to prioritize my confluences as well, because every single confluence has a different weighting. So me taking a 1 minute type 3 shift is more important than time frame alignment for me. Or me having DXY correlation is more important than having an AOY or a level. The most important confluence for me is like identifying a middle time frame range. And also level 2 of this is that these confluences affect each other. So certain confluences in certain conditions will do better than others. So in a range, I know buying into highs, selling into lows is more important than in a trend. So confluences also are condition specific. So being able to learn, understand, and prioritize different confluences in each different condition is an important skill to understand. That actually improves your skill as a trader and your ability to adapt to conditions. So you can only take a good trade if you know what factors, what aspects, variables make up a good trade as well. So, it's like, how do I make a good burger? What do I need? Certain meat, maybe like a Wagyu beef burger, or a certain type of bread. It needs to be cooked in a certain way. The process for that. Certain type of cheese. Maybe I want mozzarella or something else. So didn't find the ingredients that make up a tasty meal, the ingredients that make up a good trade. So understanding how each confluence affects the probability of a trade winning is integral to being able to think in probabilities and make informed right decisions as well. So yeah, we'll cover this a bit later, continuations versus reversals, but you also have what is a condition? So market conditions is like the prevailing state of the asset at the certain time. So it's kind of like, think of this as like just the highs and lows and how much you're correcting each previous move. So you have like trending markets where it's more directional, you're making higher highs and higher lows. You have very volatile markets here where you have like big ranges, or you have more like range bound markets where you're correcting the previous moves, or just low volume markets where you're barcoding, not going anywhere. And so being able to identify and adapt to these different conditions using the right sort of confluences in these conditions. So maybe in a trend, I'm looking for continuations or breakout entry models. In a range, I'm looking for more reversals or pullback entry models. It's kind of like every single day, the market gives you a different condition. And it's like, a trend is like a triangle. A range is like a circle. And you have like, you have a circle and a triangle in each hand. And it's like, it's a trend. Okay. If it's a trend, I'm going to use my continuation model and put it into the right hole. You don't want to put the triangle into the circle hole. You want to put it into the triangle hole. And so your confluences are like the things you put into the holes, and the condition is like the holes, if that makes sense. And so you want to make sure you're slotting in the right confluence, the right process, the right strategy to the right market condition. That is adapting, your strategy you make the strategy profitable by applying it to the right condition, if that makes sense. So yeah, only work when it's applied to the right conditions. So being able to understand different conditions, and understanding what works in different conditions as well is really important. Being able to understand that. Yeah. So I trade my intuition, emotions that are validated by data. So I trade both intuition and more mechanical systems. Like it's a combination of both, because every emotion happens for a reason. We talked about this. But breaking down a feeling of a trade into a confluence or reason to take that trade and track what parts of your intuition work best. My intuition works best when it's in a range or a trending range, not in a high volume trend. So I'm really good at taking reversals when there's DXY confluence, because different confluence, like the same confluence for different people can have different results because everyone has different understandings and intuition because they have different life experiences. So yeah. Feedback is like you're a quant, you're training a computer algo based off data, but you're training your brain. So you're training your biocomputer, your brain based off data and feedback. So training a trader's intuition is similar to training an algorithm as well. So once you define all the different confluences and conditions, we then want to collect data on those confluences and conditions. So what works, what doesn't in your trading, what to track as much as possible, as many details as possible, entry, exit time, market conditions, outcomes, and objective versus subjective data. We kind of talked about this. Objective is more quantitative, measurable. Win rate, risk reward, confluences. This is subjective data is more qualitative, based off feelings, confidence, intuition, emotional state. Track both as well, because it'll be important a bit later. Objective data, facts, feelings. We already talked about this. Subjective is just personal insights and emotions as well. Yeah. So we collect that data and then we analyze that data to find what works and what doesn't. So how do we analyze? Once we've collected that data, we can use objective metrics. So notion analysis. So I can look at my win rate as the prevailing factor. For example, I can look at how my entry relativity affects my win rate. So if I have an average win rate of 63% and I'm taking a buy in the middle of the range or the upper half of the range and it massively increases my win rate, I should be doing more of that. So that's how I can analyze and see how different times of day affects my win rate. So I shouldn't be trading the first hour of Asia, for example. I should be trading the second hour of Asia. So you can see how these individual confluences affect the outcome. I can also look at how individual pairs, if I'm trading gold at the second half of Asia, and I'm should I be using DXY? Does DXY improves my win rate at that time as well. And I can look at all these different things. Like if I'm trading a low time frame reversal, is it best if I trade it within a trend, or vice versa? Probably need to remove some things from this, but yeah. So I can look at all those different things. Let me get this back. So I can look at my win rates to try to improve my win rates through looking at different variables. And I can also look at how to improve my risk reward. The main way to improve your risk reward is through tracking your MFE. So hold up, MFE. So this is kind of like, let's say for this, I have a 1-to-1 risk reward here. I have a 1-to-1 risk reward. But price goes further in my direction here, and it goes onto a 1-to-1.6. In my journal here, I could put for MFE, I could put 1.6, and my risk reward, my outcome is a 1. So 1-to-1, this is a 1.6. And I can look at the average MFE, the average max favorable excursion. So how on average, how far does it go in my favor? In general, not taking profit, but in the next 30 minutes. So am I consistently closing my trades early before they go in my favor as well? And I can also filter by MFE and see, okay, if I have how often does it go into a 1.9 or 1.5 as well? It can be very helpful. So that's how I can track and improve my risk reward. I can also filter by different confluences and see how that affects my average MFE or just my average R multiple return to improve both risk reward and win rate. So I can either win more often or win a bit bigger, or a combination of both. If I can win a bit bigger whilst keeping the same win rate, that is good as well. And so we just want to improve our expectancy, build our edge, which we'll cover as well. We can also upload our Notion dashboard our Notion journal into ChatGPT and have AI analyze it. We can ask it questions. So we can export it to Excel, put it into ChatGPT. We can get it to visualize that data and ask it questions around like, what's the best time to trade? How does this confluence affect my profitability at this time and stuff like that? It's very helpful. And I actually used that to do this. So I used it to visualize this data around reversal timing. For subjective analysis, we can go filter. I can go through and filter by all my wins, look at the commonalities between all my winners and say, okay, they all have this thing in common. Or I can like filter by all my losses here in the journal and say, okay, they all have this thing in common. So if I say does not contain winners, so I can go through all my losses, look at all the screenshots, look at everything they have in common. Or I can get screenshots of all my trades. Let me see if I can find this real quick. Okay, so I can look at screenshots of all my trades. Like I can take screenshots of all the entries and say, okay, like I have all these winners here, and I have like some losers as well. What is the difference between the winners and the losers? This is more subjective analysis. I'm just looking at the screenshots and say, okay, the extension, all these trades have like very clear extensions without a pullback here. So all these trades have very clear extensions. Look at these: extension here, extension here, extension here, extension here, and extension here. But on this one loss here, what is the difference on this one like loss right here? We have this price action. Yeah, we have this tight low volume range, and we created into 50% of this tight low volume range here, and we don't have this on all these other trades. And so in the future, maybe this is a learning for me, is that when we have this low volume range, like in the middle of this extension, I should actually just target 50% of this extension here. It kind of like interrupts this extension, makes it lower probability here. So I shouldn't be looking to target 50% of this overall extension. So there's a very clear difference between this loss and all these other wins. And so that's how I can use that subjective analysis to learn and improve as well. So yeah. So combining objective and subjective data information is the key to consistency. You want to also, like, you might have a certain feeling that when I take trades at this time, I have better results. You don't want to ignore your intuition, your feelings around that. Ideally, you want to like, okay, I feel like this entry model gives me better results. And then you want to look for evidence in your data to back that up. So you want to combine subjective feeling and objective data to make informed decisions as well. So, and like your trading plan is just your hypothesis, and you just test it and collect data. And so like if I trade continuations in the first 15 minutes, what win rate will I have? Do I expect to have a 70% win rate? And you just test it over 50 to 100 trades. And you can also make small adjustments and refine over time and measure the impacts. Just don't change too many things at the same time. Change one thing at a time and measure the impact. It's like a science experiment again. And you'll be able to see, matching confluences to market conditions as well. And like, categorize different conditions, all this type of stuff. Don't over refine. You don't want to curve fit. So a big mistake people make in their refinement of their strategy is that they over refine their approach to be overly restrictive. So they just don't take any trades, or they just, focus. They're no longer adapting to conditions. They're just overly focusing on one thing. So you want to start broad and then maybe, slowly refine over time as well. And you can get caught up in some bias or some noise. So with data, like any data in general, in trading, because it's based on probabilities, there'll be both noise and bias that can significantly impact your data collection and analysis, leading to flawed strategies or inconsistent results over time. Understanding these concepts can definitely help you clean up your data. So we have accurate data, we have biased data. So it's the data is all in the same sort of circle, but it's off center. We can have noisy data, and then we can have biased and noisy. So it's just like, how close of the data points are they together? And then the data is like how inaccurate is like the bias as well. So bias is kind of systematic errors, like overly focusing on one confluence and disregarding everything else. So when a lot of people have like good results in the beginning with the strategy, and then they kind of learn what works, and then they overly focus on one part of that strategy. So I figure out that me trading a certain condition gets me better results when I use a certain strategy. And so I know that it works. And then the problem is that I over focus on trading that condition. So my trade quality decreases because I'm no longer looking for my 3-step process. I might just be looking for one step of it because the data tells me that trading at this time or trading this entry model gives me such better results. But when you overly focus on that one thing, you over bias, that actually decrease. Like that's why people go through then losing streaks after starting a new strategy. But then there's also noise where you could take 10 trades, lose 5 or 6, even when you have like a 60% win rate as well. So random errors, inconsistencies. So just understanding this as well, noise, measurement noise, emotional noise, sampling noise. So being able to understand that the best way to reduce noise is to increase your sampling size and take more trades and be more consistent with your trades as well. So be mindful of selection bias, hindsight bias as well with collecting data, confirmation bias, survivorship bias, sampling bias, and all these different biases to try to avoid that. This is why data collected in real live market conditions is the highest quality data as well. So yeah, you don't want too many rules. You don't want too few rules as well. So over versus under refinement. You want to be adaptable, but you don't want to be too flexible. So don't curve fit as well. Avoid curve fitting. Yeah. So if you over refine, you'll lack setups. If you under refine, there'll be too high frequency of setups, but too low quality. A good frequency of trades is like around 4 a week. Or you can very easily find 1 or 2 setups per day with a good system. But yeah. In order to find the right amount of refinement, you kind of have to bounce in between over and under refinement. So it's a learning process, improving over time. But yeah. Okay, a big thing about collecting data, analyzing data in your journal is to reverse engineer. So how do you use losses? How do you become anti-fragile? Use losses in your trading data and reverse engineer them. Reverse engineer losing trades into winning trades. Because losing is an essential part of the learning process. Instead of fearing them, how can you benefit from them? So how can we extract those valuable insights into a step-by-step process, and reverse engineer that? So we want to identify commonalities between the losses. So if I take trades at a certain time and it leads to a lower win rate, I can just avoid that time. So losses tend to happen at certain times of the day or certain conditions, entry models, and the losses clustered around specific news events or sessions as well. And the easiest way to find what works is just to find what doesn't work and then do the opposite. The easiest way to be smart is just to not be stupid. It's a lot harder to be smart than it is to just avoid being stupid. So again, avoiding failure or succeeding something through just avoiding failure. So identifying what doesn't work, you can refine your trading plan and focus on what does. So stop trading at times where it doesn't work or do the opposite of what you have been doing. For example, I found over my data here. So when I'm trading continuations, so lower time frame continuations, and this is broken down by 10-minute intervals. I found for when I'm looking for a continuation, in the first 0 to 10 minutes of the hour, I had a high win rate. So 66% of the time I won trading continuations in the first 10 minutes of the hour. But as soon as we kind of approached later half of the hour, around 30, 45, maybe even 10 minutes as well. But around the sort of halfway point of the hour, I had a lower win rate trading continuations. Okay, interesting. What if I do the opposite? What is the opposite of continuations? Reversals. So if I'm taking lower time frame reversals, broken down by 10-minute intervals in the hour, around 20 to 30 minutes into the hour for reversals, I have a much higher win rate. So this is kind of the opposite of continuations. So finding out like this is like a bad thing. This is a problem. I'm losing more often at this time. but there's also an opportunity to improve. Like I suck at this. Okay, if I do the opposite, I'm amazing at this. So learning what doesn't work is extremely important to find out what does, because it'll tell you to like how to do the opposite of that. So around 20 to 30 minutes into the hour, I have around a 70% win rate. So I'm more profitable with reversals at this time than continuations at the best time. And with reversals, I definitely should not be trading around the open. Not a good idea. So massive sort of learning, and this is what my current strategy is based off. Reversals around 30 minutes into the hour, and it's made me over $1.3 million in the last year trading, because I failed at taking continuations around the halfway point of the hour, which led me to find what does work. So failing, losing, figuring out why, and then trying to do the opposite, reverse engineering it, is the best way to improve. It's the easiest. This is kind of like the learning curve is kind of you get worse and then you compound over time. You need to find what doesn't work here, so you can do the opposite to learn what does work as well. So we've covered quite a lot in the trading journal. We'll then go over in the next video how to build an edge, how to use the trading journal, like more specifically. But this is kind of the most important parts of the system and trading in general. Okay, so now we're going to talk about how to actually build an edge. This is one of the most important parts as we go back to earlier on in the course. The first thing we need to have is define a profitable trade using data. So we need to have an edge to avoid losing too often. That is the big way to fail that we need to avoid. So how do we edge in the right way? Or what is edging? Sorry, wrong video. How do we build the right sort of edge? And what is the right method to build an edge? So there's two ways that people try to find an edge in trading. There's the first way, which is what the majority of traders do. It is a fragile approach. So they just hope. So they watch a bunch of videos. They hope to stumble across something that works through guessing. Hoping that I'll stumble across the strategy that will just work, and it will just fix all my problems. So watching YouTube, copying other traders, jumping between systems, strategies, and all that type of stuff. This fails simply because it relies on luck and not building skill. There's no understanding of why a strategy works. You have enough information. There's so much information out there. You don't lack information on what works. You lack understanding on why it works. And every time you lose on a strategy, it destroys your confidence. Okay, this is not working, and you jump to something else. And you're never learning from those losses. And you can never adapt and diagnose those issues. So that's why it's fragile. If win rate drops, strategy appears broken, and you'll switch to something else after a string of losses. And performance is completely dependent on luck, not skill. It doesn't improve over time. It, in fact, gets worse over time as well, because you can't adapt or diagnose problems because you don't understand why problems happen and you can't fix them. So when losses happen, everything collapses and fucking the world ends. What is the better approach? So building an edge, you're not trying to find an edge, you're trying to build an edge through data. This is the anti-fragile approach. Every time you lose, you get an opportunity to learn if you journal it correctly. So you're not relying overly on YouTube videos to and theory to have a profitable edge. You build understanding through experience, not knowledge and information. So you test ideas using the scientific method. So you have a hypothesis. If I take a trade at this time, will it be better or worse? Or if I use this sort of entry model, will it improve my win rate? And then you test it with data. You track all the variables, you measure it, and then you see what happens. And you can just do more of what works, less of what doesn't. And there's a clear connection between inputs and outputs. You understand why something works by tracking all the different variables as well. So every time you lose, why is it anti-fragile? You gain more data, more refinement, more opportunities to learn. Every loss improves clarity and makes you better. So it's impossible to not get better over time with this. So you actually understand the probabilities underlying your system. So that's a big thing. People tell you to think in probabilities, but they don't tell you how. You can only do that through actually collecting the data, understanding the probabilities. And you know what to expect, what is variance versus what is genuine failure. Because you will go through losing streaks, but you need to understand like what amount of losses should I expect and is acceptable. most people should expect to have 4 losses in a row, and that should be acceptable to them. So when losses happen, you get better. That is the anti-fragile approach as well. So those are the two sort of methods. We're going to be focusing on method number 1. I wasted so much time trying to build an edge or have profitability through watching YouTube videos and watching what other people were doing. And a lot of people try to improve their understanding of the markets by watching videos and watching what other people are doing. That doesn't work. You're just collecting more information. If you want understanding, if you want to reduce your confusion, you need to take more action, and you need to fail and make mistakes and learn from mistakes, track data, and iterate over time. Understanding comes through action, not watching videos. So please, all this information in these videos doesn't matter if you don't take action on them. So the easiest way to build an edge using the second method, because it sounds kind of daunting, the scientific method and data collection. But the easiest way is to pick one simple strategy in the beginning. So this is going to be step by step. We want to pick one simple strategy. We want to use a fixed 1-to-1 risk to reward. And we want to set and forget. We do not manage your trades. That is you overcomplicating the data, overcomplicating the process, and you're going to mess with the data. In a science experiment, there's controlled variables, and you have a control group and all this sort of shit. But we want to keep as many variables as controlled as possible. So setting and forgetting adds in another variable. It complicates the process, and so we just want to keep it fixed. Like we also want to keep our risk reward fixed as well, because we're not trying to be profitable now. We're trying to learn and collect data first to be profitable later. If you're constantly focusing on being profitable, you're never going to become profitable. It's just going to run further away from you. So with a 1-to-1 fixed risk reward, we should have around a 50% win rate on average. So if we were just to flip a coin and take a buy or sell with a 1-to-1, and we did that 1,000 times, we should have around a 50% win rate, and it'd be around break even. It could be a bit less, a tiny bit less for spread, but around 50%. Just pure randomness, you should have that sort of win rate. And then we want to take 100 trades. So this is sort of the tedious, this is the hard part of the process. You want to take 100 trades for testing. So trading on either a demo or a small account that has risk that you don't really care if you lose money. So we're trying to fail. We're trying to make mistakes. We're trying to learn what does and doesn't work. So we want, it's good for there to be risk, but we don't want too high of a risk. We want acceptable risk to learn and improve. And so I would recommend a small prop firm account with smaller risk. So it depends. If you're doing a Forex prop firm account, you could use 0.5 to 1% risk. If you're using a futures prop firm account, I do around 0.5% risk. The goal isn't to pass this account, it's to collect data and learn from those trades. I would try to avoid doing it all on a demo account because it's just not the same, really. It's just not the same on a demo account. There's no attachment to the outcome. So you can do a little bit here, a little bit on a demo account, but I'll try to progress to a small prop firm account. It could be a 5K prop firm account, but progress to this as soon as possible, really, as well. And you can also do some backtesting. Backtesting is good for quantity of data, but it's very low quality. Backtesting is completely different to live trading. And yes, it's helpful for pure technical analysis, but it's very different. And my backtesting results, most people's backtesting results always greatly differed from their live trading results. And it was kind of almost a waste of time. But mainly for testing on a small prop firm account in the weekday. If you want to do some backtesting on the weekends, you can do it using FX Replay. You still want to journal these trades in the Notion journal when you backtest. Makes it even more tedious and boring, but that's how you actually learn from this as well. So for testing, backtesting, and you want to journal every single trade in as much detail as possible. So we want to use the Notion to track every single little variable. So track, what trades are you taking, when are you taking them, how are you entering, what is the timing, tracking the R multiple outcome here, and there's the free journal template that you can track as well. So we want to track every single variable here, and there are 3 possible outcomes over these 100 trades. So the first outcome is that you have a less than 50% win rate. which is amazing. Great. Ideally, you want this to be as low as possible with a one-to-one risk reward. So let's say this is like a 30% win rate at the end of those 100 trades. You fucking suck, but that's great that you suck. We can reverse engineer and flip this into a 70% win rate system. So kind of going back to the example that I talked about in the trade journal section around continuation versus reversals in the timing in the hour, because the easiest way to find your best setups is to first try to find your worst setups through data. So I could reverse engineer that. Why did this suck so much? So I could do the opposite, because it's kind of easy to find good ones and bad ones. Again, lower win rate in the second half. Lower win rate in the second half of the hour. Higher win rate in the first 10 minutes of the hour on continuations. And then for reversals, lower win rate in the first 0 to 10 minutes of the hour. Higher win rate, very high win rate around 20 to 30 minutes into the hour. So I just focused on reversals now around 30 minutes into the hour. And I could only do that. I only found this out because I realized that, I fucking suck at trading continuations around the halfway point of the hour. What if I just did the opposite? Okay, this is amazing here. So doing the opposite is underrated. Inversion, like the inversion principle. So find all the ways to fail and then just do the opposite of that and you'll succeed. So we'll go back to that. So reverse engineering, flipping that. I've kind of covered this example, but if I'm buying into highs, selling to lows, I have a 40% win rate. If I do the opposite of that, buying to lows, selling to highs, I have an 89% win rate. And there's lots of other examples, that I can find in my journal and filter through and have a look at everything as well. But it's pretty easy to figure out what is going wrong if you track your data correctly and find the commonalities between the losses, similarities between the winners, and do more what works, less of what doesn't. And then the second possible outcome is that you end with a 50% win rate here. And when we end with this around break even, this is the part where we can analyze and refine our system, or like analyze our data and see, okay, out of those 50 winners, what do they all have in common? Out of those 50 losers, what do they all have in common? And you can, find, how to either win more, win bigger, lose less, have smaller losses, or have a better entries. And so there's a couple of different ways we can go about doing that. I'll just get this set up. Okay. So in the Notion journal, there's 4 different ways we can improve our trading strategy. We can either look for ways to improve our win rate here. And so kind of going back to this, the reason we want to have a one-to-one fixed risk reward, because the risk reward will affect the win rate on average. So I think it's better in the beginning to have a fixed risk reward. It's boring, but it will help. Okay, what if I want to improve my risk reward in the future? We'll cover that. So the main sort of things that we're tracking is the R outcome of a trade. So what is the outcome? Do I win 1.2 times my risk or 2.5 times my risk? Do I lose 1 times my risk? Do I lose less than I initially risked, like 0.8 of my risk? And so there's a couple different ways we can actually analyze and improve our system here. So if I get this up as well. So first off, we want to be tracking MAE and FAE. So MAE is max adverse excursion. MFE is max favorable excursion. So for example here, if I take a trade like this and it's a 1-to-1 trade here, the max adverse excursion on this trade is how far it went against me. So I'll just get this up. Okay. So it's how far it went against me. I can find out my MAE. If I just get this up here. So I just get up the inverse of this tool. I have it set to 1-to-1. And I can see, okay, it went 0.63 times against me. So it went 0.63 towards my stop loss. So it went 0.63 R against me. In the journal, wrong journal. In this journal, I'll track it as going negative 0.63 against me. For my MFE, I just track it over 30 minutes here. And I'll have a look and see, okay, over the next 30 minutes, because I'm not looking to hold for the rest of the day, I closed it at a 1-to-1. So in the R multiple outcome, I'd have it as like a 1-to-1 here. I put it as a 1. But the MFE for this trade here, okay, how far did we go to? We went to a 2.8. So in MFE, I would put a 2.8 here. So I'd put a 1 here, a 2.8 here, and a 0.63, negative 0.63 here. And so the MAE is like, okay, does it keep on going against me prior to it going in my favor on these winners? So I can filter by wins and look at my MAE. This is kind of like your opportunity to improve your entries, getting a better entry. So entering, not entering and then going against you and then in your favor. Or maybe you keep getting stopped out before it goes in your favor. MAE will capture this and track it. Maybe you get a perfect entry or on a breakout and there's no MAE. But then MFE is tracking your max favorable excursion, your max risk reward of that trade over the next 30 minutes for me as I'm scalping. And so I can see, in general on my wins and my losses as well, how far it goes in my favor before it either stops me out here, before it either stops me out for a loss, or how far it goes after I take my win here. And so this is how I identify, what risk reward I should be targeting. And so what is the average on my winners? What is the average on my losers? Or like in general, what is the average over my trades that if I was to target would not negatively affect my win rate that much, and I'd massively increase my risk reward. This is why we don't want to target like big risk rewards in the beginning or variations of that. It's easy if you just keep it the same, keep it very simple. Target a 1-to-1 in the beginning. You can always change it in the future, but you're tracking your risk reward by using MFE to track the max favorable excursion. And this is how you actually identify what is the best risk reward for you and your system as well. So we can filter by different variables as well. We can see like, okay, if I'm using, gold spread correlation, does it improve my MFE, MAE, stuff like that? Or does it improve my win rate? So the main two things you're kind of focusing on are, does it improve my MFE, which will allow me to win bigger, or does it improve my win rate, which will allow me to win more? And so you avoid losing too big or losing too often as another sort of viewpoint as well. So that's how you analyze and review your system, tracking different variables, and how they affect your approach. If a certain CB day improves my win rate as well. But yeah, so it's very easy to play around and have a look and see how different, even maybe different days affect your win rate, or different positions, stuff like that, or CBOEs, like having a 50-minute CBOE versus an hourly CBOE as well, and all these types of stuff, how they affect your win rate and your MFE. So very helpful for improvement, and getting this you either improve this win rate so it's around 60% with a 1-to-1, or you just increase the risk reward to maybe a 1.5 with a 50% win rate and you're profitable. So there's two ways to improve on that. Or you can get better, but maybe losing a little bit less, or getting a better entry, which will improve your risk reward. If you end those 100 trades with a above 50% win rate, you just keep doing what you're doing, and maybe you refine a little bit, doing the exact same things that we talked about, filtering by variables to improve your win rate, or MFE, choosing the MFE that makes sense the most. And you can like export this into an Excel spreadsheet, put it into AI to ask questions like, what is my average MFE over all these trades, or what should I be targeting on, and all this type of stuff as well. So that will lead to improvement. And this is just one iteration cycle. So I've done 100 trades, I refined it. So now I've reverse engineered this. I started off with a losing strategy. I reverse engineered this into a new plan. And then I take another 100 trades. So I do this again. I take another 100 trades and I forward test, maybe on a small prop firm account. I journal every single trade with a new sort of approach. Maybe I've changed some things, taking it at a different time, or using different concepts. And then again, I have those possible outcomes. Maybe now I have around a break-even approach. here. And then I do that again. And maybe I have a, now it's 50% above. So maybe it's around like 60% now, 60% where they want to on risk reward. I go through the improvement cycle again. That gets up to a 55%, or sorry, a 65% win rate. So, that's how you just gradually improve over time. You refine, iterate, using, this sort of method. And so you take trades, you journal those trades, you review them, and then you iterate. The thing is, you don't want to be constantly changing things. You want to, maybe take 50, 100 trades, and then you want to review that data set, and then you want to draw conclusions from that to then iterate and make one or two changes. Like, don't try to train. You're not trying to change as many things as possible. You're trying to change the one or two most important things. So it could be an entry model, or a time, or focusing on a specific market condition or pair. You just do one or two changes, and then you go again for another 100 trades. This is tedious. It's boring. This is the hard part of trading. You're not going to want to do this, but this is where pretty much all your improvement will come from as well. It'll give you understanding and experience. And so if you just do that, you will have an edge over time. It's impossible to not have that, because regardless of what happens when you journal your trades, you will learn and improve. Even if you fucking lose and you suck, which is important. It's part of the process. You need to suck. You need to be bad at something before you're good at something. Don't try to avoid that. If you do, you will fail over the long term. And so, yeah, that's how you build an edge. We'll go through next the different confluences, technical analysis as well. Okay, so now we're going to break down technical analysis. These are the confluences that we're going to use, kind of like the building blocks that we utilize to build our edge. So when we're trying to track the different variables, track the different market conditions, we first need to have the skill of identifying those variables and identifying those market conditions. So when we use technical analysis in trading, there's two main parts that I mainly focus on. So firstly, I'm a price action trader. I really focus on price action. I think everything else is just a distraction. So what is price action? Price action is just the rawest form of information. So it's the movement of a financial asset's price over time, as displayed on charts. So candles and market structure are the two main ways that price action can be broken down into. You can also use other things like volume as another sort of information source, but I mainly focus on the first two. This is a lot better than relying on indicators such as MACD or RSI, all this other shit, as it's lagging and it's just the same information but put in a different way. So yeah, it's real time. There's no lagging indicators. It's the simplest form of technical analysis because it just focuses on the pure fundamentals, the market structure, candle behavior, and it's extremely versatile. You can use it across all markets, all times. And price action is all about understanding the psychology of the market participants. So as traders, we are looking to trade patterns in the market, but where do those patterns come from? So in general, the markets are still moved primarily by humans. Big institutions, trading desks. Yes, you do have high frequency trading, but there's still a big part of the market is human. And humans tend to act in the same ways in the same periods of time. So we are habitual creatures. We tend to do the same things at the same times, think and feel the same things as well at the same times. And so as a trader, we're just trying to capitalize on the patterns in human behavior. This is why I look to take the same trades at around the same times each day, because I'm trying to capitalize off patterns in human behavior, which is represented in patterns in the market as well. So yeah, that is the fundamentals of price action. So market structure is just highs and lows, and then candle behavior is time-based market structure. So every high time frame candle is just made up of low time frame market structure or lower time frame candles. And these two things both can be used in similar ways, but they answer different questions. Market structure answers what type of trade are we taking, continuation, reversal, buy or sell, direction and condition. It'll answer where we want to enter on the charts, what price we want to enter within market structure, and how do we want to get towards that point as well. So it answers those kind of questions. Candle behavior specifically answers when. So when do I want to take an entry? When do I expect this price action or this market structure to play out? Or how long do I expect for this to continue for? And so candle behavior gives timing to market structure. It's just how a candle moves at the life cycle of a candle. And if a high time frame candle is low time frame is a simplified time-based version of low time frame market structure, we just get here. So, um, you know, for example, 3 candles, a push to the upside. So you push up to the upside here, you consolidate, and then you push back down. Maybe you even close bearish here. It can result in a just simplified version of that, which is a bearish candle, and vice versa. And so candles allow us to anchor ourselves in time. So looking at a daily candle and looking at where we are within the day, or where we are within the session, or a 4-hour candle can be helpful for timing as well. So those are the 2 core sort of factors that I use, the variables, which we can break down even further. And then I also keep in mind auction market theory. I don't use it how most people use it. I use it in sort of a different sort of way, but auction market theory just explains how price moves as well, similar to price action. How it's a constant auction between buyers and sellers. It goes a bit into order flow, but I don't want to overcomplicate things. But the market's job is just pretty simple. The market will try to find fair value. What buyers and sellers agree on what is fair value. And this is a core sort of understanding for me, is that price action is kind of like an elastic band. So auction market theory simplified is that price action is like an elastic band. The further you push in a certain direction, the more likely you are to have a correction. And so if you stretch in a certain direction, you tend to have a snapback or a pullback. Even if you look at the charts here, whenever we have a move, we pretty much always have at least a 50% pullback. It depends on the condition and if we're trending or not. But the bigger the stretch, more often than not, the bigger the pullback. And price never moves just in one direction for long. It's always a sequence of pushes and pulls. It's a wrestle between buyers and sellers, where we're trying to find fair value. We're imbalancing. We're in price discovery, and then we're correcting back into fair value. So yeah, my main sort of style of trading is that I just look for price to imbalance and then look to target back into rebalancing. And so as price seeks fair value, it's always trying to find fair value. If price pushes aggressively in one direction without pulling back, it becomes inefficient. Like an elastic band, it stretches, then eventually it will snap back to rebalance. And I don't try to guess direction or predict where the market's going. I just wait for it to stretch, to imbalance too much, and then look to capitalize on that little snapback. So I'm not predicting, I'm just reacting to what markets are showing me. And I found that a lot more consistent as well. But we'll cover that a bit later, specifically how I use that. And yeah, you don't really need to understand this. It's good for as a mental model, but a better sort of mental model is understanding that price is elastic. It's like an elastic band. And you don't, if you stretch, the further you stretch in a certain direction, the more you are to correct that within the condition as well. So those are sort of the basics: price action, candle behavior, a bit of auction market theory, order flow as well. Even more basics: every sort of candle is made up of 4 main things. You have the open, the close. So price opens here, you might create a low. So this is a low. We might push bullish again into creating a high, and then have a bit of pullback before the candle closes. So every candle has a open, close, high, or low. And these are, it's a simplified version of how low time frame market structure moved throughout that candle. For example, where we can see, price action, the 1-minute market structure has opened, pushed bearish around the halfway point of this 15-minute candle here. We've pushed bullish, create a bit of a top wick here, and then we closed bullish with this bit of a bullish candle close with a little bit of a top wick and a pretty big bottom wick. Wicks are kind of like the rejection areas as well. But yeah, those are the basics. Price action is fractal as well. I talk about fractal price a bit differently from others. I don't really use time frames. I use something else, which we'll cover later on. But fractal price action really is that everything, every time frame moves in the exact same way. The type of price action, the type of patterns that occur on low time frames happen on higher time frames. And my trading heavily revolves around fractal price action, as it is the best way to align and give yourself high probabilities as well. So cover that. I have a lot to break down and cover, basic market structure, condition direction, airwise, entry models, candle behavior. So looking forward to getting into it. I'll catch you guys in the next video. Okay, so now we're going to cover market structure. This is probably one of the most important concepts to understand deeply and to prioritize in your learning. It is, very basic, but the basics tend to be the most important things to understand and master. Again, so market structure is just purely defined. It's highs and lows. So think of highs and lows. Are we making higher highs and higher lows? Are we bullish? Lower highs and low lows bearish? Breaks the structure, all these sort of things. Market structure helps us identify what is the direction, what is the market condition, and where we might want to enter within that. Really helpful for entries and specifically risk management, placing stop losses, take profit, entries, all these sort of things. And identifying if you're looking for, what type of trade are we looking for? Reversal, continuation, buy or sell. So it answers those sort of questions as well. So there's we'll go through some basics first. The difference between bullish and bearish market structure here. So bullish market structure is defined by higher highs and higher lows, obviously making, going from the bottom left to the top right of the screen. And we tend to have breaks of structure consistently to the upside, where we also respect lows as well. So that is a simplified version of bullish market structure. Bearish is just the opposite. We're making lower highs and lower lows. We have breaks of structure to the downside. Yeah, pretty simple. And reality might look something a bit more like this, where it's a bit messy and you don't have clean, pushes to the upside and pullbacks as well. You might have some low time frame structure in between the high time frame or the high time frame swing points or external highs and lows here. But in general, we're still making higher lows and higher highs here as well. And then for a basic example, the same thing, we're respecting highs and we're breaking lows as well. So that's a pretty simple definition of bullish versus bearish market structure. I mean, the easiest way to have a look at this is you can use the regression trend tool here. So regression trend tool, if I just draw over this sequence of market structure, I can very clearly see that this is going to the top right. So most likely that's going to be bullish here. Vice versa, if it's going to the bottom right, that's really bearish there. So pretty simple. And so easiest ways to identify direction is to use regression trend tools. This will be covered a bit later on, but there's a free indicator that you can use to help you simplify direction using some regression trends, and they're set over specific times, which will show you like low time frame, middle time frame, and higher time frame market structure and direction. So that indicator's on the WAP as well, and I'll put it below the links to some of the videos. But yeah. Direction is always constantly shifting through bullish or bearish across all different time frames. And so you can identify a change in direction or a shift in direction by identifying a change in highs and lows. So when we go from making higher highs and higher lows here, making higher highs and higher lows, to then breaking a high into immediately breaking a low, direction has shifted. So what we were once making higher highs, higher lows. Now we've made a lower low and a lower high, and we're now pushing bearish here. So this sequence into breaking a high here, breaking a high into then breaking a low, that shifts the direction to then create that, potentially create a lower high into then pushing bearish. And that is a bearish shift in direction. For a bullish shift, it's just the opposite, where it's looking to break the low into then breaking the high here. And then you're making a new sequence of what was once lower highs and lower lows. Now you're making higher highs and higher lows. Yeah. For a actual example of a change of direction, this is, we can see the external highs and lows of this sort of structure. And then we can see we have a break of structure to the downside here. So a break over this low into then price action coming in, or volume coming in, breaking this high here. indicating a shift in the direction where we have a pullback into then higher highs being formed here. So bullish market structure. So shifting from bearish to bullish after you take out a low and then take out a high. It's pretty simple. Change in direction is defined by change in highs and lows. And then internal versus external structure. So this is kind of referring to fractal price action. In between, we'll call this like a high time frame move here. When you have a higher time frame, bullish uptrend, you can have like, lower time frame uptrends within that sort of bullish trending range. And so we have a high time frame swing or push bullish here. And then once we take out this high, most likely we're going to have a pullback into then a correction. And on the lower time frame, what this will tend to look like is that you have a lower time frame shift of structure to then lower time frame shifting bullish. So low time frame was pushing bullish with the high time frame taking out the previous high time frame high or external high. You then have low time frame after it's taken out that high, correct or pull back, will then low time frame to push bullish again with that high time frame. And so we have internal structure within this external structure. So we have internal push bullish, we have an internal push bearish. And so everything in between the external highs and lows, this is all internal highs and lows. So you can have external breaks of structure here, and then you have internal breaks of structure here, where these aren't as significant. Internal breaks of structure are kind of signifying a lower time frame change in direction. So we can have a break of structure here. Doesn't mean high time frames overall bearish. We'd want to wait for a high time frame external low to be broken. So if we took out this low here, that would be more of a high time frame shift in direction. And you can even go even deeper, where you have a internal shift bullish that aligns with high time frame. Then on the internal pullback, you can have a smaller shift in direction as well. So you have external break of structure here, and you have internal break of structure here. And this is just kind of showing you we pushed bullish, took out the external high. The internal structure shifted bearish here, had a bit of a downtrend, and then we came into the lower half of this external push bullish, where we had internal structure then align with that high time frame, shift bullish, and continue that overall direction. For example, external highs and lows here, and then we have some internal structure shifts as well. So it's something to keep in mind. It's not the most important thing, but it's just helpful for aligning different directions of price action, different time frames. So low time frame, middle time frame, high time frame. And that kind of brings us into fractal market structure here. So fractal market structure is simply that the same patterns repeat off every different time frame. So price behaves in the same way on the 1 second, the 1 minute, and 15 minute. And so you can trade them all in the exact same way. The biggest mistake people make is this. They don't actually fully understand fractal price action. For me, I just simply do the same thing across all different durations of price action, and that massively boosts my win rate and my profitability. So if you zoom in and out, all structure looks the same. And so there is no best time frame. There's only the time frame that suits your style. So if you're looking for scalping, small little moves, you want to focus on lower time frames, maybe 1 minute, 5 seconds. If you're going for swing trades, maybe 4 hour daily would be a bit better as well. Most people think that the low time frame is just noise, and the lower you go, the more noise it gets. But this is simply because they're not good at understanding the difference between internal and external structure and connecting and aligning different time frames. They're not good at telling the difference between signal and noise on the low time frame. They don't understand when to take when to look at the low time frame as well, which will cover how to align fractal price action a bit later. So so you can have a shift within the shift. This kind of covers more fractal counter behavior, which we covered a bit earlier on. But for example, here you might have a high time frame, push bullish, then you have a pullback and another push bullish. What this will look like, you can have a middle time frame correction here, where this high time frame push bullish has a lower time frame or middle time frame, highs and lows. So you have a bearish downtrend on the middle time frame that makes up that high time frame push bullish, and then you might have a a lower time frame sort of bearish impulse, so low time frame has aligned with middle time frame, then it shifts, bullish, correcting that previous bearish move, coming into the upper half, and then continuing that. And you can have little shifts of low time frame, changing middle time frame, which then eventually changed higher time frame. So you can have shifts within shifts within shifts. For example, here, this bearish move overall, it was made up of lower time frame, highs and lows, lower highs and low lows when we're pushing bearish. Then on the pullback, we had a bit of a bullish trending range here. We're making high highs, high lows, which then we eventually took out some lows here. We had a bit of a shift bearish, which then that bearish downtrend started with lower highs and lower lows as well. And so when we look to align timeframes, we always want to start off with what is the overall move, and then where are we within that. So we can have the overall high time frame push bullish, middle time frame can shift bearish here. We can come into the lower half of this high time frame move, and then we can wait for middle time frame to shift in our favor, shift with that high time frame, and then that low time frame will probably pull back into then again do the same thing on just this middle time frame move. And we can wait for a low time frame to shift in our favor. So waiting for middle time frame to shift bullish, low time frame to shift bullish. Once that has happened here, all time frames have shifted in our favor, and these tend to be the highest quality setups that move furthest in our direction as well. And so these are sort of the basics of market structure. What is the difference between bullish versus bearish market structure, changes in direction, internal versus external structure, and fractional market structure. This is helpful for finding direction, answering that. Should I be looking for a buy? Should I be looking for a sell? But it doesn't tell you where exactly to enter. So, highs and lows tell you what direction to enter in. When you're trying to find where to enter, you don't want to enter too early. That's where we go figure that out in condition. So market conditions tells us where to enter. Direction tells us what type of trade we're taking, buy or sell. So we'll cover that in the next video as well. So condition versus direction, which is probably very, very important because if you're entering with the overall direction, but you're looking to take a buy after you've previously taken out a high, this is where, if you enter the wrong area within this move here, if you're looking for a buy here and you place your stop maybe around here, you'll just get stopped out before price goes in your favor. So if you keep getting stopped out before price action goes in your favor after you enter, it's likely because you don't understand market conditions well enough and where to enter within overall market structure and with the direction. Okay, so now we're going to cover market direction versus market condition. It's important to understand the difference between these two. And identifying the market condition is probably one of the most important skills to have, or it is the most important because, again, as we covered in systems design, every strategy fails when it's traded in the wrong condition. For example, if you're taking breakout trades in a really high volume trend where you're taking breakout at highs. So if it's really directional, you just keep on taking breakout at highs and you just take buys. You're gonna win all the time. But as soon as you try to do that in a range where you keep taking buys at highs in a range, you're just gonna get stopped out and it's gonna go against you and it's not gonna work. So identifying and adapting to the market condition is the most important skill to make the strategy work. If you trade the strategy, you can trade it right, profitable. You can trade it like a really good profitable strategy. But if you trade it in the wrong condition, it won't work. And this is why a lot of you guys, go through big losing streaks because you trade 1 week really well. You have great results, and then you try to do the exact same thing the next week, but the market condition has changed. And you feel like, what happened? It was going so well. Why does for some reason now trading feels really hard? Why am I losing more often? It's because you're not aware of the market condition and you're not correctly adapting to it. You can either not trade when it's bad or adapt when it's, to try to trade in a different way. And so your skill as a trader is directly tied into identifying the market condition. So again, direction is defined by highs and lows. Condition is defined by the size of the pullbacks or corrections or what is in between highs and lows. Market condition will tell you where price action is going. Market condition will tell you how it's going to get there, and where you want to enter on the in that direction. So direction is just whether you want to buy or sell, and then condition is where you want to buy or sell. And there's kind of three main conditions that I keep in mind. It's kind of like a scale, um, and it's pretty overlapping. In the middle, you have a range. So market direction is neither bearish or bullish. You're making equal highs and equal lows, very very range bound. And then you go into more of a trending range here, where you're making a bit of a directional range, and then you go into more of a bullish trend or bearish trend, where it's just really high volume, and you're just going to the top right or top left, bottom left, bottom right of the screen as well. So yeah, market direction is just the highs and lows. The market condition is kind of like the pullbacks. How much are we pulling back when we go and form those highs and lows here? So for example, on the left here, so how rangy versus how trendy, we can identify the market condition by looking at the size of the pullbacks. So if we kind of just go quickly to here, when we have a move here, so let's say we have a bullish move, if we pull back on average to around 75% or even more, that signifies a range. If we pull back to around 50%, maybe around 50% to like 60, 70%, that's more of a bullish trending range. If we do under 50%, that's more of a trend. So for identifying the market condition, you're mainly focusing on how much have we corrected the previous move on average over a certain period of time. So pretty clear example of a trend. On average, we're correcting over 50% of the previous move. We might sometimes, take out lows or take out highs. So we might break or correct over 100% in either direction, because there is no direction. You're kind of just moving sideways. Well, there is. We'll cover that a bit later. But for an actual example, we are breaking, highs and lows in either direction. And we're correcting around 100% or 75 to 100% of the previous move. Very corrective as well. Easiest way to identify the condition. Again, you can just use the regression trend tool here, where you can have a look at, are we going sideways, maybe with a bit of a bearish bias, and you can align direction and condition, where here we might have had a bit of a high volume or low time frame trend here, where we're correcting under 50% of the previous move. So if we just get this up. Okay, trending ranges are categorized by pullbacks around 50 to 75% of the previous move. So you can either pull back to around 50% or even a bit lower to 75%, but you're still making clear highs and lows in one direction here. So you're making a breaks your structure to the upside, you're making high highs, and you're expecting lows on average. For example, here, correcting to around 50% of this previous bullish move here. Previous bullish move, you would correct a bit more than that, but around 50 to 75%. Yeah, as well. As a general sort of, this is a bit more directional of a trending range, but in general they all look a little bit different. But you're making clear highs and lows in one direction, whilst correcting around 50 to 75% of the previous move. For a trend, this is pullbacks around less than 50%. So it could be 50% or less, maybe just barely 50% or less than 50% here. Again, less than 50%. And then as an actual market condition, very directional, big bullish moves, very small corrective moves without much of a pullback at all as well. And so the market condition will tell you, will also tell you a little bit about what type of entry you want to be taking. Do I want to be looking for a continuation or reversal? When we're looking to trade trends, we want to focus more on continuations in the overall direction. It's a lot easier than looking for reversals counter to that. But if you try to look for continuations in ranges, you're going to get fucked. So we want to focus on reversals. In trending ranges here, we can look for both. We can look for both continuations and reversals. As ranges have their own direction. So when I said earlier that ranges are kind of in between, bearish and bullish direction, it's in between. Ranges have their own direction. The direction in a range isn't sideways. it's towards the midpoint of that range. So the higher you go up in that range, the more likely you are to reverse and correct back in towards the midpoint here. And the lower down you go, the more likely you are to correct back in towards that. So where you are in a range will tell you a lot about the direction to expect price to go next as well. And so it's better for reversals. Think of it as like gravity. Every range has its own gravity. In a normal range, the gravity is like very strongly towards the midpoint, towards like the center. Like the Earth having gravity is towards the center of the Earth. In a trending range, it's a bit different. You still have like, gravity, but it's kind of like sloped. So the gravity is still in towards the midpoint of that, directional range here. And so, when you take out highs, you're more likely to then correct back in towards the midpoint, take out highs, correct back in towards the midpoint, take out highs, then immediately correct back in towards midpoint, take out highs, a little bit of a correction. You start to shift a bit more trendy here. But the further you go up into that range, if it's a bullish trending range, the more likely you are to push bearish. The further you go down lower into that bullish trending range, the more likely you are to correct back in towards the midpoint of that directional range or that trendy range. And so trending ranges tend to give me the highest probabilities. They're very clean. I fucking love trading them because these will probably give you your best trades. You can look for a lower time frame like reversal into the midpoint of the range, but you can also stack that with overall high time frame continuation or middle time frame continuation. So you're kind of like doubling up on direction. You're trading with the direction of the trend. You're trading with the direction of the overall trend, but you're also trading with the direction of the range, which is towards the midpoint of that range. It's very corrective. And so you can trade both reversals and continuations in this as well. So yeah, the most important part is being able to correctly identify a clean condition. And this kind of goes back into more fractional market structure. The size of the range or the condition that you look for will be based off the type of trade you're looking for. So if you're looking for a low time frame, small little scalp with like a really small entry model, you want to focus on lower time frame market structure. If you're focused on a 10, 15, 20 minute move, or even higher, maybe like 5 hours of market conditions or past price action. It's really important if it feels hard to identify the market condition. If it's really irregular or it's high volume and you're not really sure what's going on, do not trade. Do not trade. I don't know what's going on half the time. And when that happens, I don't do anything. I just don't trade. Because if you feel like it's too hard to trade, it's probably because you're going to force a bad setup as well. And with conditions, you don't want to overthink market conditions. You want to trade what you see, not what you think, and you want to expect market structure to continue doing what it has been doing. And good losses are when you take a trade in a condition, like a reversal in a range, but the condition changes. Maybe it shifts into a high volume trendy impulse sort of range or sort of condition. And the only way to tell if a middle time frame condition is going to change is by looking at either high time frame market structure or candle behavior, and looking like what is the context of this middle time frame range within the high time frame market structure. So, for example, we have this overall bullish move, like high volume impulse here. We have a swing high, external swing high, external swing high, external swing low here. And then we have direction shift bearish. We take out this high into then taking out this low and push bearish. We have this middle time frame bearish trending range here, making lower highs and lower lows. But then we're coming into around the lower half of this previous bullish move. And so when we're kind of in this sort of area, trading this bearish trending range, you might be looking for a buy, like a sell here. So, within this bearish trending range, I should be looking for a sell with this overall, middle time frame condition and in towards the midpoint of that middle time frame bearish trending range. But the quality of that will be decreased because you're trading against the high time frame direction that's like overall bullish, or the high time frame condition where you might have a bullish trending range here, and you've just come into around 75% of this bullish or of this low, and so you're more likely for that condition, that middle time frame condition, to break and cede to that high time frame condition and continue that overall direction, as well. Because you have gravity, the gravity of the overall high time frame is now against you. So yeah, as well. So it's important to think about how middle time frame conditions align with high time frame conditions, and fractal price action, all that type of stuff as well. But that is condition versus direction. It is important to be able to identify the condition, because it'll tell you what type of trade to take and where to take it. As in a trend, you're looking to target entries around 50% or maybe a bit less. In a trending range, you're looking to target around 50 to 75%, and then in a range, you're looking to target in the bottom or around lows here, maybe around 75% to 100%. And if you use the wrong sort of area to enter in the wrong condition, you'll just get stopped out before it goes in your favor and stuff like that. Because this will tell you, exactly where to enter as well. In order to actually refine our entries and get better entries, we'll cover entry relativity and levels in the next one as well. This is kind of once we understand condition and direction, we refine our entries or where we want to enter using our AOYs within that overall market condition. So I'll catch you guys in the next video. Okay, so now we're going to cover AOYs, or areas of interest. This is kind of refining where exactly we want to enter within the middle time frame condition. And so entry relativity is just where we're entering relative to the previous move. It's kind of like premium and discount. Pretty much the same to that. But I learned about this before I even understood, premium versus discount. I'm not a ICT or smart money trader. So it's all just about, answering where are we in relation to the previous move, because we want to be entering at the right area. So where are we relative to structure and condition here? And so in a bullish move, whenever we're looking to take a buy and we have a previous bullish move that maybe we're correcting back into, the best sort of entry areas will always be around either 50% if it's more of a trending range, or if it's more range bound, it'll be around 75% of the previous bullish move here. So for example, if I just have a look at, maybe this is a bit more directional here. We're making higher highs and higher lows in a more directional bullish sort of condition, or moving more bullish. We can look to enter around 50% of the previous bullish move, swing low to swing high, around that sort of area. Or if it's a bit more range bound, we might want to wait for price to either extend to take out high, or push into previous lows around here. So pushing into lows or pushing into highs, or even taking out highs, correcting over 50% into around 100%. For a bearish move, it's just the opposite. So pushing bearish, the easiest way to find like where you are, using entry relativity, is to just use the Fibonacci tool. So using the Fib tool here, I have it set up. These are my settings for the Fib tool. And I just do it from the swing low into the swing high. And if it's a bit more rangy or a bit more of a trending range, I want to at least wait for price action to come into 50% of this previous, swing low, swing high, this previous bullish move, or just look to enter at around this area with the overall condition for price action to continue. If it's more range bound, it's likely to be in the lower half. If you've been pushing more rangy over this period of time, I'm likely to expect that it's going to be a bigger push into the lower half of this range. If it's more directional, where we've been pushing bullish over the past period of time, I'm likely to expect us to correct under 50%. So I can look for buys higher up in the previous move, or just wait for it to come back into 50% to look for my entry. But you just want to expect the condition to continue doing what it has been doing, unless high time frame tells you different as well. So yeah, a bit of a bullish trending range where you're correcting to around 50% of the previous move. So that's just showing you where you want to enter using the Fib. So ideally, if it's a bearish trending range, or we have this previous bearish move, I want to look for entries around 50% or above here, around 50% or above. I can look for my entry model in this general sort of area. And again, we have a swing high to a swing low, this swing high to this swing low. We want to be looking to enter around 50% or higher as well. This is probably extremely important. As in my journal, when I'm entering buys in the bottom half or sells in the upper half of this previous, previous bearish move, sells in the upper half, previous bullish move, buys in the lower half, I have around an 89% win rate when I'm taking that buy, 75% corrections, after 75% correction. So 89% win rate here. But if I'm looking to buy into highs, sell into lows, and I'm doing the opposite of that, buying around highs, selling around lows, I have around a 40% win rate. So definitely not a good idea for me to be doing that. So very easy way to improve your profitability just by looking at where you are within market structure, within the previous move, and looking to make sure you're entering in the right half of that move. Yeah, but this can be a pretty big area that we're looking to enter in. Like this is a massive sort of area to look for an entry. And so we can use levels to further refine that area that we want to enter. So we want to focus on levels that are at the right areas within the condition and relative to the previous move. We don't just want to focus on any random levels. And it's just, more refined version where we want to look for our reaction or our entry model, which we'll cover next, the entry model. So the main levels I use high time frame candle closures. So for example, when we go from a candle closing in a certain direction, so we'll just get this up here. So when this candle goes from a bullish candle close to a bearish candle, so here, there, that creates a level here. So when we go from a bullish to a bearish or a bearish to a bullish, that creates a level here. I mainly focus on levels formed by these high time frame candle closures. So the time frames that I look at here, I look at the 1 hour candle closures, the 4 hour candle closures, the 1 day mainly, but you can kind of look at them across different time frames. And these are where I refine my entries, where I want to look for an entry, like on the low time frames, on the 1 minute. So I mainly focus on hourly levels as I'm trading the 1 minute. If I was trading the 5 or the 15 minute, I look at levels on the 4 hour. If I was trading, 30 or hourly, I look at levels on the daily. And think of these high time frame levels, these candle closures, as where the low time frame market structure can react to create the wicks for the next high time frame candles. And you're just likely to have reactions at these sort of areas here. So when you go from a bearish to a bullish candle close, that creates a level. When you go from a bullish to a bearish candle close, that creates a level. Another level here, and this is just simply where we're looking to look for our entry model or for a reaction to take our entry off in that condition. If you want access to this candle overlay indicator, I'll put the link in the description below the videos as well. You can find it on the WAP, and you can have the candle behavior overlay indicator. But yeah, as another sort of example, we have this bearish to bullish candle close here. That creates a level for the next candle to open, push into that level, create that wick. And yeah, so I wouldn't say levels are the most important. They're helpful for refining your entry. But the accuracy of your entry comes mainly from the entry model or the reaction at that area. So yeah, for example, in the previous sort of example that we're using, we can look at previous hourly candle closures. We had this previous closure here that price reacted to. I tend to draw like a zone around this level. So I won't look for price to come exactly into this level. I'll draw a zone around it like that. And I'm, because it's not really like exact price levels. It's just like a general sort of zone that I look for a reaction at. I'm not trying to be the most accurate. I'm just looking for a reaction at that area. And so we have a bullish to a bearish candle close that we come into, reverse tap into here, and then we have another push into it. I don't care if it goes beyond. It's just a general sort of area that I'm looking for a reaction at here in this overall condition as well. And then we have a previous, again, we have a bearish to bullish candle close here. So bearish to bullish, where we come back into after we take out these lows. We come back into this sort of area. This is around 50% as well. It lines up with 50% of this bearish move, this level, where I can look for my entry model for a reaction on. So yeah, you look to align the levels with where you want to enter within that, entry relativity or that range. And that's where we kind of look for our reactions, like our entry models, which will be a shift of market structure here. So we can see shifts of market structure at those levels in the upper half of the swing points. So bearish move here, 50% as well. So we'll cover entry models in the next video, but AOI is just about looking about where you want to enter within a market condition or within direction, and you can refine that using entry relativity, adapting it to the market condition. So trending range, ranging will tell you if I want to enter in the top 25%, 50%, or maybe lower if it's more directional and trendy. And then levels are helpful for refining where you want to enter within the range or that 50% fib area as well. Okay, so now we're going to cover entry models. This is more about timing our entries and making sure we have low time frame aligned in our direction, or have a confirmation or reaction at a certain area. So we've kind of covered what sort of direction is, how do you identify direction, so we can identify, are we taking a buy or sell. We've then covered where we want to enter within that direction or that market condition, and refining that, refining where we want to enter. Now this is about a bit more when we want to enter, making sure we're entering at the right time, and that we have low time frame in our favor, or the lowest time frame possible. Because if we're looking for a sell, but low time frame is pulling back, making higher highs and higher lows, if we just randomly enter a sell, we're just guessing. Like, we want to wait for a confirmation to have consistent entries, so we can have consistent results. Not have price top us out before it goes in our favor. And so the best way I've found, all my entry models are just a simple shift of market structure. So where we go from price action taking out a previous high into immediately taking out a previous low. So we go from making high highs, high lows. Now we're making lower highs and lower lows. That shift in market structure shows that there's been a shift in market direction. So the quality of your trade is based off how much you refine and align. And so I always want the lowest time frame possible to be aligned in my direction, trading with direction and momentum. And so for the entry on this market structure shift here, I'm always going to look to enter at around 50% of the previous move. So using that entry relativity here, and my stop loss will be placed above this high, and I'll be targeting wherever I want within that range here. And so what we specifically want on a shift of market structure to there be a high volume impulse. So we want it to immediately take out this high into then immediately taking out this low here. And if I go back here, there can be lots of different types of shifts. There can be some like low volume, like rangey shifts where we have a range and then we take out a high into immediately taking out a low. That's still fine. And this is maybe a bearish, bit big of a high of a bullish type 3 shift. Whereas this might be a little bit lower volume, rangy of a bullish type 3 shift where we take out a low into then immediately taking out a high, pulling back into 50%, then continuing as well. But we want to focus on taking shifts of market structure, and this is sort of an example of it. So we have a high here, we have a low here, and then we take out this previous high into then price action volume coming in, immediately taking out this previous low. We go entry relativity, swing high to the swing low. We look to enter at around 50% of the pullback of this breaking move here as well. And so that's sort of it. Stop above the high, targeting wherever you want within the range as well. And that's a pretty basic sort of entry model. We do not want to look for entries on changes of character, as it's kind of low volume. It's not as clean. There's no clear shift in direction. Like, this could just be a pullback into then you going higher as well. So I don't really care about changes of character here. Like, it could just be, you pulling back into then continue on. I'm really looking for, price action to take out a previous high into then immediately taking out a low, a clear shift in direction, high volume shift as well. Because otherwise this isn't the cleanest confirmation of direction. It could just be low time frame pulling back into then continuing, not low time frame actually like shifting as well. So shifts can be further refined again as fractal price action. On this sort of like, if we look at this as a middle time frame move, in between these little middle time frame moves, you have lower time frame structure where you might have a shift here at the low where you take out this low, take out this high into then pushing bullish, where you might have you take out this high here, take out this low, and then you have a pullback. So you can have fractal shifts, a shift within a shift here. The benefits of these is that, let's say there's a really big breaking move here, really big breaking move, and if you were to enter at around 50%, you'd have a massive stop loss. In this sort of example, you can look for another shift within this shift. So a shift within the shift where you have low time frame come into 50% of this previous move, and you take out this high here into then immediately taking out this low. You put your stop loss above the high or still above the external high, and you can have a better risk reward as well. And this is sort of another example going back to internal and external structure shifting, where we have a bit of a low time frame shift here. And it comes pulls back into 50%. Then we have a shift within the shift where you can put an entry, stop below the low and target with the overall condition. Yeah. And so putting all the concepts together, you have, identifying the overall bullish trending range. You're looking to take a buy in the lower half of this bullish trending range. You could maybe align that with a level. And then you wait for a price action to shift in the overall direction. And you could have a pullback at 50% of this previous move. Yeah, as well. So you're kind of using the same concepts across all different directions of price action, like entry relativity, highs and lows, market conditions. And for example of a shift, this is a bit of a high time frame shift. So this is the previous example of the change in direction. So a shift in high time frame direction. So if we get up this, so we've taken out this low to take out this high. We've come back into 50%. Here, and we can actually zoom in on this low time frame structure here, where this is a bit low volume, not the cleanest, but we take out some lows around here into then immediately taking out some highs with high volume. So you want it to be like a pretty volatile break of highs after you take out the lows, or vice versa if it's the opposite direction. And then you look to enter at around 50% of the breaking move here. And we can take this one step further. It can be a shift within a shift within a shift, where we drop down onto the seconds, where we're making lower highs on the pullback here, and then we take out some. We take out some lows here, take out some lows, and then immediately take out some highs. So an entry can be at the breakout of the highs, stop below the lows, and you've aligned a lot of different time frames. You've aligned second chart with the 1 minute, with maybe a bit higher time frame. And so that's mainly the entry model. It's just a shift of market structure. We'll go into a bit more timing in candle behavior as well. But that's sort of, the baseline of it. You can use higher time frame shifts for helping with direction. Or, you can even use high time frame shifts for where you want to enter. Just like if you have a high time frame shift, you have a 50% fib, that may be where you want to enter, or an AOY. And then you can just look for the exact same thing, just on lower time frame here, and it's pretty simple, very easy to have an edge using that as well. And I tend to get the best risk rewards on these sort of setups. Yeah, but we'll cover candle behavior next. This is more about timing, giving timing to market structure as well. Okay, so now we're going to cover candle behavior. This is probably one of the most important parts of trading, because the hardest part of trading is timing. It doesn't matter if you enter at the right area, in the right direction. If you enter at the wrong time, you will still lose. You'll get stopped out, maybe just barely, before price action goes in your favor. And that's pretty frustrating. And so market structure tells us where to enter, what sort of direction maybe to enter in. Candle behavior, more specifically, tells us when, and it gives timing to market structure. This is simply because every candle is just time-based market structure. A 1 hour candle is a simplified version of 60 minutes of 1 minute market structure here. So if you have a look at this using the indicator, this 1 hour candle simplifies the lows, the highs of this low time frame market structure. So think of it as time-based low time frame market structure. And so understanding how candles move throughout the life cycle of each candle will allow you to give timing and understand how low time frame market structure moves throughout that time. So when moves are going to happen. If we push in a certain direction for the first half of a candle, what's likely to happen in the next half of the candle? And this has allowed me to, identify when the best times to take continuations versus reversals are, which we'll cover a bit later as well. But what is candle behavior? It's just the study of how individual candles form and close in relation to the previous candle, opens and closes, key levels, market conditions, sessions, and yeah, market conditions. Is it a range? Is it a trend? How is the candle? Where is the candle opening within that condition? Is it going to push into the low, into the upper half of that range or that trend? All these sort of things. And then also liquidity, highs and lows, all that type of stuff. But it's not really about memorizing patterns. It's about understanding how the candles open and move throughout the life cycle, how it flows, as well. So in order to understand candle behavior, you need to understand why whenever you push bearish, we're always likely to create a top wick first. Or whenever you push bullish, we're likely to create a bottom wick first. So why does every bearish candle start with a bullish move? Why does every bullish move start with a bearish move? So this kind of goes back into auction market theory, or price being elastic. In order to push in a certain direction, in order to push bullish, we first have to push bearish, because big institutions move the market. And if big institutions want to be buying or looking for price to go bullish, they will first drive price lower to create sell volume, so they can then become the counterparty of that volume to enter their buy positions, get filled at a better entry, for them to drive price higher later on in the day. And so a lot of time you'll see when you trade is that if we're going to continue in a certain direction, likely a bearish candle will start bullish here and push bullish to create that top wick first, to then flip later on and push bearish, continuing that overall direction. What this will look like on lower time frame market structure is that you have you're making higher highs and higher lows here. Sorry, you're making lower highs and lower lows, and you might have a bearish candle close here with the next bearish candle opening, creating that top wick first here to then flip and push bearish later on. And for a bullish example, you can have a bullish uptrend where a high time frame candle like opens, you have that bottom wick being formed in the first half. We have that pullback first to then push later on as well. And so understanding when candles open and close will allow you to time when pullback's likely to occur and how long they're going to last as well. So it can be really helpful for that. And it's also helpful for timing direction, timing entries. If you're trading the first half of the day, which we'll cover a little bit later on, that will help you find the direction as well. But sometimes when we open, let's say we're pushing bullish, we're making high highs and high lows on the lower time frame here, but we just don't have a pullback here. Let's say we have a bullish candle close, we're pushing bullish, but then we just immediately continue pushing bullish. So there is no pullback at the start of the new candle. We just continue pushing. Instead of the previous sort of example where we create the bottom wick first to then continue and closed bullish, likely you're going to have the opposite. So institutions weren't able to collect their orders. They weren't able to drive price lower or lower earlier to then take the opposite side and then drive it higher. And so it's kind of like you weren't able to collect energy to continue on. You've kind of expended even more energy, and now you're kind of running on old fumes or like running on steam, running out of energy. So prices is stretched too far in one direction without a pullback, and likely this is where you have reversals. You more likely have a snapback. So just by looking at a candle close here, so the previous candle close, also just by looking at how a candle opens, does the candle open and immediately push bullish, continuing on in that direction? Likely we're going to have a correction or a reversal in the later half of that candle, and that can be like a sign for reversals. If that candle closes bullish, next candle opens, we create the bottom first, we then continue, likely that direction is going to continue. So how a candle moves at the open or in relation to the previous close can tell you, is it more likely for us to continue on in the overall direction, like we create the bottom wick first to then continue on, or do we like immediately push in the same direction of the previous candle here, where we don't create much of a top wick at all? Then likely in the second half of this candle, we're going to reverse because we've overstretched, we've corrected too far. Because again, price is like an elastic band. if you stretch too far here, you're likely to have a snapback. And so I look to take advantage of these little corrections, these snapbacks, when these hourly candles stretch too far. Yeah. And so candle behavior can be used for timing direction. So high time frame candles, so the daily and the weekly candle can be useful for timing direction. For example, if I'm trading Asia session here, likely I will look at the previous day close to tell me if I should be looking for a buy or a sell, or timing, looking to align that with some middle time frame market structure or low time frame market structure. For example, when the previous day closes bearish and maybe we're a bit more directional, a bit more trendy, likely the first half of the day around Asia session, we're going to be pushing bullish to correct the top wick here of the previous move here. For example, again, this is a bit less of a close. So think of it like the smaller the body, the less of a pullback you're likely to get. Yeah. And so we create a bit of a top wick to then push bearish, we have a shift and push bearish. But yeah, a bit less of a top wick, more of a push bullish in the first half here. And so that results in, we didn't really get to create much of a top wick at all. We've overextended and we have a big snapback here. And so now this candle has closed bullish. In the next candle, in Asia session, you kind of be looking for it to create the bottom wick first here. And this high time frame candle created that overall shift of market structure. We can look for that next candle to create the bottom wick to time, direction timer entry as well, coming back into 50% of this previous move. To then push bullish in overall direction. And so that can be quite helpful. Pretty much always, if we have like a bullish candle close on the high time frame, we're likely to create a bottom wick in Asia session to then continue on later on in the day. So previous candle close bullish, create the bottom wick in Asia session to then continue on later in the day. So likely around the open of Tokyo or Asia, you could look to trade in the opposite direction of high time frame or the opposite direction of the previous candle close. Because it's going to be creating that wick first as well. So let's get this up. For some other examples, creating that bottom wick first on the day in Asia session to then continue on later on in the day. But this is also helpful on the weekly sort of time frame. So likely, if the previous week closes bullish, Monday, Tuesday, Wednesday, or Monday, Tuesday, probably going to push bearish to create that bottom wick as well. And you'll find the best reversals tend to happen on a Wednesday around London session. Why is that? Because around Wednesday, if I get this up here, around Wednesday here in London session, you can look at both that you're around the halfway point of both the daily and the weekly candle behavior. And so if you've kind of pushed bullish for a couple of days, coming into around the halfway point of the day, and then you've pushed bullish in Tokyo Asia session, and you've kind of overextended, you haven't corrected the previous move. You kind of have that daily and that weekly candle likely to shift and correct, and you can have these massive sort of reversals. For example, this is again, these are some daily candles with the weekly around the halfway point of the week. You pushed bullish without much of a bottom wick being formed first, and so you reverse. And again, you push bearish here without much of a top wick being formed of this previous bearish candle, and so you reverse later on as well. So yeah, you just need to understand these two things in candle behavior is how does the candle open in regards to the previous candle close. So if the previous candle closed bullish and you've created a bottom wick first, you then continue, likely it's going to be a nice continuation. If the previous candle closed bullish and the next candle immediately opens and continues pushing bullish without creating a pullback or without correcting, likely you're going to have a correction in the second half of that candle. And so you can avoid losses where you might be looking for, it's pushed and you might be looking for a, continuation in the second half where you just take a loss because that hourly candle behavior. You've overstretched too far and you're now correcting that previous move as well. And so that can be useful for timing direction using daily, weekly candle behavior as well. For example, I trade both Asia session and London session. And so if Asia session is trending, likely there will be a really nice reversal in London session. So that's, great for me. So if I don't get it set up in, if I'm always looking for like a range to take a reversal in. If I don't get a range in Asia session because it's trending in one direction, I'll wait to London session to then take the reversal of that high time frame trend, or that daily candle behavior. So for example, let's just get this up. If I bring up some daily sort of candle behavior here, I go into maybe a bit higher of a time frame here. I always look at the previous candle closures to identify, if this previous candle closed bullish, likely I'm going to be looking for sells in Asia session, or if it closed bearish, likely going to be looking for buys in Asia session, or it's going to be a bit more directional. And how that candle moves, the life cycle of that candle is also quite important. If you have a candle open, it doesn't create the pullback here of the previous bullish candle, and it's a very big bullish candle, likely around that halfway point, you're going to have that correction or that reversal as well. Okay, now onto timing entries. This is more about using a bit lower time frame candles, so maybe 4-hour candle behavior, hourly candle behavior. So for example here, we want to, again, align this with the middle time frame condition, and align this with the low time frame market structure. So let's say, for example, we have this 1 minute market structure here. We've been making lower highs and lower lows. And we're looking for a pullback here. We can wait for the new hour candle to open and create the top wick first here. And for continuations, I look for continuations around the first 0 to 50 minutes of the hour, reversals around 30 to 45 minutes into the hour. Just coming back to the data that I've collected. So continuations tend to be best in the first, around 10 minutes, I'd say. Continuations in the first 10 minutes of the hour tend to be best. Reversals around 20 to 30 minutes, 45, 30 to 45 tend to also be quite good with data as well. So that's the data behind the candle behavior. And so for continuations, here we can time the pullback of the low time frame market structure with that high time frame hourly candle behavior here. We can look for our entry model or a bit of a shift for that candle to then create that top wick and then flip bearish here as well. So for a continuation sort of example, we have this bearish downtrend trending range, and we're creating the top wick in the first half of the hourly candle here. That's the pullback of this previous bearish move to around 50%, and we're routinely creating the top wick in the first half of the hourly candle here on the pullback to around above 50% of the previous move, and again here. Then when we tend to just continue on without creating much of a top wick at all, we tend to just immediately push bullish, take out the previous low, and then have that shift. That's more a sign that could be either a big shift, or it might even be like a bigger pullback, or just an overall reversal. So for example, in this sort of example, we immediately pushed bearish, but then we created a bit more of a top wick in the first half to then continue on. But in this sort of example, wasn't as much of a top wick being formed. We just continue pushing bullish, and then in the later half of that, we had more of a shift. Even on this candle here, we had more of a pullback in the second half because it wasn't much of a top wick. I mean, you kind of want it to push bullish first, and then have that correction, a bit of a cleaner move. So yeah. We wouldn't be looking for continuations of the overall direction in the second half of the hourly candle. That's what resulted in lower win rates for continuations. It's more like you're going to be looking for a reversal. And you can look for your entry model, your low time frame entry model around the second half of the hour as well. So you can look to align candle behavior with low time frame market structure for your entry model. So for example, we can connect candle behavior with market structure. So I mainly look to use, for this sort of example, like 1 minute market structure with 50-minute candle behavior. For example, if I have a previous 50-minute candle close in my direction here, I can look to enter on the pullback of that next 50-minute top wick being formed here. So on this 1 minute type 3 shift, I can wait for this 50-minute candle to close bearish. The next 50-minute candle can open, create that top wick first. I can look for my entry here, and I'm aligning that 1 minute market structure shift with that 50-minute candle behavior to time the entry around the halfway point of that 50-minute candle here. If let's say, we have this shift here, but we have a shift like this, and then this is actually like a candle closing bullish, and then the next candle opens here, and we create the bottom wick first, and this bottom wick is actually forming that shift. So this is like a high time frame candle creating the bottom wick, breaking this like internal low of the previous candle and creating that shift to market structure. Likely, I will not take this trade because it could just be this candle creating the bottom wick to then flip and push bullish, and so this would be like a fake out here. So I'd rather the candle close in my direction and then the next candle open, create the top wick first. That's a better quality trade. That's more confirmation. So that can help me avoid some losses. And so for continuations, you're kind of looking for the pullback to be initiated at the start of the new candle, create that wick against you here. Think of it kind of like a slingshot. You want the candle to open and like pull back, like slingshotting you in one direction, to then go in that direction. If you don't have that, likely it's just gonna falter and then reverse. And you can also look at premium discount, entry relativity in the same way. The best buys will tend to be below the open of the candle. The best sells will tend to be above the open. So best buys below, best sells above. So previous candle closes bearish, best sells will be above. Previous candle closes bullish, best sells will be below. Yeah. And this can be useful on high time frame candles, connecting market structure with direction or timing direction using high time frame candle behavior. So let's say, if Tokyo is trending here, low time frame is trending in Tokyo session in Asia, and we push into the range low of the previous day's candle, likely around London session, we're going to have a reversal. So this is one of my favorite sort of setups, is identifying, what is the range of the previous day? How does Tokyo move in relation to that range? If Tokyo trends and impulses into the range low, around London session tends to be the best of reversals. So if we have a previous swing high here, and swing low, we have the day open, and Tokyo just pushes trends bullish into the range high. Likely around London session, we're going to have that reversal or a bit of a corrective move here as well. So using daily candle behavior to time a bit bigger moves through sessions, and looking at how sessions move, and how I trade Asia session will be based off how the previous day closed, and New York session, how I trade London session will be based off how Tokyo moved in relation to the previous day's close. And then you can also use it for timing as well. If you're trading like a reversal back in towards the midpoint of this bullish trending range, when do I want to enter? In the upper half, looking for sells, I can actually time it around the halfway points of a alley candle. Let's say the alley candle opens, you immediately overextend, you take out highs of this bullish trending range. Likely there's going to be a good reversal. So we've stretched too far. So how you come in to take out these highs, this candle opened, didn't create a bottom wick here, it just immediately pushed bullish. Likely there's going to be a nice reversal when we take out this external high of this bullish trending range to come back in towards the midpoint of that, or correct back in towards the midpoint. And then for another example, alley candle opened here, you have the swing high, swing low, you have around 50%. You're in a bit more of a bullish trending range, so you're looking to buy in around the lower half of that. So you have price open, extend into lower half around the second half of this wick. Here you have a bit more of a shift, you then push bullish later on as well. So you can connect that high time frame candle behavior with low time frame market structure. This is why when I'm trading a reversal in a range, I always want an alley candle to open here and overextend into the extreme of the range. Alley candle opens, overextends into the extreme of the range. Alley candle opens, overextends into the extreme of the range. And then in the second half of that alley candle here, you tend to have really nice reversals back in towards the midpoint. because again, how a candle opens and forms in relation to the previous candle. If you don't, create that wick first, that's a reversal signal. You've overstretched. You're too imbalanced, and you're likely to rebalance. And so for timeframes, when I talk about low time frame, middle time frame, high time frame, all timeframes show you the exact same thing, just in different amounts of detail. A hourly candle will show you the exact same thing as 61 minute candles, but just in different amounts of detail here. So it'll show you, the highs or lows, but you won't be able to really see the details of the highs and lows. And so, when I talk about different time frames, low time frame, middle time frame, high time frame, I talk about duration of price action here, not time frame. I don't really care about time frames. They all show the exact same thing. Let me get this up. Think about price action when you're looking at the charts as like a TV screen, and the higher time frame you go, the lower quality detail. So maybe the daily chart is 480p, and the 4 hour is maybe 1080p. Hourly is like 2K. The 5 minutes like 4K. The 1 minute's like 8K HD. So for example, I can just see bare highs and lows here. If I go into the hourly here, let me get this up. I start to see a bit more detail of that, and then there's even more detail on the 1 minute, the 5 minute charts of how these candles have moved throughout the life cycle of that candle, the low time frame market structure. So all time frames show the exact same thing in different amounts of detail. When I think about price action or time frames, I think about duration of price action, because everyone has different definitions of low time frame, middle time frame, high time frame. And the biggest mistake people make is that they trade too high of a time frame for the type of move that they go for. And so that leads them to enter too early and get stopped out before price action goes in their favor. Looking at the 30-minute time frame is inconsistent here, because when I look at the 30-minute time frame, am I looking at it like this over the past half a week, or am I looking at like this over the past almost a month? I just stay on the 1 minute time frame, and I just zoom out. And if I want to look at different time frames, I have my indicators up, which you can find in the link description below, where I can look at the 4 hour time frame, the hourly time frame, and all that sort of stuff on the 1 minute chart. I don't switch between these time frames much at all. I just think about duration of price action, because when I'm taking a lower time frame little move, I need to care about the past 30, 60 minutes of time frame. It doesn't matter what the hour time frame, hourly time frame is doing. It doesn't matter what the past 2 weeks of market structure are doing if I'm just trading 10 minutes. Because you're not just trading moves in the market, you're trading periods of time. I'm trading the next 10 minutes. So I don't care about what a certain time frame is doing. I care about what the past hour of price action has been doing, or what the past 5 hours have been doing. And so for low time frame, I focus on the past 30 to 60 minutes of price action. Middle time frame past 5 to 12 hours, and then high time frame is past day plus. And so I will use the regression trend tool and see, okay, the past 6 hours of price action here have been overall bullish in a bit of a bullish trending range. If you want to simplify this as well, you can use the timeframes indicator as well. I'll put the link of that to that below, and I can see overall different timeframes. I can input the low time frame as well. So we have high time frame in the red, overall bullish. We've had middle time frame in the sort of blue gray. We've come into the lower half of this bullish sort of trending range on the high time frame. Now kind of a bit more range bound, but low time frame is now pushing a bit more bullish, aligning with that higher time frame here. And so I can identify all the different directions and ranges based off duration of price action, not time frame. I think that's a mistake. Focus on time frames, because it all shows the same thing. All shows the same thing. You're just getting less detail, and it's a bit simpler. But yeah, that's kind of behavior. Gives timing to market structure. This kind of sounds like a lot. We covered a lot of information. In the next video, I'll kind of break down exactly how to put it all together and use it in a step-by-step process. But this is sort of the theory, or not so the theory, but how to read price action, how to understand price action, market structure, to tell you what, where, and how, counter behavior to tell you when, and just kind of, this is all about answering simple questions to build that edge, those variables about what type of trade you want to look for. buy, sell, continuation, reversal based off direction and condition. Where do you want to enter using condition, identifying the market condition, your AOIs, entry relativity, and levels. And then when you want to enter. So when you want to enter is based off your entry model and candle behavior, about timing that market structure, look at how that candle has opened and moved, that the life cycle of that candle in relation to all these other factors to give timing to direction and entry models. Okay, so now that we've defined and gone over technical analysis, now we're going to go over how to put it all together and use it in real market conditions. Everything that we've covered from market structure, auction market theory, candle behavior is also that we can answer these four main questions. The first question that we want to answer is what type of trade are we taking? Are we looking for a buy, a sell, a continuation, or a reversal? And there's two things that we use to answer that is market structure. What is the market direction and what is the market condition? That'll allow us to define, are we looking for a buy or sell based off direction or a continuation or reversal based off the condition? Then after we define what type of trade we're looking for, we then want to define where we want to enter within that direction or, within that market condition. And, that would be based off looking at, what sort of condition it is, trending versus ranging, where are we in relation to that condition or the previous move, and are there any specific levels that we want to be entering at in that market structure. The third question that we want to answer is how do we want it to get there? How do we want it to come into our area of interest? This is kind of a bit of auction market theory. Ideally, we want to imbalance or stretch, overextend into where we want to enter. As well, I find that gives us a lot better of a probability. And then once it stretches into that area within that condition, then it's now about timing. So we want to make sure we're entering at the right time to avoid getting stopped out early. And this is probably one of the most important parts where we more specifically rely on candle behavior. So low time frame, middle time frame, high time frame candles, all trying to align that in our favor to take entries at the right time. In this step as well, we also want to wait for our entry model, so a market structure shift as a bit of a confirmation in that period of time, at that area, in that condition. And so we'll break down this 4-step process on how I find high quality setups, doing a bit of back testing as well. So we'll start a new session. And as always, I'm looking to take a trade on gold. Always looking to trade gold. That's my main pair. And I'll just turn around so I'm not cheating. Okay, so we'll go to the start of the month here and we'll do today's date as the end date. Okay, nice. So I'll kind of break down my, the theory behind it when I'm looking to take a trade. So I'll break down into that what, where, how, and when. And we'll just get this up. So remove volume. I don't use volume. And so first off, I just zoom out. I'm mainly always going to be on the 1-minute chart as well. So I'll just zoom out and look at, what is the market condition? What is the market direction first? Obviously, we're moving definitely a bit more bearish, making lower highs and lower lows. It is quite bearish. But over the past 7 hours, we've been a bit more rangy, a bit more corrective. And so there could be a potential setup for maybe like a low time frame reversal, high time frame continuation, or maybe like a low time frame reversal, high time frame continuation if we extend below these lows. So there's two sort of setups here in this sort of range. It's a bit more of a rangy condition, so reversals can do well in this. So we'll just get this up here. Okay. Yeah. Actually not bad. So first off, looks like we're kind of forming a bit of a bearish trending range. It's a bit bigger of a middle time frame condition, but we've taken out this previous low. And so ideally, if you're trading against the condition, against the overall direction, sorry, especially for like trending ranges, you want to be looking for like sells above lows. So below lows. You want to be looking for sells below lows back in towards the midpoint of the range. And so this is looking pretty good. We do have a shift here as well. So We've taken out this low into taking out this high. We would then want to look for a pullback into 50% of this previous move here. So if we have a pullback into 50% of this previous move, we can look for an entry on that shift, and we would look to target 50% of this extension, because this is a pretty nice extension. We've stretched without much of a pullback at all. So what is a bearish trending range here? Where when you're trading, counter to the direction in this sort of condition, you want to be looking for buys below lows. This is you good. We've taken out this low. How, nice extension. When we are at 20, around 30 minutes into the hour. So decent sort of timing, and we've had a shift in market structure. So we'll see if we have a pullback. So we can take a buy in towards the correction, 50% of this previous move. Okay, so we didn't really have a pullback. Okay, that's looking unfortunate. We didn't get a pullback on that. Went just straight in towards 50%. Unfortunately, sometimes you just won't get a pullback. It'll just it'll just go. And this was pretty high volume market structure. So that's pretty unlucky, but we'll just wait and see if we get another setup. We could either look for it to extend into the high for maybe a bit of a continuation, or extend to take out this low for a bit of a reversal. So we'll see what happens. Okay, pretty high volume. This is really nice sort of extension here. We've taken out this low again. Okay, that's looking nice. So we've taken out this low into taking out this high here. This is a really nice shift. This is even like a nicer shift than this. So this is even a better entry model. Very clearly took out this low into taking out this high. We are below lows here in this bearish trending range. It's counter direction, but pro condition back in towards the midpoint, of this condition here. So I'll get rid of these drawings and I'll go swing low, swing high here. And what I'll do is on the pullback on a type 2 shift, most of the time I look for like a bit of a reaction at that 50% area. So okay, I'm just looking for us to pull back into that. Might try that to there as well. Okay, so now what I'm looking for is we're making lower highs and lower lows. I'm looking for this second structure to align with this 1 minute structure shifting. So if we take out a high, after take out a low, then take out a high. I mean, we do kind of have a bit of a shift. Ideally, want a bit bigger of a break of a low. Like a big break of a low like this. Yeah. Okay, this is a bit nicer. If we take out this high, that would be a nice second shift. Okay. If we take out this high, that would be a nice second shift. Okay, if we take out this high, that would be a nice second shift. Okay. Nice. Nice. So we have a decent break of a low. On a shift, you're not just looking for it to like barely take out this low, like it maybe barely did, or barely take out the high. You want it to like have a clear takeout of a low and then a clear takeout of the high. Otherwise, it could just form into like a range here. So that's pretty nice. So we have a shift within a shift. And so we can look to target in towards 50% of this breaking bearish move. So I'll get up this look for a buy around here, and I'll put a stop below the low. We'll target in towards 50% of that move. And was it Alt M? Okay, so place a market order on this. Let's see how this goes. I'll go back onto the 1 minute. Nice. Easy. That's 1.9 R trade. And it corrected a bit more than 50% of this previous extension. You have a bit of a shift here. I mean, so you do have this kind of trending range direction is kind of shifted a bit more bullish now because you've kind of taken out this high. So direction has kind of shifted. We'll see if there's a pullback into 50% of this. Okay, that's pretty nasty sort of volume. Okay, we have a bit of a pullback. Okay, so on this, like the what is the direction, the condition? The direction's kind of shifted bullish, and we could be looking for like a bit of a buy in towards that. The where is like we want to be entering around 50% of this, breaking move. The how is not met though. So the how, ideally you want price to like, push and then have a nice stretch extension. This is like a range into it. So I don't like this at all. I mean, it could shift in our favor, but yeah, not the biggest fan of that. It's just ranging. So it's a bit messy. I could have entered here. I would have been stopped out before, went in my direction. So yeah, it's just the how wasn't being met. You want to like shift or extend, stretch into your favor. And we're in the New York session, so I won't be trading this. So we'll just wait until the next sesh. $11:30. Okay, 12 p.m. Some volume comes in, taking out those highs. So direction is definitely more bullish. And 30-minute, we are kind of extended here. Okay, we have a bit of a shift. We'll see if we have a pullback on the seconds. Okay, we've come back into 50%. We could look for a bit of a correction back in. Okay, we're now 39 minutes into the hour. Let's wait for a shift. Do we get one? It's kind of tough. Like it's hard on these big pullbacks because you don't really have like much structure to trade around. Yeah, it's not looking great, yo. So I was looking for a bit nice of a reaction in this shift here. Yeah, this is now the next hour open. Yeah, it's looking very directional, very trendy. Okay, the alley open is around here. We've had a pretty decent sort of extension. I've had a bit of a second shift. I think it's just trending, man. It's just too directional. Because if we zoom out onto this, what is the condition over like the past half a day or 9 hours? It's very directional. You've only had like, a push bullish, push bearish, push bullish. And you have this massive range to the left here. So I don't think this is optimal for looking for reversals. it could eventually happen, but you're just likely to get stopped out before it works out in your favor. So I'm not the biggest fan of this condition. So I'm just going to wait for a condition that I like to set up. So I'm waiting for more structure to form on the middle time frame, as it feels like if it's too hard to find a setup, you just shouldn't be trading. And we're in New York session again. So we'll wait until Asia. It's been very high volume. Yeah, again, you have a really big extension. No clear inch model on that as well. Okay, we've had this hourly extend into breaking out this low. So this is a bit of a shift bearish. We could look for a little bit of a buy in towards 50% of this. And we're 40 minutes into the hour. Kind of just tough on this like lower time frame structure. It's kind of hard to get like a clear shift. Well, I'm feeling like it could pull back into this, you know, a bit overextended after taking out this low. I mean, I'd sorry, this would be a buy. I'd have to like give this quite a lot of breathing room. I mean, fuck it. I mean, this is like a lower quality setup. Like, I wouldn't be surprised if this lost. I mean, it's rangy as fuck. Um, but like, I feel like you know we can correct back into towards 50% of this previous move. Yeah, that was wasn't the greatest sort of setup, but like even if we want to push lower, likely we're gonna correct back into 50% to then push in that direction. We've just previously taken out this high of this bullish trending range here. So we're kind of like shifting more bearish in towards, you know, correcting back in towards the midpoint of this overall bullish trending range. So it was a bit of a extension back into 50%. This is, yeah, I think this trade wasn't the cleanest or the best. But yeah, we'll just go on to the next one. Okay, pretty high volume, big extension. Yeah, I don't think I should be trading this condition. It's a bit too big of a range. So we'll just wait and see. It's very bullish, man. Wait. I'm just gonna wait until like a range forms because this is like very trendy, and I'm not the biggest fan of trading trends. I like trading within ranges or trending ranges. something that's a bit more like corrective. Okay, we're at the second hour of Asia. I want to be trading like within structure, and we have this previous big bearish move here, so we're more within structure. Okay, 12:35. We do have a nice extension into like this is the previous bearish move here. We are in the upper half of this, so we could look for a bit of a condition with this like or continuation with this overall bearish trending range direction. But I don't like this structure here. It's not very clean of an entry model that would likely set up. Yeah. We have taken out this low into taking out this high. I mean, that's not bad. Looks like a pretty nice little reaction. Might just take like a 1-to-1 on this actually. Okay, overall direction is like still bullish. We did have a bit of a shift bullish. Like this isn't really the cleanest. It's like, it's still like relatively rangy. But we took out this low into taking out this high. I think on this, I might look for like an hourly level. Okay. Just for like some further sort of confirmation. Okay, we did come into an hourly level and rejected it. I mean, I might put my stop loss a bit tighter. I'll probably target like a pullback here. So we'll just do that. On that second shift, so we had a really clear shift bullish here. We're looking to correct this like extension as well. And we had overall structure shift a bit bullish as well. And overall high time frame is a bit more bullish. It's ranging. And also this is the hourly open and you've extended. So around the second half of the hour. So the hourly kind of opened, extended, push bearish, looking for a reversal back in towards the midpoint of this hourly candle. And yeah, played out pretty nicely. So the what wasn't that clean. What is the direction? What is the condition? Wasn't that clear, that obvious. The AOY, what felt a lot more obvious, like this previous bullish move, looking for correction back in towards 50% of that. We had a hourly level stacked with that as well. The how, I liked the how. So the candle opened, hourly candle opened and overextended for the first half. And we looked for a reversal on the second half in towards correcting that move. We were too imbalanced. We stretched too far in one direction. And then we had a second shift entry model. So a lower time frame shift of market structure. So that's a pretty nice sort of entry as well. So it looks, yeah, relatively rangy. So we are definitely moving a bit more bullish now. I mean, this definitely could this could potentially continue pushing bullish. I mean, it's just like quite low volume now. Like I want a bit more of an extension. Like I want a nice how into my area of interest. This is quite low volume. So I want some more volume to come back in. Holy. This is a big extension. This is the alley open. I don't like this though. This is quite like low volume. Yeah, I mean this was the next hour. So didn't really play it high liked. I mean I probably could have got an entry back in towards 50%. I just didn't like the rangy sort of condition. But yeah, it is what it is. Okay, we're now in New York, so I might just wait. Um Went into Asia session. Holy volume, Batman. So we are in second half Asia. Okay, second half Asia. What's the direction? What is the condition? Obviously, quite looking quite a lot more bullish. Very high volume over kind of like a bit lower time frame. We did break out of this range here. We are extended above highs. We could look for a bit of a pullback in towards, a bit bearish. It's just a big range. Yeah, it's just very high vol. I don't like these massive sort of ranges. It's like too big of a range for me a little bit. Like I want to wait for like some like lower time frame structure to form. But this is like a very big sort of structure to the left hand side. Jesus, look at that volume, man. Interesting. Okay, we've been pushing extremely bearish. Holy shit. So ever since Tokyo session opened, so Tokyo opens are like around here, we've been just pushing extremely bearish. Most of the time when this sort of happens, when you have Asia push really directional, really trendy, London tends to give you a nice reversal setup. So we'll look to see if we have a bit of a reversal. Obviously, direction is now bearish. We've taken out this low. We've had a big high time frame shift bearish. We could potentially look for a bit of a correction back in towards 50% of this move. And we are kind of approaching London session now. So we could look for a bit of a correction. We've taken out this high here. So we've had a bit of a correction here. 1730. Okay, I've taken out these highs. I've taken out these lows. So low time frame is a bit more bullish. Let's see if we have a pullback into 50%. It's be a bit kind of like a fractal shift, hopefully. It's a bit low volume. Okay. Not bad. Okay, this might be a different type of trade. We did come into 50%. We had a really nice reaction here. We had another shift. So we've had this shift where we've take out these highs, came back into 50%. We've had a shift within that shift. So let's see if we can have a shift within this shift as well. That would be very nice. Okay, we're coming into 50% now. So what I'll do is I'll drop down onto the seconds. This is a nice extension into that as well. So if we see if we have a second shift, that is a second shift. That's looking good. Okay, so we have this bigger shift, we have this smaller shift, and then we have the even smaller shift to, and this is all to correct back in towards this even bigger shift that we're trading against. So correcting back in towards 50% of this. This is pretty rare. I mean, it happens like, I don't know, maybe like 5 or 6 times a year. So what we can do is I might just say fuck it and go balls deep on this. I might put my stop below that low. So we can actually target 50% of that. So I mean, I don't know if I should go for this. This is a 1.7. I don't like big risk rewards. I don't think most people should do that. Like this is like once or twice like a year that I get this set up. But it's a shift within a shift within a shift, correcting back into 50% of like a bigger shift. Like this is like once in a blue moon threading a needle. And so it's a big risk reward, but I mean, we'll see what happens. I might give it a bit more breathing room. I don't need a fucking 1 to 7. I wouldn't be surprised if this lost though. I mean, it's good, but so many things need to align for this. It's just really clean. It's like a really clean shift. Oh my god, boom! That's actually really nice. Yeah, so this is kind of a bit of a fractal shift entry. This is kind of like it's like a high time frame trade of the exact same thing that I look for. So when I was like the previous trades, it was like an alley candle opening, extending one direction, and then looking for a second shift back in towards 50%. Think of this as like the daily candle opening, overextending massively, and then looking for like a shift back in towards 50%. And then here you just have like, a shift within the shift within the shift. And so it's pretty rare that you get this. But holy fuckamole. I mean, and then you could even look for like a shift within this or a continuation. Here, so we have a shift within this. So we would then want to look for a shift here. Okay, that's a decent sort of shift. Oh. So I could get a entry on that. I might put it above this high. I don't know what I would target on this. I don't know what I target on this, but this is kind of a similar sort of thing, where you have, this bigger shift, and you have, the shift within the shift that came back into 50%. This is more like a pro direction continuation sort of trade. Oh, is it going to go in our favor? It's kind of struggling to break those lows. Ooh, damn! I'm fucking on fire today, yo. Holy shit. I'm kind of fucking clapping this shit. I mean, this is pretty rare that you get something as clean as this. I mean, like, it's pretty rare that you have shifts as clean as that. Like, those are really fucking clean shifts. But yeah, I mean, like, I guess this is a pretty good example. Like, I really I use shifts for everything. I use shifts for direction, for entries, for where I want to enter. You can use it. You can use like one very simple concept or pattern in so many different ways. Okay, so this is counter direction. That we could look for a buy here. We are below lows. I mean, I probably could have held this sell a lot as well because it's on a bigger shift. I probably could have done that, but it is what it is. I mean, I could look for a buy here. I wouldn't say this is the cleanest shift though. Like this is the high. This is the low that we broke. You'd want to take out this high into coming back. Um, I mean, we are in the AMs. This is fucking 3 a.m. New York session, so I don't know. I don't trade New York, so we'll just wait. Okay, second hour of Asia. Still bearish. In that kind of bearish trending range though, we've just taken out this low, so we can look for a potential correction. Um, okay, we have a shift here. Very holy volume, Batman. Okay, we don't correct back in towards 50%. And that forms an even bigger shift because we've taken out these highs now. Now I'm feeling over a bit more bullish, very high volume. I wouldn't say I'm the biggest fan of this sort of condition. It's very big ranges, very high volume. We have a shift here. Do we get a pullback? We don't. Okay, I'll go fuck myself. I mean, you have a pullback on this. We never corrected back into 50%. We could look for maybe, I mean, maybe a potential sell. This is a new hour open as well. Do we push a bit bullish? So this hour candle, what did the previous hour candle close? Okay, previous hour candle closed bearish. We have a level here. We've created a bit of a top wick here. Okay, do we have a second shift? We do. Do we have a pullback? Please? Okay, thank you. Do we have a reaction? We don't. We just fucking boom straight through that. And I mean, now we are coming into the level a bit more, so maybe we'll have a reaction. I mean, that's looking decent. We've taken out this low here. Taken out this low here. Even better reaction. Pull back, please. Thank you. Reaction, please. Yeah. I'll take it. I mean, that's gonna be a fucking massive stop loss. What am I targeting on this though? I mean, this is a bit bigger of a move. I'm not as confident on this. Might just go for like a 1-to-1. Okay, so we are like relatively rangy on this. It's a pretty big sort of range. And so I waited for a bit more of a confirmation. So we have this 1 minute shift, this second shift within that, in reaction to this hourly level with the previous hourly candle closing in our direction, in our favor. So we've created that top wick first, just looking for a bit of a move back in towards like, the midpoint of this range here. And so we'll kind of see what happens. Okay, maybe I should have. I know it wouldn't have hit my take profit anyway. Please, please. No. Okay, that's unfortunate. I guess my discretionary take profit would have been a bit better, but it is what it is. Took a L on that. Unlucky, man. Unlucky. Yeah. I mean, this wasn't the cleanest sort of condition, but it was a decent sort of risk reward on that. I'll just wait and see what happens. I'm not the biggest fan of this like tight little range. Yeah, it's pretty mid price action, so I'll wait. Oh. Okay, second half Asia. We are in a bit more of a range now. We're a bit extended below lows. But it's definitely a bit more rangy. Jesus Christ. Okay, that is really high volume. I want to wait a bit for that for structure to form on that. Yeah, but this is New York session again. Okay, that was really high volume that day. I'm just not looking to trade that. Okay, a bit nicer of a range. Coming to the highs of this range. 43 minutes into the hour. We get a shift. 52 minutes into the hour. I mean, we have a shift. I mean, okay. So, what are we thinking? Relatively rangy, a bit of a bullish bias on it. We are extended above highs. We could look for a correction back in towards 50% of that of the range. Have a decent sort of stretch extension to taking out those highs. This is more of like a second sort of shift. I might just give it a bit of breathing room. I'm not the biggest fan of going for big risk rewards on these sort of, counter or it's a bit counter direction sort of trades. That is not great. This is going to be a loss. Yeah. Unlucky, man. It's very high volume. Yeah. I'm going to wait. So 2 losses in a row. Unfortunate, man. Just not the sort of condition I should be trading. So wait till second half Asia. Yeah, it's kind of tough. Taking reversals in these sort of conditions, like these massive sort of ranges, can just be more likely to lose. But it is what it is. Coming into around some lows here. Okay, I've had a bit of a shift bullish at the low of this range. Okay, so this is definitely quite rangy. I wouldn't say there's a very clear direction on this. We just want to looking for corrections back in towards 50% of the range. We didn't really correct back in towards 50% of the range. I mean, we kind of corrected into this sort of move. The previous hour closed in our favor. And we're creating a bit of a bottom way. I'm just not the biggest. I mean, we already kind of corrected back in towards 50% of this move here. Yeah, man. Yeah, I'm not the biggest fan of this sort of condition. Really high volume again. Damn. A bit of a rough patch recently. I might just wait for some structure to form, man. Like these massive sort of ranges are a bit tough to look for reversals on. Nope. Big ass range. Okay. Let's wait for some range, some like a middle time frame like range to form over like 10 plus hours would be nice, please. Like these have been very big ranges. I want something a bit more like this, maybe. That would be nice. Please, gold. Okay, coming into second half Asia. Okay, this is a bit nicer. We are looking a bit more rangy, a bit tighter of a range. So we'll see what happens. Nice extension into the lows. Is there a shift that forms? Not really. Okay, a bit of a bigger shift. I think I could take a buy on this. Okay. What do you think in chat? I'm alone. No one's here to talk to me. I don't have a chat. Yeah, I think this is relatively rangy. Back in towards 50% of this would be decent. It's a pretty decent sort of risk reward on that. I mean, I probably could just go lower, around a 1.5. Okay, we'll see. Let's go on this one. It's pretty rangy, man. Okay, comes back in towards 50%. So middle time frame condition was relatively rangy, a bit more on the bearish side of things, but we're looking for a bit of a correction back in towards 50% after this big extension into range low, taking out these lows. We had a 1 minute shift with a second shift within that. Pretty nice 15-minute candle behavior on that as well. 15-minute candle opens around the second half. You have that shift bullish as well on the seconds. So yeah, I think I might end it there. How did that go? Took 8 trades, 75% win rate, average risk reward of 2.48. It's a bit skewed by that one big trade. Normally I don't target that bigger risk reward. I feel like subconsciously I target bigger risk rewards when it's back testing because I can just like skip through trades. Like it's, you know, there's no patience needed at all. But all the trades were in Asia, most trades in Asia, some in London. Average RR, yeah. So average RR will always be bigger for me in London session because you have those big daily moves, and there's big fractal shifts that most likely happen in London session. But yeah, okay, nice. So that's a bit of a breakdown about how I do the market structure candle behavior, what, where, how, and when. I mean, that might be a bit confusing to you because you're watching a video. You need to practice this. It's a skill. You need to take action on this. So I hope you find this helpful. This is why like all my students that I do that join my program, like I give personalized feedback on it because the only way to learn the skill is to do it and get feedback on it. And you know, you don't need more knowledge. Like this is a lot of knowledge. You kind of need more understanding and get that through taking action on that, using more active learning methods, getting feedback, you know, either from reviewing your trades yourself in your own journal, seeing what you could have done better, what you can, you know, improve, or trying to, you know, discuss it with a friend who's also trying to learn the same strategy as you and see, you know, helping each other out or getting someone further ahead of you to help you out as well. But yeah, just take action on this, you know. I've kind of broken it down, but you know, start filling out the trading journal, take some trades, journal every single trade you take. If you just do that, you'll become profitable over time. You'll get the experience. You'll get better over time. You're not going to immediately get it. You're going to get a bit confused in the beginning. It's going to be a bit overwhelming. That's because you're learning something new. That's a part of the process. That's not a bug. It's a feature. And so just take action on this. Take a lot of trades, journal those trades, review it. And that's how you actually learn this. That's how you actually get good at technical analysis. Understand the concepts I talked about through taking action, not watching more videos. But hopefully this is helpful, putting you in the right direction and you have more clarity over what you should be doing. And I'll catch you guys later in the next video. Okay, what is up? So now we're going to cover risk management. I have so much that I want to cover here, and it is by far the most important part of trading. Building an edge, you know, having good technical analysis, that's all about putting probabilities in your favor. Risk management is actually about profiting off those probabilities. You don't make money in technical analysis. You make money through your risk management, kind of like a casino. You're not going to win every single trade. A casino isn't going to win every single blackjack hand or roulette spin. If they were to risk too much on any single spin or trade, that's how you go out of business. You can have a profitable strategy. You can have one of the most profitable strategies in the world, but you still won't make any fucking money if you risk too much. So we'll go through this. So technical analysis only puts probabilities in your favor. Again, risk management extracts profit from the probabilities. So let's just go with an example here. We have two traders. Trader number one here, they both have the same risk reward and same win rates. So 10 trades, they both win 5 and they both lose 5 with a 2R, so 2 risk reward strategy. So they should be making money, they should be profitable over time. Investor one risks 60% of his account to win 120%. Investor two risks 5% of their account to win 10%. So same profitability, same expectancy, everything is the same, but the percentage that they risk is different. Investor one on the first trade, they win $12,000. Amazing. $12,000, Jesus. Investor number two wins $1,000. So a lot less, only 10% of the accounts. And so now the first account balance is up to 22,000. Second is only up to 1,100. On the second trade though, they both lose. But because trader one is risking 60% of his account, he actually loses more than his first trade. He loses 13,200 because 60% of 22,000 is obviously a lot more than 120% of 10,000. Maths, amazing. And so the second trader risks only 5% and they lose $550. So obviously they're back down to 10,450. So they're still up on the account. They haven't gone into drawdown, whereas the first trader has gone negative on the account, all the way down to 8,800. And so by the end of these 10 trades, same expectancy, same risk, same amount of trades won and lost. The first trader, who's risking 60%, is down to 5,000. The second trader, risking 5%, is up to 12,000. So over double the account size just through risk management. And so this is kind of going back to the point that trading and risk management is about, trading is all about making money. Risk management is all about, actually profiting off probabilities. But the goal of risk management and trading is never that we're never trying to make as much money as possible. We're never trying to have the biggest returns as possible. We're always trying to maximize our risk adjusted returns. So we want to maximize our returns, minimize our drawdown, our max drawdown as much as possible. How much do we make in regards to our max drawdown or, losing streaks? That is the most important part. We want to limit max drawdown as much as possible. It doesn't really matter if we're making that much. If we can limit how much we lose, that is, the most important part. This is because as you go further down into drawdown, as we go into 10%, we have to make 11% to get back. As we go into 30%, we have to make 43% to get back. So we have to make more than 30% now, or like almost 1.5 times as much to get back to where we were. If you go down to 50%, you have to double your account now to get back to where you were. So the further you go into drawdown, the more you're going to decrease your profitability, decrease your edge, and it gets harder. It's a negative spiral. It gets harder to actually get out of it. If you go into 90% drawdown, you've pretty much blown your account here. Having to make 900% to get back out of that, it's just unlikely. Better off going to fucking McDonald's and getting a job. So as well, going back to this, all mistakes in trading come from trying to maximize returns. Like the worst habits you have in trading is because you're solely focused on your returns and not your risk adjusted returns. I'm not trying to make as much money as possible. I'm not trying to be the most profitable trader. I'm trying to have the best risk adjusted returns. Okay, so trading, making more money is all about protection of capital first. We're not trying to be the best traders. We're not trying to have the most profitable trades or make the most money. We're trying to first and foremost protect our capital because trading is a different type of game to other endeavors. Because making the most money now is not the goal. We want to stay in the game long enough for compounding to take effect. So making money in trading is not linear. We like to think of it as linear, like most things in life are linear. In a job, it's pretty linear. You start off with maybe, 50K per year at an entry-level job. You're a couple of years in, maybe that gets bumped up to 60K, and a couple more years, 70K, a couple more years, 80K. It's pretty linear here. But trading, you start off really slow. You just need to stay in the game long enough for compounding to take effect, 1%, 1%, 1%. And then nothing happens for years. And then within a couple of months, everything happens and you're an overnight success. So it's really important to understand that trading is exponential, not linear. And making more money in trading is a byproduct of having a big account, not by making bigger returns or taking more trades. because if you have a $5,000 account and you make 5%, that's $250, pretty good. But if you have a $200,000 account, that's 10K. So the whole goal is to manage risk to be able to survive to the point where the compounding has taken effect. You're up to that, big account, and you're now, making a large amount of money as well. Like, the reason trading is so hard because it isn't really because it's, anything about trading. It's because a lot of people or traders come into the game undercapitalized. They're trying to get into trading. They don't really, maybe they don't have a job, or they don't have much money at all. They're broke, in debt. That is probably the worst thing to do. And they're trying to dig their way out of that through trading. But the less money you have to trade, the harder trading becomes, because the less money you have, subconsciously, you'll go for big returns, you'll over risk, and you're more likely to blow up, lose money. The less you need money in trading, the more money you're going to make. It's a bit fucked up. So this is why setting yourself up, setting up your personal life to a point where it's actually at a stable area before you get into trading is really important. So trading improvement and self-improvement are very hand in hand. If you don't have a job and you're trying to trade, please just fucking get a job. You need another source of income. The more you focus on trading, the more you try to focus on making money in trading, the more likely you are to lose money. Making money in trading is best pursued indirectly. Okay, so and we'll go back to this. The only way to have a bigger account is to either have more money from other income sources to put into trading, or just have the trading account for a long enough period of time where the time plus consistency scales and compounds over time. You're not trying to be overly aggressive, not over risk. You're just trying to stay in the game long enough for compounding to take effect. And so I'm not trying to be the most profitable trader. I'm trying to be the most consistent trader over the longest period of time. For example, equity progression. We can start off with around 10K here, get up to fucking, around 2 mil, as this is 260K. I think that's 2 mil here. And it's just, it's a long-term game. It is the hardest way to make easy money, but once you get it, it is the easiest money out of any sort of fucking endeavor. And so you're not trying to chase the biggest returns, biggest months. Most traders fail to make any money at all because they're trying to be too profitable. You're trying to make too much money. When I stopped trying to be the most profitable trader and I started trying to be the most consistent trader, that's when I actually started finally to make money, and make more money, because it just compounds over time very quickly, especially with prop firms. You can scale up very quickly as well. So longevity is the name of the game, trying to be the most consistent trader possible and not treating it like a linear game, not forcing returns too early or oversizing to speed up growth, or recover losses quickly. It'll just destroy all these mistakes. You'll dig yourself a hole. And yeah, so think of trading like, you go to university, you do a 3-4 year degree to become a lawyer, or you go to med school, the whole process takes like 8 years to become a doctor. Trading is very similar. It is a long-term game. If you want short-term money, go fucking gambling at a casino. It'll be more fun, or go get a job. You make more money doing that in the short term. Trading is a long-term game, and so treat it like one. Okay, so a big point of trading is what is more important, win rate or risk reward. We'll cover this a bit later in more detail, but the most important thing is neither. It's kind of your expectancy. So how much do you expect to make off any one trade? So it's win rate versus risk reward. The combination of them is what actually matters. Your profitability of your edge is defined by your expectancy, and that is the combination of your win rate and your risk reward. So it's just the win rate times your average win minus loss rate times average loss. For example, if I have a 50% win rate with a risk reward of 1 to 2, so I win double my risk. Every $1 of risk gains 2 of profit, but I only win half the time. If I risk $100 to make $200 with a 50% win rate, that is a 50 per trade expectancy. So if I took 100 trades, I could expect to make $5,000 in profit. So it's kind of like the value of each trade. That's the expectancy. So you want the expectancy to be higher than 0. If you have an expectancy of 0.1 and you risk $100, you make $10 per trade, or the value of that trade will be $10. And so you just want to take trades that have a positive expectancy, or a higher than 0. And yeah, that is kind of like the profitability of each trade, or the profitability of your strategy, your system. And it is really important that you know that you have a positive expectancy. There's also another sort of thing called profit factor. This is different to expectancy. This is the ratio of your total gross profit versus total gross loss. This isn't actually that important. It's sort of a lagging, ratio. It's more attached to your account, not trade by trade. It's just the overall efficiency or system efficiency. We'll cover it in a bit more detail, but yeah, expectancy is value per trade. Profit factor is just, have you won more than you've lost? We want to focus more on expectancy. This is the most important thing, and making sure we take trades with a positive expectancy. Taking trades with a positive expectancy is kind of like you're the casino and someone's spinning roulette for you. You have the green, which puts probabilities just in your favor. We just want probabilities just in our favor. We just want just above a zero expectancy, and if we just do that consistently, we'll make money over time as well. So yeah, we've covered that. Okay, so probabilities. Trading is a game of probabilities. This is kind of why it's harder than other games, because you have to keep in mind, as humans, we're not good at thinking in probabilities. You need to understand the probabilities of your system, though, for anything in risk management to matter. Like hopefully, in setting up the trading system, setting up the trading journal, the trading plan, you get that set up and you consistently journal your trades, because you need to understand your win rate, your risk reward on average, to actually, be able to manage risk effectively, or have realistic expectations, or to be able to think in probabilities, you need to actually know the fucking probabilities of your system. But going back to this, every trade you take is random. Every, moment in the market is unique. Anything can happen. Really, anything can happen. So think of each trade like you're flipping a coin. You just want it to be, a little bit weighted in your favor. And every single trade is statistically independent. Even if you go through a 5 losing streak, the next trade you take still has the exact same probabilities. Exact same probabilities. It doesn't matter. Like the gambler's fallacy around, okay, we've had, 5 blacks on the roulette table. Next one's going to be red. Not really. That's not how it works. It's unlikely for you to go through those big losing streaks, but on an individual basis, it doesn't change the probabilities. So the last trade you take does not affect the next one. This is why it's important to be consistent with your risk management, because every trade is independent and unique. And a win does not increase the probability of another win or another loss. And going through a losing streak doesn't mean you're due for a win, so you shouldn't size up when you're going through a losing streak as well. That's a big mistake. So even if you have a 60% win rate, it doesn't mean win, 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 and then loss is loss. This is what people expect. I have this and then this. In reality, you can go through streaks and stuff. It'll be randomly distributed. So random in the short term, it'll be random distribution. Over the long term, over 1,000 trades, it'll get closer to the actual statistical, the actual reality of it. So, you can take 10 trades, and based on probabilities, even if you have a 6% win rate, you could only win 4 trades of those 10 trades. If you take 1,000 trades, you might have won 590. So the more trades you take, the more likely you are to get towards a statistical, like the actual edge. And so that's why we need to take a lot of trades, collect a lot of data to actually understand. And in the short term, nothing really actually matters. It's always going to be uncertain. You never know what's going to happen next. And as well. So law of large numbers. This is kind of the thing that fucks a lot of traders over. So the more trades you take, the closer your results will get to statistical average. That's kind of what I was talking about. But only if you don't change risk, don't skip valid setups, do not revenge trade, and do not increase size emotionally. So you need to just be as consistent as possible. Your job as a trader is not to make the best decision, it's to make the same decision every single day. You're not trying to be perfect. You're trying to be consistently good. Do the fucking same thing every single day until it's boring. Okay? So it's just like, you're trying to be too smart, overthink things, or trying to avoid problems that you think are problems, but are actually just, trade-offs, or, parts of your system. It just fucks with you. So do not change things. Just keep 95% of the shit the same, please, especially in risk management. Okay, so trading isn't about being right. This is why doctors tend to be the worst traders, because they're constantly trying to be right, because if they're not, people will die. When you take that same sort of mindset into trading, when you're trying to be right, you'll just fucking lose money. You're not trying to be right. You're just trying to have a little bit of probabilities in your favor. It's okay if you're wrong. Really, that's important. So you're just trying to execute the same setup in the same conditions with the same risk over a large sample size. If you just do the same shit, you have consistent results, you will get consistent outputs, and you'll be a consistently profitable trader. Okay, so it doesn't matter what happens trade by trade. It matters what happens over the next 50 or 100 trades. That's where your edge shows. And so taking a long-term view of things, law of large numbers as well. So treat your trading like a business, especially in risk management. Losses are a cost of doing business. It's the business expenses. Okay, so if you cannot emotionally tolerate 3 losses, 5 losses, 8 losses in a row without changing anything at all, you shouldn't be trading. You should go back to Macca's, flip those burgers, or you should just decrease your position sizing as well. That might help. So, if your position sizing is too large, or you might actually not know what your average win rate is. If you have we'll go through this a bit later. I won't, the lower your win rate, the more you are to go through bigger losing streaks as well. So you need to have realistic expectations around your win rate, your losing streaks, max drawdown, everything like this. Okay, so yeah, we'll cover this a bit later, but think of trading kind of like you're a business owner. If you've owned a business before, you probably have better results in trading because it's based on taking risk, probabilities. The average person isn't good at taking risk. The average person going through school, into university, into getting a job, they're never actually taking risk at all, really. Like once you go to try to start your own business, have a job, or try to start your own business, do something with lots of uncertainty. Getting good at that as a skill, risk taking as a skill is extremely important. Being able to deal with uncertainty is extremely important for trading, for business, for even going on dates, putting yourself out there. It's one of the most important life skills, taking risks. But I digress. Trading is like a coffee shop. You have rents, staff wages, coffee beans. I love coffee. Electricity, and you have all these costs of doing business. In trading, it can be losses, it can be commissions, it can be spreads, prop firm fees. But these are all fees, costs of doing business. Okay, so if you lose, it's just a cost of doing business. There's nothing wrong. I do not cry about paying rent. I mean, I kind of do sometimes, but it's just the cost of operating. It's an expected expense. People just don't expect to lose. That's why they think it's something wrong. Like if you want, the easiest way to have high resilience is just to lower your expectations. So losses are just operating expenses. Wins are revenue. If you want to profit in this business model, we just want to make sure our revenue is higher than our expenses, and that will be our net profit, same as in our sales from a business. So think of every trade as well, like you purchase a product for a certain amount. You have cost of goods, and then you sell that product. So think of the cost of goods, cost of making that product as you taking the trade, that expense, your stop loss. And then, you could sell that product, make money, or maybe no one buys it and you lose money on that. Every trade you take is just like you're purchasing information, you're purchasing an opportunity. When you risk $100 on a trade, you're not, losing $100 if it takes your stop loss. I think of it like I'm paying $100 to test my edge, to execute my system, to participate in this opportunity. Once I take the trade, once I set my stop loss, and I set that $100 stop loss, that money's gone. Like I think of that money's gone. If I make it back plus more, amazing. If it's my stop loss, okay, that is expected. So you're buying the opportunity, you're buying the information, buying the data point to participate. If it wins, you generated that revenue. If it loses, you just paid for that information, the opportunity, that setup. That is okay. So you just executed your business model. It's cost of doing business. It's kind of like the invoice. You get invoiced, and you're just paying $100 for the opportunity. Okay. So the moment you place the trade as well, assume the money's gone. Simple as that. Okay. Attaching yourself to each trade wins equals, I'm a Sigma sexy ass, person. I'm so skillful. I'm so smart. If you do that, the losses are going to be heightened. If you lose, you feel like a failure. Losses do feel bad, but yeah, it's important to detach yourself from each outcome and to have low expectations. And in general, trading is all about being able to be uncertain. If you don't like being uncertain, don't trade. Do something else, please. Short-term uncertainty leads to long-term certainty. If you don't know, like, you shouldn't know what's going to happen next in each trade. Like, you don't know what's going to happen. But if you consistently execute in uncertainty, you just do the same thing at the same time in the same condition every single day. Over the long term, you can guarantee yourself you have certainty that you'll make money through having an edge, journaling, refining, backtesting, improving over time. So focusing on a large sample size, 100 trades with the positive expectancy. Each trade doesn't matter. If it does, you're risking too much. And it's as simple as that. So you need to be able to tolerate short-term randomness, and then that'll lead to long-term stability. Okay, streaks. This kind of ties into law of large numbers and win rates. Losing streaks and drawdown periods are inevitable. You can't avoid them. If you try to avoid them by changing things, that means you're just going to be unprofitable because you're inconsistent. And if you want consistent results, you want consistent profitability, you have to have consistent actions. So removing a stop loss, doubling down on a trade, over risking to try to get out of drawdown by trying to avoid something, like whatever you avoid controls you. So just don't fucking try to avoid drawdown, befriend it, try to rizz it up a little bit. Get used to being in drawdown because it's a normal part of trading. If you can't handle it, again, there's always macros. So yeah, obviously it's not comfortable to be in drawdown, but you need to have realistic expectations. If you have around a 50% win rate, and this is over a 50 trade period, if you take 50 trades, that could be 2 months. If you're taking a trade every single day or 1 or 2 trades, so every 2 months you have a 97% chance of losing 6 trades in a row with a 50% win rate. It's not a bad win rate, but you have a 97% chance of losing 6 trades in a row. And this could happen with a profitable trading strategy. So it is extremely important to have realistic expectations. Can you go through 6 losses in a row and not change a thing? If you do, that's a mistake. That's the issue. Okay. So, and this is you being a profitable trader, you making money consistently over time. You're going to go through 6 losses in a row. That's just the basic probabilities of it. When losses happen, when drawdown happen, when losing streaks, happen, do not change a thing, please. You're going to want to change something. If you go through 6 losses in a row, you probably think, this isn't working. I'm doing something wrong. I hate my life. You're going to start gooning. Just please don't change a thing in your trading process. Just stick through it. Inevitably, you'll come out of this drawdown period. It won't last forever. And this is, the bad periods are one of the best periods for learning and growth. So this is where the part where most traders actually fail. They don't fail because they go into drawdown periods. They fail because they're affected by drawdown periods. They react negatively to these events. So if you have a 50% win rate, you have a profitable system, but you still go through 6 losses in a row. We talked about that. It's not a bad thing. This is your system actually working. So you being a profitable trader means you have to go through 6 losses in a row and not change a thing. If you do deviate from your system, from your strategy, they might go through 3, 4, 5 losses in a row. They might tend to risk more or increase their risk reward. So if you risk more or you increase your risk reward whilst you're in drawdown to try to get out of it quicker, a lot of people tend to, if you go through 3 losses in a row, if you're risking like a 1 to 1.5, now you're risking a 1 to 2, a 1 to 3, because I want to get out of this drawdown as quickly as possible because it's uncomfortable to sit in drawdown. And by doing that, by increasing your risk to reward, you decrease your win rate even further because they're inversely correlated. And so that will go through spirals. This is how people turn 6, on average of 6 losses in a row into 10 losses in a row through either over risking, having too tight of a stop loss, or having too big a risk reward, going for home runs. They just negatively spiral, and it's just a negative feedback loop. and they just get fucked on. Really, it's as simple as that. So streaks, they're gonna happen. It's inevitable. The important thing is how you react and not try to avoid them, and just keep doing the exact same thing. Okay, so going back to this, trading is all, I mean, risk management and trading, but risk management is a balancing act. You're always trying to balance a couple of different things. Kind of like how we talked about earlier, the goal is not to maximize our returns, but maximize our risk-adjusted returns. We're trying to make as much money as possible, but we don't want to make as much money as possible whilst also having a massive max drawdown. So we want to maximize this, minimize drawdown, and it's a trade-off between those two. Because bigger returns lead to bigger risk. How can we have bigger returns whilst limiting our risk? That is, the core part of risk management, and where most people go wrong by over-risking, leading to too much risk, trying to make too much money, and they just get fucked by the markets. No protection at all. So making 20% in a month, might think it's impressive, but means jack shit. It's actually fucking easy to make 20% a month if I'm risking my whole account. How much did you risk to make it? What was your drawdown? Is it repeatable? One trader made 20%. Most people might look at that and say, oh, amazing. But they had 18% drawdown. 18% drawdown. You're barely above, 1x risk-adjusted return. Trader B only made 12%, but they had 4% max drawdown. So they made 3 times as much as their risk. Quick maths. So Trader B made less, but they are a better trader than Trader A. If you're trying to pass a prop firm challenge, Trader A would fail, Trader B would pass. And this person made more money or had bigger returns than this person. This person was more profitable than this person. But this person actually makes money. They actually pass prop firms because they have a bigger risk-adjusted return. They don't make more money or make bigger percentage, but they have better risk-adjusted returns. I'm repeating myself a lot. Oh well. Yeah, so a lot of prop firms, whenever trading with unlimited money or unlimited drawdown, because the deeper you go into drawdown, the harder it is to get out, and this will fuck with your compounding. This will fuck with you passing prop firms, because if you go 10% past 10% max drawdown, you just blow the prop firm. If you go to 15% max drawdown on your personal account, you have to make double to get back. And then so that'll interrupt compounding on your personal accounts. It'll blow prop firm accounts. So it'll just interrupt scaling and compounding over time. It's the worst thing you can do. So trading is never about making as much money. It's about how much you can make in relation to your drawdown, risk-adjusted returns, because you don't have unlimited capital. Unfortunately, it'd be amazing if we did, but yeah. Especially when you're trying to pass prop firms, you're not just trying to make that 6% to pass a futures prop firm. You have to make that 6% whilst adhering to a 4% max drawdown. So futures prop firms tend to have a 4% max drawdown. Forex prop firms tend to have around a 8 to 10% max drawdown. So it's never about passing or making 4, 10%. You have to make that percentage whilst only having a certain amount of max drawdown. So pretty much on a futures, you have to make 6% with 4% max drawdown. What it actually means, on a 50K account here, 4% is 2K, and you have to make 3K here. So technically, you have to make 150% on that actual account balance. So a 50K with 4% max drawdown is $2,000. Your actual account balance is $2,000. You have to double that, over double that, double it in half to 3K. So 150%. So this is why risk-adjusted returns are so important, because you can be a consistently profitable trader with an edge, with a profitable strategy, but you still lose money with prop firms if you're unable to stick to the max drawdown. They also have consistency rules as well. So, and trailing Apex or Take Profit Trader, they have trailing drawdowns. It's even harder as well. So it's extremely important. With risk management, I'll just end off this video with, there are 4 main variables that we want to consider and that we'll cover in the next couple of videos. You have your win rate, your risk reward. These are inversely correlated. The higher your win rate, you need a lower risk reward. the higher your risk reward, the more likely you are to have a lower win rate. And then position sizing and drawdown are also inversely correlated. The higher your percentage, size, if I risk 1% versus 2%, obviously risking 2%, I'm going to have higher drawdown. So they're positively correlated, I guess. So higher percentage sizing leads to higher max drawdown, likely to have a higher max drawdown as well. So good risk management is all about understanding your edge and understanding how to balance win rate and risk reward and position sizing and your max drawdown to be able to pass prop firms, compound your personal accounts quicker, as quickly as possible, but whilst also limiting the probability that you blow that account as much as possible as well. So we'll go through a couple steps. With an edge, you can use lots of different types of win rates and risk rewards. But first, we want to define what our win rate and risk reward is from that data. So building an edge through that trade journaling system, having a trading plan, having an edge that is backed by data that you know the win rate and you know the risk reward. If you don't know the win rate, the risk reward of your system, of your trading, you will not make money. You will not be profitable. You will just, there's so much, on the table that you're leaving if you don't know these basic statistics. And so most traders don't know their win rate and their risk reward. If you don't know these things, you're not going to make money or risk, the right amount as well. And I'm not going to go talk about the same things like other fucking gurus online. Just risk 1% per trade. That is retarded. It doesn't when you actually understand the statistics, there's so much nuance around how much you should risk. Risking just 1% per trade doesn't really make sense for a lot of people. And, we'll cover this next video, but just risk a minimum of 1 to 3 risk reward. You only have to, win a third of your trades. A lot of people say that as well. These people don't fucking trade. If you actually understood the statistics, you wouldn't say that. These guys don't trade. I'm crashing out, but I've done a lot of learning about the actual maths and statistics behind trading, and it will surprise you. I'm excited to cover this in the next videos. But yeah, really important to define this because this will affect your max drawdown a lot and how much you can actually risk as a position size. So we want to define that, calculate our expectancy, calculate expected losing streaks, and then choose a position size that keeps the max drawdown tolerable, but gets us to where we want to be in a good amount of time. We don't want to take too long, otherwise you get impatient. There can be psychological issues that arise there. But yeah, so this is a bit of a breakdown, some of the basics of risk management and why it's so important. Understanding your expectancy, win rate, risk reward, limiting drawdown as much as possible is so fucking important for both your psychology and actually making money. In the next video, we'll cover win rate versus risk reward because you actually get to choose how much you win and how big those winners are. You get to choose. You actually get to choose your win rate based off how much you target with a risk reward and vice versa. So you need to make sure you choose the right one because most people choose ones that are psychologically brutal without realizing it. Most people can become profitable in one simple, easy change. They just need to make sure they're targeting the right risk reward. If they just did that, they'd make money. It's just one simple change. If you do it, you make money. You'll become instantly profitable. So we'll cover that in the next video. Okay, so now we're going to cover win rate versus risk reward. This is going to be really juicy. I fucking love this topic. I've loved breaking this down, learning about it, actually understanding the statistics because when I first started trying to learn to trade, when I was trying to become a profitable trader, a lot of content creators, fucking gurus, told me to target high risk rewards. You're told, the higher risk reward you target, the less you have to win. It's easier, target a minimum of a 1 to 3, target a minimum of a 1 to 5. You only have to win 30, 20% of the time. Take so much pressure off. It'll make you more profitable. You make more money. And yeah, it feels nice. It sounds nice to have those big winners. It looks nice. You can take a screenshot and you can post it in the Discord, send it to your friends. And it feels good. But it fucking ruined me. It is the biggest piece of bullshit I've ever heard. And I'll show you. I'll break it down exactly with actual statistics showing you that the bigger risk reward you target, the less profitable you become. It actually decreases your profit factor. It increases your max drawdown. And this is actually based off statistics. This isn't based off like, just assumptions from these fucking gurus that actually don't trade. This is based off, first principles thinking, maths and data. So what is best, win rate or risk reward, or the combination of both? What even is win rate and risk reward? So think of your risk per trade as your stop loss placement. So how much are you risking on your stop loss as a percentage of your account, or in regards to your take profit, your reward here. So if I risk 10 pips, 10 points to make 20 points, 20 pips, I have a 2 risk reward. So it's just the relationship between how much you lose when you're wrong versus how much you win when you're right. And it can be a dollar amount, percentage, pips, points. I think it's best to be a percentage amount. So keep it a fixed percentage. So with a 1-to-1 risk and reward, you're risking the same amount to make the same amount. With a 1-to-2, you're risking double. With a 1-to-3, you're risking triple. I wouldn't say, okay, I only want to take trades that have a 1-to-3 risk reward, because I don't have to be right as often. And if I'm wrong, I can make back 2 losses in one trade and still be up on the account. It sounds nice, but the statistics don't agree with that feeling. So we'll cover that. So the combination of your risk reward and your win rate makes your expectancy, and you want positive expectancy. But this is a big but. The bigger risk reward you target, the lower your win rate will be. It's a balancing act again. So because when you're targeting a higher risk reward, the higher your risk reward you're targeting, the more you need price action to move in your favor against you. So you're asking for the market to move triple the amount, in size than your stop loss. I need it to go 3 times as far than against me. And a lot of the time, it can like stop you out before it goes in favor, or keep going here and then reverse. You're asking for a lot, really. And so they're inversely correlated. The higher your risk reward, the lower your win rate. The lower your risk reward, the higher your win rate. And you can be profitable with both high win rate systems and low win rate systems here. But we just want to make sure when we're choosing like a combination of risk reward. So this is risk reward on the lower side here. This is win rate on the left side. We just want to make sure we're above the expectancy or the profitability line, like this zone here. So with a 1-to-1 risk reward, the break-even rate is 50%. Not like this is like not keeping account slippage and commissions. So you might need to make actually like 55% to be profitable or break even, depending on your spreads and commissions. But we just want to be above this break-even line here. So with a 0.5 risk reward, we need to have above a 66% win rate. If we have a 2 risk reward, we need above a 33%. A 3 risk reward above a 25%. And so you might think, if I have a higher risk reward, it's easier because I only have to, I don't have to win as often, or I'm able to lose more often. But yeah, that is true. But it also means you're going to lose more often. Like the higher risk reward you target, the less likely that's going to happen, the more likely you are to lose. So it's a self-fulfilling prophecy. Like I don't have to win as much, so I won't win as much. It's a self-fulfilling prophecy. That is what most people don't talk about or understand. And we'll cover all the pros and cons of each a bit later. But with a 1-to-1 risk reward, you need above a 50%. And yeah, so you just want to be above this line. If you want to use this tool and like have a play around with it, it's in there'll be a link below this video where you can use it through the WAP website and play around with it because I'll be using it quite a lot. But we just want to make sure we're above this line. We want to be in the profit zone here. And you can see, you can use like, play around with different combinations of risk rewards and win rates. And as we can see here, like as I play around, it goes from like the left to the right, risk reward and win rate. We just want to be above that line here. So with that combination of win rate, risk reward, that'll show you the positive expectancy. We have, breakdowns and all that type of stuff. And so this is kind of like the break-even zone. Think of like, all these, like in the greens, this is like, as you go further, this is you're more profitable. You have a high expectancy as you have a, either a high risk reward or a high win rate. You're going from, top left to bottom right as well. Okay, so kind of already covered this. Price has to go further to your target if you have a high risk reward, which lowers the probability. Just basic sort of statistics. If you flip a coin, and you just press buy or sell at a random time, like I probably have this up. We'll cover this a bit later, but yeah. So why this happens structurally? Markets move in waves. Short moves happen more frequently. Large expansions happen less frequently. If you target small moves, there's a high probability of that small move happening because there's a high frequency of it. With bigger moves, less frequent, and it's kind of hard to have a 80% win rate with a average risk reward of 5. You have to be fucking extremely profitable, all the way down here to have that. And the more profitability you're going for, think of it like the further green you try to go, the harder it is to get there. The harder it is to get like that high edge as well. And we don't need to be like extremely profitable. We don't need to have the highest profitability. Again, like we don't need to have the biggest edge. We just need to have an edge that consistently makes us money. If we want to make more money, we just need to stay in the game long enough for it to compound. Okay? So like you're not trying to have the most profitability. You're trying to have the most consistency for the compounding effect to happen over time. And we'll go through some actual examples of that. So the kind of question is there's a psychological aspect to this, is which one can you execute without emotional interference? Because high win rate systems, low risk reward systems, high win rate, they both have problems. They both have trade-offs. They both cause pain. If you can't handle 5 losses in a row, a low win rate system isn't for you. If you can't tolerate small wins, where you're consistently closing trades early before they go in your favor, a low win rate system will just frustrate you. If you have both of these things, where you can't handle losing streaks, but you can't tolerate small wins, you can't close winners early, you're gonna be fucked, man. Like it's just painful. Like you never get to avoid pain in trading. You do get to choose your pain. Do you want to choose the pain of watching winners turn into losers, or winners going in your favor and then stopping you out, or taking a lot of losses in a row? Or do you want the pain of closing a winning trade early and seeing it routinely go 2 times, 3 times further without you? Like, you get to choose those pains. You don't get to avoid all pain, but you do get to choose it. So you're not trying to have the most perfect optimal system. You're just trying to have a system that is easy to stick to so you can be consistent. Okay, most plans work. People just don't fucking stick to the plan. It's as simple as that. Okay. And so, both of these systems are equally hard to execute because they both have the same expectancy. So, yeah, we kind of already covered that, but yeah, you just need to have a bit of expectancy in your favor. We want the right type of strategy or right type of expectancy that works for us, that we can consistently execute so we can actually make money. So win rate, risk reward. Win rate directly affects your streaks and your drawdowns. We kind of covered this in the previous video, but you've probably been told by a lot of gurus to just target a high risk reward. So many fucking people talk about this. Target a minimum of a 1, 2, 3 risk reward. But as you'll see, as I'll cover, this will decrease your profit factor. This will increase your max drawdown. This will lead to everything that we don't want. And these people don't fucking trade prop firms. These people don't trade small accounts where you're targeting bigger, using bigger position sizing. These people just don't fucking trade. It sounds nice in theory, but in the reality of trading, going for a minimum 1, 2, 3 risk reward just doesn't make sense, statistically speaking, based on actual facts, objectivity, reality. These people talk about fucking fantasies and Lamborghinis. It triggers me. Sorry if I'm going on a tangent, but I just get pissed off. Because it wasted years of my life when I was first trying to, become a profitable trader. It wasted years of my life. Fuck. But yeah, so you'll be a lot more profitable. You'll think you'll be a lot more profitable if you have a higher risk reward. If you just need to win 30% of the time, but it's flawed reasoning because by people who don't actually trade. Based off pure statistics, increasing your risk reward doesn't actually make you more profitable. It doesn't change your profitability or your edge. Your edge comes from your technical analysis, building that, collecting data, refinement of that system. Increasing your risk reward just means you're more likely to lose. as a base of pure statistics, that's what it means. So increasing your profitability and your edge comes from analysis, not increasing your risk reward. So don't focus on that trying to make more money. It's a pitfall. So for 99% of traders, a high win rate system, low risk reward system, high win rate, low risk reward system suits them better. Okay, and this is for three main reasons. So the higher your win rate, the lower your probability for losing streaks to be bigger and for losing streaks to happen more often. So it's, they happen less frequently and they're going to be smaller. It's a big benefit there. So if we go here, if we have a 70% win rate, we're less likely to go through losing streaks, and losing streaks are only going to be likely to be 73% chance for 3 losses in a row. So 3 losses in a row with a 70% chance with a 70% win rate over a 50 trade period. So the size and the frequency are going to be lower with a higher win rate. Big positive. The higher your win rate, the lower your average max drawdown. As you can see on this nice chart here, average max drawdown versus win rate. So with a fixed 2% risk over 200 trades, as we can see here, with a 10% win rate, we have around a 50% max drawdown with 2% risk. As your win rate increases here, your max drawdown decreases. And this, like all these like percentages, win rates, like this is all with the same expectancy. So this would be a 10% win rate with like a bigger max drawdown. Sorry, a bigger risk reward. So this might be like a 4, 5, 6 risk reward system. And this might be like a 0.67 win rate system here. So this is all the same profitability, the same expectancy, but as you can see, as your win rate increases, your max drawdown decreases because goes back to step 1, the less size and frequency of losing streaks. The higher your win rate for the third one, the lower your variance. So variance is kind of like the smoothness of your equity curve. So as we can see here, variance is the difference between, in a Monte Carlo simulation here. We'll get this up. So let's say we have we go over 100 trades. We have a 23% win rate with a average risk reward of 5.7. So very profitable system. But we have the difference between the best equity curve over 100 trades, the best series of trades is 32 times different to the worst. So massive variance in the best equity curve and the worst equity curve. What this means is that in general, your returns of your profits or your returns will be less consistent. They'll be more inconsistent. You have a more jagged here. We'll get this here. So if we have a 14% win rate and we have a 9 risk reward system, we can see the equity curve here. It's kind of more jagged. There's bigger drawdown periods. It's kind of like more like this. If we have a higher win rate system, there's less jig-jags, and it's more smoother equity curve. If we go back to here, if we have a higher, extremely high win rate system here, the difference between the best case scenario and the worst case scenario, there's only a 1.8 times difference. Where with this here, we go back to this, there was like a extremely high difference here. So think of like increasing your win rate here. Like when you increase your win rate, you reduce your variance, and think of your variance like the consistency of your profits, the smoothness of your equity curve. Do you want an equity curve where it's consistently like smoothly going up, or do you want an equity curve where it's kind of like going all fucking around the place here? Which one do you want? If you're going for a high win rate, low risk reward system, that's what you'll get. If you're going for a low win rate, high risk reward system, that's what you'll get. So you get to choose the consistency of your profits. Bah! If you're trying to be a consistently profitable trader, which hopefully you are, you get to choose how consistently you make money. You get to choose the consistency of your profits. So you make it a lot easier to be a consistently profitable trader by having a high win rate, low risk reward system, because you have lower variance, a smoother equity curve, you have more consistent profits. You win more often. You go through less losing streaks. You go through smaller losing streaks. Like, does that not like blow your mind. I wish I knew this when I first started trading. Like, you get to choose the consistency of your profitability through what risk reward you target, because that'll lead to, win rate. And so that is insane. Like, why does no one talk about that? Like, yeah. So that was a big, kind of a mental boom for me. Is that, variance, understanding variance, learning about variance. And so, yeah, with two strategies that have the same edge, the same size of edge, the same profitability here, there's a high win rate system, low risk reward, that has 10 times better risk adjusted returns, because of what we previously talked about. A higher win rate system, like losing streaks, less max drawdown, lower variance, like all these things kind of stack into this. So with a 75% win rate system with 2% risk, with a risk reward of 1 here, the robustness of this, so you have a max losing streak, a max win streak, your risk adjusted return is 69. Nice. Your risk adjusted return on a system as a 20% win rate, a 6.5 risk reward on average, same position sizing, same edge. They both have the same edge, 0.5 edge here, 0.5 edge here. But your max losing streak is 25, max win streak is 3, your risk adjusted return is 5.8. So you have 10 times better risk adjusted returns with a higher win rate system, low risk reward, than you do the opposite here. So you're 10 times more consistently profitable with this than this. And these two systems, it's the same challenge to get this expectancy. So it's hard, like the whole challenge in trading is getting edge. If you're trying to get like the bigger the edge you're trying to get, the more you're trying to edge, the harder it's going to be. Like, this sounds kind of sexual, but the higher the edge you aim for, the harder it's going to be to get that. That's just, basics of trading and statistics. But, choosing the right edge, a edge that has a high win rate, low risk reward, can 10 times the consistency of your profitability, can 10 times your risk adjusted returns without extra effort. It's not any harder. It's the exact same challenge. Like, so do you want to trade in a way that's easy, or do you want to trade in a way that's hard? That's you get to choose. Most fucking content creators, gurus tell you to go for this big high risk reward because it sounds nice. It sounds smart. 90% of people tell you to go for a big risk reward. 90% of people fucking lose money trading. Like, most people lose money trading. Why are you doing what most people do? And we'll cover this, the psychology of it a bit later, but yeah. So extremely important to understand this, that you'll become more consistently profitable through having the right edge, the right type of profitability, not just being a profitable trader. Okay, so really important. And we previously covered like losing streaks and not to change things as well. So win rate is extremely important for risk management, and the right type of edge, the right type of expectancy. And this is kind of more statistics and data, but now we'll kind of cover more psychology and biology. So there's a concept in life, not just trading, but it's called the winner's effect. Wins and losses psychologically affect you, and you can't help that. Like, you're human, you're not a robot. The winner effect is a biological phenomenon where an animal, a person, a lobster that wins a fight or wins anything, an event, a competition, is more likely to win the next competition or future contests. This is part of the reason why kids born at the start of the year are 10 times more likely to become professional athletes than kids born at the end of the year. Why is that? Well, for example, in the beginning, like, there's a big difference between, if you're born in like January, February, you have, 5, 6, 7 extra months to grow and, more experience. You're bigger, you developed more. And like, if you're a professional athlete in your 20s, does that really matter if you had an extra year, in the beginning? Actually, yes, because the extra year, you have extra development. leads you to, getting into, higher programs early on, or you win early on, and that earlier winning makes it more likely to, win later in the future or like later on. So that's why, you think it's a pretty big difference. It's only a couple months between, people being born, but because they have those early wins, because of their, early advantages, they get into like, higher teams that have better training, and that leads them to perform better in the future, and that's like a self-fulfilling cycle. It's due to the winners effect, because success causes physical and chemical reactions in the brain, such as increased levels of hormones like testosterone, dopamine when we're winning. It boosts our confidence, focus, motivation. You're more likely to be motivated to do something that is working for you. This is why it can be really hard to become a profitable trader. You're less likely to join on your trades when you've gone through a losing streak, because losses lead to less motivation. And so if you're trying to fight against this, like if you're having a high risk reward, low win rate system, you're losing more often, you perceive all those losses, that will decrease your testosterone, it will decrease your dopamine, you'll be less confident, less motivated, and will that improve or hurt your trading? Like, it won't improve your trading at all. Because you're going, instead of the winner's effect, which is a positive feedback loop, you have the loser's effect, which is a negative feedback loop. And we talked about, all the psychological issues that come from when you're in drawdown, like over risking, over trading, or increasing your risk reward, changing things. It's just harder when you're losing more often. So don't treat yourself like a robot. You are a human, and that's okay. It's okay to be human. And so the winner's effect is something important to understand. If you want to read the book, go ahead and read it. Good book. So the high risk reward trap, it is a trap for a reason, because you have the frequent losses, frequent losing streaks. It's mathematically viable, but psychologically brutal. More wins. If you focus on lower win rates, higher risk rewards, you have more wins, you have more confidence, you have better execution, which leads to more wins again. It's a self-fulfilling cycle. It's an upward spiral instead of a fucking downward fall with the opposite. So yeah, we previously talked about variance, and consistency is directly tied to variance. The lower your variance, the higher your consistency, the higher your consistency of your profitability. And lower win rate systems provide more setups because they happen more frequently. There's a lot more small moves than big moves in the markets, more trade frequency, faster feedback and learning, faster compounding, more consistency, so faster compounding again, and less pressure per trade because you have them happening more often. If you've ever tried a high risk reward system, you might have taken 2 losses, and then the third setup happens, you miss that setup, it turns into a 1 to 3, and that is one of the most painful situations where you take 2 losses, you miss the third setup, and that was the setup that would have made you back all that money plus more. And each setup kind of feels like it matters a bit more. So, yeah. But yeah, trading is all just about choosing your pain. High risk rewards, fewer wins, longer losing streaks, bigger drawdowns, low risk rewards, smaller wins, more frequent success, more emotional stability. And it just makes sense, really. So all is just to say, it's just kind of like, stacking the proof with, what risk reward should you aim for, what win rate should you aim for, and how that affects your trading and your psychology. But you just want to, have a system that matches your psychology as well, because, don't treat yourself like a fucking robot. You can't control your emotions. You don't want to trade in a way that's overly stressful and fucking like sucks and makes you feel like shit every single day. I like winning. It's okay to like winning. It's okay to not like losing. And I want to win more often than I lose. So I target low risk rewards, and that's okay. I still make money. I'm more consistent than ever. Stop trying to be perfect. Just try to fucking be good and consistent. Yeah. So again, win rate versus risk rewards. What's the effect of everything? We've kind of covered all these different things, but yeah, it's a big misconception. Increasing your win rate won't make you more profitable. So increasing your risk reward won't make you more profitable. It's a combination of both, but it'll just make you more likely to lose. So I think, you can still target, a bit bigger of a risk reward, but just focus on the probability of the move. Don't, put your take profit in a certain area because it needs to be, a positive risk reward. It needs to be a 1 to 2 risk reward. That doesn't make sense. Trade the market, not your risk reward. Trade the process, not the outcome. So place your stop loss, take profit off your edge, your system, your structure, market structure, not trying to, hit a certain risk reward. Like, okay, I need a 1 to 2, so I'm going to place it here. I'm not going to place it at the area of interest where price action could reject because I need this risk reward. What happens? Comes into AOI, stops me out, then goes in my favor. I scream and I cry. So don't force RR. Big mistake. Just trade the market. Focus on the probability of the move. If you want to have a higher risk reward, it's not by targeting more, having bigger take profits, or even having a tighter stop loss. It's just by losing a little bit less than you initially risked. So having good management, trade management. For example, I have a 77% win rate with an average risk reward of 2. So I have a bit higher of a risk reward. That sounds like, you talked about having, targeting low risk rewards. That doesn't make sense. But my average win is actually a 1.7 risk reward. So that's my average target. On average, I win 1.7 times my stop loss, which is a bit higher, but based on my edge, I've kind of, I've maxed out my win rate as much as possible. I could probably get it to around like 90% if I targeted maybe around a 1-to-1, which I might start doing. But the reason I actually have a 2 risk reward here is because my average loss is 0.86. So I only lose 14% less on average. So that's like a small amount, 14% less. But it turns my 1.7 risk reward on average into a 2.4 because I just lose a little bit less than I initially risk. Isn't that kind of crazy? So, yeah, losing a little bit less is the easiest way to increase your risk reward, not by targeting more. And the next best way is to get a bit better of an entry. So, even a 10% better entry leads to, 20% better risk reward because you're not just having a low stop loss, but you're also having a bigger take profit. So if I move this up, what was once like maybe like a 10 pip stop loss is now an 8 pip. What was once a 10 pip take profit is now 12 pips. So you double up here. So the best way is just get a bit better of an entry. So trying to focus on that is one of the easiest ways. And I surveyed a bunch of profitable, I've surveyed a couple profitable traders in my community that had 100K plus in funding and 5K plus in payouts. They have an average win rate of around 60 to 70% with an average risk reward of 1.5 here. So this is what they had. So on average, people tend to have a higher win rate, a little bit lower risk reward, below a 2 risk reward, closer to around a 1.5, similar to me as well. I find this is the most consistent, and it kind of balances out the pros and cons of each, win rate versus risk reward, psychology and stuff like that. Winning too big, winning too often, losing too big, losing too often, stuff like that as well. So yeah, that was win rate versus risk reward. We'll kind of go into how position sizing and max drawdown affects, we'll go into that next video. And this kind of ties into this. So win rate and risk reward will tie into position sizing and max drawdown. And I'll further fucking stack proof on why win rate, maxing is better than risk reward maxing as well. So I hope you guys enjoyed this, find this helpful. I fucking like learning about this was like, especially this, like, how like I actually might lower my risk reward even further, so I can max my win rate even further, so I can max out my risk adjusted returns, so I can max out the consistency of my profitability, so I can compound quicker, easier, and just go to the moon. But understanding statistics in trading is really important. But hope you guys enjoyed. I'll catch you in the next video. Okay, so now we're going to cover balancing position sizing versus max drawdown to try to maximize our risk-adjusted returns. So as we know, the higher your position sizing, the higher your max drawdown tends to be. So here, on a 60% win rate system with a 1.5 risk reward over 200 trades, expectancy of 0.5R, we can start off with a 0.5% risk. That is pretty low max drawdown. As we go on to around a 1.5% risk, we have an 8% max drawdown over 200 trades. As we go on to a 2.5%, 16% max drawdown. If we go on to more of around a 4.7%, we have a 24% max drawdown. So as your position sizing increases, your max drawdown increases as well. So how do we get the best of both worlds? How do we have the highest position sizing possible whilst keeping our max drawdown as low as possible? because we want to have our position sizing high so we can make as much money as possible or compound like as quickly as possible, but we don't want to blow our accounts. So it's always a balancing act. We want to pass from as quickly, we want to have a high pass rate. So, position sizing versus drawdown, it's a bit of a, it's a trade-off. So how do we decide what is acceptable max drawdown? So we want to, so it's all about deciding what is an acceptable max drawdown and using a position sizing that will keep us within those limits. And think of drawdown, it's just like the max drawdown is the peak of your equity curve versus the trough. So we can go into profit, then we go into drawdown. Here, it's not the actual, starting size of the balance. It's the peak versus the trough. Yeah. So as we see here, we're going to actual sort of examples of this using, again, the indicator. So the tool, you can find the link in the description below to both of these tools. It can be useful on the website. For an example, if we have a basic strategy, we're risking 0.5% per trade. Here, we have an average max drawdown of 2.4% over 200 trades. And our median end balance is 12K. So we started with 10K. The median is around 12K. The max was around 15K here. If we target if we use a 2 risk reward, a max drawdown is 5 times bigger, around 4 or 5 times bigger, 10% here. But our median balance is quite a bit bigger as well. It's double the size again. So we make more money, but we have a bigger max drawdown. We want to choose what is acceptable max drawdown, because 10% isn't that bad. A 10% max drawdown isn't that bad. We only have to make 11% to get back. It could be worse. Like, is that acceptable here? And so I want to choose what is acceptable and like how much money do you want to be making, because the best case scenario here, we make around 40K, where in here we make around 15K. And am I okay with going through 10% max drawdown versus keeping it to only 2%? It's kind of personal. It's based off how much money are you willing to risk, willing to lose, your psychology, or even if you're trading a prop firm. If you're trading a prop firm, this would probably be better than this if you only have like 8 or 10% max drawdown. So it's important to choose the position sizing based off your win rate, your risk reward, and your average max drawdown as well here. So yeah. Higher position sizing isn't always bad. Like, it's good to have high position sizing because you can have faster progress towards your goals, faster compounding over time, like bigger returns. But you don't want to have too much of position sizing, as that will create you'll go too deep into the max drawdown and you won't be able to get back out. And so, yeah, that high volatility, larger equity swings, greater psychological pressure. So it's a double-edged sword. You don't want to do too little, otherwise it'll be boring. You don't want to do too much, otherwise you'll be broke and go back to working at Macca's. For position sizing, please, always just use a fixed percentage risk. It's just the easiest. It's just a lot easier. It's the best. It's the simplest. Simplest is the best. Simplicity scales as well, and this kind of does a lot of the hard work for you. So just set your stop loss based off a fixed percentage of your account balance. So 1, 2, 3, 4, 5%. For example, if you're risking 2% of a 100K account, maximum loss per trade should be $200. Keep it as close to that as possible. Because if you're consistently winning, that will compound infinitely over time. If you're consistently losing, it'll kind of flatten out, because if you lose 10% of 10K, lose 1K, that 1% is now $90 instead of 100. So you start to lose less and less. It'll decrease your risk a little bit. So just stick to percentage as well. That's why it's kind of hard to get back out of that drawdown. And position sizing, always based off your stop loss placement. The size of pips should lead to your lot size and all that type of stuff as well. But position sizing should also be based off your win rate here. So it should be based off your win rate, because win rate directly affects that max drawdown. And so the higher your win rate, the more you can risk. For example, if I want to keep my drawdown, we'll go back to this. What is acceptable drawdown for me? Like, if this is a personal account, let's say I'm okay with going into 20% drawdown. So I don't want to go any lower than 20% drawdown here. So I have a drawdown cap here of 20%. Let's say I have a 70% win rate. We'll go 75% win rate with a risk reward of one here. So risk reward of 1. This will auto calculate your safe position sizing. So if I want to stay under that 20%, so over 200 trades with a 0.5 edge here, I mean, it can be a bit higher, but in general, with a 5% risk, on average, you're going to be under 20% drawdown, with a 75% win rate. And we have our total return is a lot with a 3.5 profit factor. Let's say we go into a lower win rate system, around a 30% win rate here. You can see the position sizing, which was a lot higher. Now it's only 1.5. So the safe position size is 1.5 because we're more likely to go through bigger losing streaks. And so max drawdown is still under 20. But look at the return. Yeah. So that is a lot less and lower profit factor as well. So having a higher win rate allows you to have a higher, safer position sizing, because all three things, win rate, position sizing, and max drawdown, are interrelated here. If we want to have like a higher drawdown cap, for more comfortable with that, we're able to risk a bit more here. But if we just want to risk a bit more, you can just go onto a higher 80% win rate system with a 30% max drawdown. We can risk 11%. And that's quite high. But our max drawdown is 29%. Our total return is a lot. What is that? Like 2 fucking million %. And a lot higher of a profit factor here as well. So you're more profitable with a high win rate system. You'll make more money quicker with better risk-adjusted returns with a high win rate, lower risk reward system. Like, am I like, I'm kind of cooking here. Like, does this not make sense? So it just kind of makes more sense to target bigger win rates, because you can have high position sizing whilst keeping to your max drawdown limits as well. So yeah, win rate. So your position sizing should always be based off your win rate and your acceptable max drawdown, because of losing streaks and stuff like that as well. So yeah, we just covered this, but yeah, because yeah, win rate, as win rate decreases, so as win rate increases, drawdown increases, but as position sizing increases, drawdown also increases. So you can kind of like balance them out by having a high win rate. It'll allow you to risk more whilst keeping the drawdown lower. So there's a trade-off there. That's what people don't actually understand when they say target a bigger risk reward, lower win rate. Like, that sounds like good, but actually it removes the opportunity for you to risk more on each trade, because you're more likely to go through those bigger losing streaks again. So yeah, with the same system as well, like this is going through like the same system with the same risk. So if you have 10% risk on each over 500 trades, the 30% win rate system, that is the same profitability as the 80% win rate system, will go through 3 times more drawdown than this. So 92% versus 35% max drawdown. So a lot better risk adjusted returns with a higher win rate system. So I kind of repeating myself a lot. I'm banging it into a head, but it's really important and it'll save you a lot of time and effort. It makes trading so much easier when you choose the right type of edge. And yeah, it'll allow you to risk more. You'll compound quicker. You get better results a lot quicker, and it'll be more consistent. And yeah, this is kind of like a so this is the maximum risk that is allowed if you want to stay within a 30% drawdown limit. This is based off like your win rate here. So the win rate in the bottom, and from 10% to 90%, then you have your max drawdown, or so you have your max your position sizing. So if I want to stay below 30%, and this is position sizing, this is your win rate. If I have a 10% win rate, I can only risk like 0.5%. If I have a 50% win rate, I can risk 4% if I want to stay within that 30% max drawdown. If I have a 90% win rate, I can risk a lot higher, want to stay within that as well. So based off pure statistics, obviously you don't want to risk that much because you could just, this isn't accounting for you fucking up and making mistakes. So you might just want to risk like lower, around 5% as well. In general, if I'm trying to quickly grow an account, I'll risk like 5% because I'm not going to be perfect. I'm gonna fuck up, make mistakes. But I'll go for a high risk reward around a 75% win rate, targeting around a 1 to 1.5 risk reward, and I'll use 5% risk, and I can keep like lower than 25-30% pretty easily if I'm like sticking to my expectancy and my edge as well. But yeah, so that is quite important to understand and realize. But also, something we need to keep in mind is that position sizing, like the size of your position, the risk you have on each trade, is kind of like a mental weight. The higher your position sizing, the more likely you are to fuck up and make mistakes because each trade matters more. The more attached you are to a trade, the more attached you are to making money, to the outcome, the less likely you are to be focused on the process. The less you focus on the process, the more likely you are to fuck up, make mistakes, make errors, and lose. Okay? So risk is a mental weight. Every trade you take is kind of like a rep. You might be profitable on a demo account. Like, really profitable. But as soon as you go to live, you just go retarded mode and you just fucking lose. I've been there. It kind of sucks, but a demo account is kind of like you're, doing a bench press with the barbell. There's no weight on it. There's no attachment to the outcome. There's no weight. So the weight on the bar is like the risk. The more you risk, the more you add weight to the bar. So if I go from a demo to trading a 100K account, I'm fucking maxing out. I went from, benching the bar to trying to bench 150 kilos. Probably not going to work very well. So the more you risk, the harder the rep becomes, the more you are to fail that rep and make errors. So it's because you perceive more risk, you're more likely to focus on the outcome, you're less focused on the process, you make mistakes. It's kind of like, it's easy to talk to a girl you're not attracted to. And you don't want anything, you don't want any relationship, or you're not trying to raise them up. As soon as some like 10 out of 10 girl walks by and you try to talk to her, you're going to stutter over your words. You're going to probably talk about League of Legends or some, dumbass shit, because you're so attached to the outcome. Like that's, the more pressure there is, the more you are to make mistakes because you're trying to force an outcome. You're more likely to make a process-based mistake. And so we want to detach ourselves from that as much as possible. So that means, we can't risk as much, like the highest position sizing. We actually can't risk 13%, even if we have a 90% win rate. We actually have to risk a lot lower, an amount that we are comfortable with losing. So that is actually a cap on how much you can risk as well. So it's important to understand this. I'm not going to spout all the benefits of high win rate position sizing. There are trade-offs, there are costs, and it's important to understand this. I mean, this is the same thing with low win rates, high risk reward systems as well. But yeah, the more attached you are to the outcome, the higher your position sizing. This will decrease your edge, your profitability, and your execution. So that can kind of fuck with your statistics as well. If you add too much risk, it's like adding too much weight to the bar. A lot of people like growing accounts. I think I cover this a bit later, but yeah, I'll cover that later. You just don't want to add on too much weight because then you end up injuring yourself and you'll set yourself back months of time. Like, if I add too much weight onto the bar and I fucking drop it on my neck because it's too heavy, and I get injured, I can't go to the gym for a month and I lose my gains. And maybe I have a bit of trauma or scar tissue. A lot of people have that in trading where they lose a lot of money and there's trauma there. There's a lot of fear coming back to it. And it just does a lot more harm than good. So, and like, there's no point of trying to risk more to make as much money as possible, as quickly as possible, if it leads to this. Like, again, like, yes, it's good to have high position sizing. If you have a higher win rate system, you can have a high position sizing. I don't think you should max out your position sizing though. You should always go less than you think you should. You should always go a little bit less. Because again, if you want to make more money, you can have a bit higher position sizing to increase the speed and the compounding. But in general, making more money is a byproduct of more time. It's not through risking more big trades, big winners, taking more trades. It's just a byproduct of time, staying in the game long enough for your account to just compound, become exponential over time using that percentage fixed risk. So rushing the process, trying to make too much money too quickly in the beginning, over risking, trying to be too profitable, trying to make too much money, having too big of an edge, too big of a risk reward. Most people, like most traders, fail not because they're not profitable, but because they try to be too profitable, and that leads to inconsistency. A lot of people sacrifice consistency for profitability. Like, I'm going to remove my stop loss so I can win this trade that would have been a loss, so I can make more money. Or I'm going to double my position sizing so I can make more money. So they sacrifice consistency for profitability. But again, we're not trying to be the most profitable. We're trying to be the most consistent, because making the most money comes from having the biggest account or the most capital. So most people try to be too profitable. That leads to them deviating from their system, which leads to them being unprofitable. So, you don't need to have big profitability. You just need to have more consistency. So that is a big mistake that people make, is that they try to be too profitable. You're probably already profitable. You're just not consistent. So yeah. And having a big account is just a byproduct of time. Once you have a system that is set, that works, stop fucking changing shit. A lot of people have a good trading system that they know works. They fucking ruin it by trying to make it the perfect system. A lot of people think that they have these problems, like, oh, I keep on closing my trades early and they keep on going in my favor. That isn't a problem. Like, the easiest way to solve a problem is to decide that it's not a problem. It's a trade-off. That is a cost of your system. If you have a low win rate, high risk reward system, you're going to close trades consistently early, and they're going to go consistently further in your direction. That is okay. That is a cost of your system. That's not a problem. That's a trade-off. There is no perfect right decision. There's never any perfect right decision. There's only going to be trade-offs. So if you understand those trade-offs, if you don't no longer look at those problems cease to be problems. So just please stick to one system, keep it simple, do it over time, and it'll compound, and you make a fuck ton of money. Oh my God. So yeah, avoid trying to rush the process, trying to risk too much too soon. Slow is smooth, and smooth is fast. You want to avoid blowing up and going all the way back to the beginning, because those big fuck ups will set you back months, plus give you trauma as well. So a lot of people have a good period on their trading account. Maybe they've been risking $100 or $50, or we'll say $100, and the opposite amount. It's been going well. Okay, I'm gonna double my risk. I'm gonna double my position sizing. Instead of using one lot, I'm gonna go to 2 lots, which is normal. I did this, but think of it. Okay. Okay. I'm doing 100 kilos for 8 reps on the bench press. It's going well. I've been getting stronger. Might as well go to 200 kilos. I go do that, and it fucking snaps my elbow, and it lands on my neck, and I end up in the hospital. Doubling the risk, you're going to double the weight? Think of risk as a mental weight. Risk as weight on the barbell. Would you double the weight on the barbell? Would that be smart? No. So don't do that. Be gradual. Increase your risk by 10, 15, 20%. Always do less or slower than you think you can. Slow is smooth, smooth is fast, because you avoid fucking crashing. So you don't need big wins. You don't need to win big. You just need to stay in the game long enough for the compounding effect to take time. So please play defensive, define your risk. It's a lot easier to fucking play defensive and decrease your max drawdown if you have a high win rate, you have a high profit factor, you have high consistency of your profitability as well. So yeah. So that's kind of the basic of risk management: win rate, risk reward, position sizing, max drawdown. We'll cover a couple more things, but I hope you guys enjoy this, and I'll catch you in the next video as well. If you want access to these simulators and the Monte Carlo, you want to play around and see what your win rate, risk reward would be, and what max drawdown. If you want to do this for prop firms, if I only have a 5% max drawdown on a prop firm that's very tight, what is my safe position sizing? If I have an 85% win rate, I can risk 1.5%. If I have a 30% win rate, I can only risk 0.5% with the same expectancy. So if you want to play around with this, with your systems and stuff, and see how profitable they are, just click the link below. I'll put it below this video. It'll be in the website as well. I hope you guys enjoyed. I love talking about this stuff, especially statistics, and this is I fucking like this was like, you get to choose the consistency of your profitability. Like, sorry about yapping, but like, does that not blow your mind? Okay, so now we're going to cover trade frequency. So every trade you take is an emotional decision. Every decision is under risk. It triggers fear, greed, hope, doubt. It's very emotionally draining trading. It's, I trade for an hour or two and I'm fucking tired. I don't want to do anything else. I just want to sit by the pool and sip pina coladas. So imagine doing that for like, taking 8 to 15 of those decisions each day. It's going to be very stressful. You're going to spike your cortisol. That's not good for longevity or looks maxing at all. You're going to become a chud if you're trading that long. So we want to limit the amount of decisions we make because trading is very emotional. You're making a monetary decision, and you're always, risking losing things, and it's stressful. So focusing on just 1 or 2 trades per day, maximum 3, and limiting the amount of time you trade is very important because you have 2 types of capital. You have first your monetary capital, your risk per trade, but you also have your mental capital. And that can be very, that's decreased by each trade. Every decision you make, you're using up ATP, adenosine triphosphate, or your energy in your brain, and it's leading to, fatigue, willpower, discipline. It's a finite resource. The more decisions you make, the worse your quality becomes because you run out of that energy. And when you're fatigued, fatigue makes cowards of us all. I'm more likely to not go to the gym. I'm more likely to fucking brain rot on YouTube, TikTok, Reels when I haven't slept well, when I'm tired. When I feel good, when I'm happy, when I'm fucking pumped up, that's when I'll go to the gym. So fatigue makes cowards of us all. We want to avoid creating that fatigue through having lots of decisions. So limiting the amount of trades that we take, limiting the complexity of our system is also important so we make less decisions. We want to make as little decisions as possible, which we'll cover in the next sort of the next module on psychology and discipline versus decision making. But limit to the amount of trades, focus on just 1 or 2. Do not trade any longer than 2 hours. This is what I don't understand is like, you get into trading for freedom, specifically time freedom, because there's lots of ways to make money, but how you make money in trading is very different. It's like extremely leveraged. It's so little time that you can, you don't have to have that much time that you put to trading to make money. So that's the whole benefit of trading. Like that, it's hard, but the benefit is the time freedom. So don't turn trading into a fucking 9-to-5 job by trading for 6, 7, 8 hours. It's just gonna be stressful. It's gonna ruin your life. And trading is a different type of work. You don't get paid based off the quantity of your work or the quantity of decisions. You get paid based off the quality of them. If you take 100 shitty trades, you won't make money. If you take 1 good trade, you'll make money. Or 10 trades, 10 good trades, you'll make money. Expectancy. So we want to focus on the quality of our work, the quality of our decisions. We get paid based off not our work, our hours. We get paid based off our judgment. So we want to maximize for the quality of our judgment. And making more money, making the most money possible comes from having a big account, not taking more trades or trying to be as profitable as possible. So play the long-term game again, always comes back down to that. And so limit the amount of trades you take per day. If you take a couple losses and you go on tilt, or you find that you always trade worse after 2 losses, 3 losses, you're more likely to revenge trade, overtrade, you're more mentally, charged or, tilted. It's good to have a break and have a day separation from that. The night kind of resets that. You process your emotions when you go to sleep. So having a sleeping period between your trading sessions is quite important. We don't want to focus on willpower to not trade though. We want to set up systems and environments that support the right behavior. We want to make it easier to do the right thing, harder to do the wrong thing. So having a daily loss limit, setting it up through TradeOvate, or having like a proper EA through maybe MT5 to lock you out when you take an amount of trades or when you hit a daily loss limit is extremely important. This will stop you from the days where you just go full retard mode and just take 5 trades, 10 trades, and you just take loss after loss after loss and you fight the trend, or the condition just doesn't suit you. And so having a system, a daily loss limit, this is probably the most important thing. It's just so much, it's such an easy thing to do. Do not trust your brain. Do not trust yourself. Don't trust discipline. That's fucked. Because there'll be a day where you've maybe had an argument with someone, or you're just having a shitty day, you haven't slept well, you won't have the willpower or the discipline. It's not consistent. Have a system, an environment that supports the right behavior. So define trading windows, define setups, max trades per day, max daily loss, and pre-plan shutdown rules. Do not make decisions in the moment. Make the one decision now, which removes all future decisions. That will kind of go back into this, which is like, if you're constantly having to decide when to trade, that is tiring. Just decide one time to trade. And that will limit the amount of decisions as well. So really important, understanding trade frequency, how that affects your mental capital as well. And yeah, so if you just have a daily loss limit, only take 1-2 trades per day, and trade for 1 or 2 hours, the less I traded, the more money I made. So just do that. Understand how decision fatigue affects your trading, and should be all good. Okay, and finally, I just want to cover environmental risk. So this is risk outside of placing a trade. Really, it's just something to be mindful of when you're trading. So first off is news. You should always be checking Forex Factory prior to trading. We want to avoid situations where we have news come out and there's a big move in the market, a big gap, and you can get slipped quite heavily if you're in a trade holding over news. So always check Forex Factory prior to looking for a trade, and we just want to avoid any red folder news coming out and trading over that, because we always want to do things that are repeatable. We want to be consistently profitable. We want to trade in a consistent way. Trading around news or trading over news is not consistent. You can get slipped quite a lot. And what was once like a 1% risk, you can get slipped into 2, 3, 4, 5%, depending on the size of the move. So just the easiest way to trade news is to not just avoid it using Forex Factory as well. Then I want to cover brokers and prop firms, especially for prop firms. When you're going the funded route and you're trying to scale up capital, you want to diversify yourself across different prop firms, because you can, prop firms will ban traders for kind of some shady reasons, or they might shut down. So a prop firm shut down recently, Seacrest Funding. I was funded with my Forex funds before they got shut down by the CFTC. They're coming back now, but that account that I had is just gone. There's nothing I could really do about it. So you need to diversify yourself across different prop firms in general. So don't have all your funding on one prop firm. You can get banned. I got banned from Smart Prop Trader back in the day. And so it just kind of sucks. Diversify across different prop firms. For brokers, always use regulated brokers if you actually care about the money. If you want to compound long term, use a regulated, reputable broker, and even maybe have different broker accounts. So you don't have to put all of your money into one big account. You can split that between 2 different firms or brokers as well. So we want to plan for the worst. We want to be optimistic, but we want to plan for the worst. And we never want to put ourselves in the situation where we can lose everything, either on one prop firm or a broker or on a news event. So just be mindful of the environment that you're trading within, especially for prop firms. You can diversify across futures, Forex prop firms, anything like that as well. So yeah, that's a pretty short video covering environmental, but now that we've covered risk management, we'll go into more psychology. So looking forward to covering that. Okay, so now we're going to cover trading psychology. This is a pretty important topic, but this is a topic that most traders get wrong. And they do go about it in the wrong order. Most people think that trading is 80-90% psychology. And in a certain sense, that is kind of correct. But it depends on where you are in your journey. For beginner or newer traders, trading is 90% technical. If you're more of an advanced trader that have been trading for a couple of years, you have a system that works, then trading becomes 90% psychology. So first off, we need to define what is good or bad psychology, because there's a big misconception about this. Most people think, most people think good psychology is not feeling fear or anxiety when you're trading, not feeling your emotions, being able to control your emotions. That is not good psychology. What is good psychology? Good psychology is simply your actions and your behavior. the ability to take action on a proven edge consistently under uncertainty. So you can still feel fear when you're executing your process, but if you execute the correct way, that is good psychology. So it's your actions, your behavior, not what you feel, but how you react to your emotions and uncertainty. That is good psychology. So it's not feeling calm all the time or being fearless, confident, not having any doubt, not feeling emotionless. That is not good psychology, because it's impossible to not feel emotions because we're human, unfortunately. For the time being, who knows? But yeah, so good psychology, it has to be earned. The psychology as a problem has to be earned as a trader. And it becomes a lot easier to have good psychology when you know exactly what you're looking for. You have data that proves that works. If you lack confidence, build evidence first. And very easy to execute the same way when you've practiced. Most people deserve to have bad psychology because they haven't actually done the work. So bad psychology is not feeling certain emotions, it's how you react to those emotions. So trading without a defined edge, it's just poor. You're just gambling. Moving stops randomly, not knowing what you're doing, just revenge trading, over trading, or deviating from the system that you know works. Most people don't have a system or strategy that they know works that is validated by data. They don't have a trading plan, they don't have a trading journal, so they deserve to have bad psychology, and they will have bad psychology. Because trading is hard because it's uncertain. Every single trade you take is uncertain, and that's where every emotion arises from. Every emotion arises or is attached to that uncertainty. When you are not just uncertain about the outcome, but you're also uncertain about the process, you don't clearly know what you're supposed to be doing. You don't have a clear system that is backed by data. There's uncertainty around that process, that system. You're doubling up on that uncertainty. So you're doubling up on feeling those emotions and that psychology. So you're making it 2 times harder than it needs to be because you have 2 times the uncertainty around the process and the outcome. Bad psychology is just being affected by your emotions and deviating from your system or your approach. If you don't have a system, you don't clearly know what you're supposed to be doing, psychology is not for you. So it's just, you're being able to react the right way to uncertainty. Think of psychology in trading as trying to close the behavior gap. So closing the gap between knowing what you should be doing and actually doing it. If you don't fucking know clearly what you should be doing, you don't have evidence that it works, and you don't know, your entry model, when you're supposed to be trading, what you're supposed to be trading, you don't clearly know that, then you don't have a psychological problem. You don't have a problem with discipline. You have a problem with clarity and a system problem. So if you know what you're supposed to be doing, but you just can't do it, that is where psychology comes into play. But in general, it's still a bit of a system issue. Most people's psychological problems is that they don't clearly know what works and why it works. And that you just do that through collecting data, information, and learning as well. So most people don't need to focus on improving their psychology. They need to focus on building their system, their strategy, collecting data and information, so they know more clearly what they should be doing as well. So yeah, most traders don't have a psychological problem. They have a clarity problem. So good psychology, has to be earned through experience, through data. If you don't know your win rates, your risk reward, if you haven't journaled 100 plus trades, you don't know the optimal market condition, and what condition your edge works best in, you deserve to have bad psychology. You deserve to have anxiety because you don't know what the fuck you're doing. It's as simple as that, really. And so you don't have a psychological issue. It's rational fear. Like, you feel emotions for a reason. In order to feel the right types of emotions, you have to actually give yourself a reason to feel confident. You need to build evidence. If you don't backtest, forward test, have hard data, you only have a half understood strategy that is, copied from someone else. You deserve to have bad psychology, and you'll probably fail. It's harsh, but it is the truth, the reality of it. And when I was trying to, fix my psychological problems, I read Trading in the Zone. I read Best Loser Wins. I read all these books, consumed all this information, but I never actually put in the fucking work to journal my trades. And so my psychology never improved. I wasted years of my life consuming information, watching videos, instead of doing the boring work, such as journaling, collecting trades, reviewing those trades, discussing that with other people, actually fucking learning and putting in the work. I was trying to fix it by consuming information, and nothing changed. So you need to actually, build evidence to build confidence and to fix these problems. So clarity in your own system, your own process fixes psychology. when you have 300 plus logged trades, you know exactly what is a profitable trade, exactly what leads to a unprofitable trade. You have known expectancy, known win rate, known risk to reward, and you have defined invalidation rules, and you know very clearly what your setup is. Losses stop feeling personal, and they just become an expense of your business. And you stop, identifying with losses as well. So first off, you probably don't have a problem with psychology. If you don't have the system down, if you don't have your strategy down, if you don't clearly know what works, you haven't put in the work, you don't have a psychological problem. And you're wasting time focusing on it as well. If you don't have the system set up, if you don't join your trades, have a trading plan, you're just wasting your time. And so first, we want to build a measurable edge, validate it with data through that journaling process, and then reduce risk to tolerable levels so we can actually execute. So we'll kind of cover, we've covered it a bit in risk management. So risk as a mental weight. You get better at that through progressive overload and desensitizing yourself to losing. And then, at the very end, you work on emotional execution. Most people shouldn't be working on this though. It's down the road. So psychology becomes simple when the process is easy to follow and it's clear. You know the maths. It's like if it's a step-by-step process that you follow, like I've already mapped out all my processes and my strategy. I don't really have psychological problems much. May have some little ones, but it's not really a problem. It's just me knowing my system. So you need to journal. You need to collect data. The way you fix psychology is not by focusing on your psychology, is by doing so much fucking work around building your system, your strategy, that you have confidence and you know it works. And feeling emotions, feeling fear, feeling feeling uncertain when you're taking a trade, feeling fear, that's not a problem. Like that's normal. Like it's how you react to these emotions. So emotions in trading are neither good or bad. Intuition is an emotion, and intuition is what makes us profitable. So it's not what you feel, it's all about how you react to what you feel. That is where good psychology comes in. It's all about your actions and your behavior and not deviating from your system. So easiest way to improve your psychology is just to change your reaction to an emotion. Because not all emotions are bad. Intuition is an emotion again. The best way to tell if it's a good or bad emotion, because it can be jumbled up, is this emotion based off the process or the outcome? Every emotion tied to the process is a good emotion. It's intuition. I'm seeing this market structure and feeling bullish, so I'm going to take a buy. Every emotion attached to an outcome, like, I'm going to close this winning trade early because I fear losing. Instead of, I'm going to close this winning trade early because I feel like volume's decreasing. I feel like it's going to reverse. You can close a trade early, a winning trade early out of fear, if that fear is based in reality, if that fear is based off the process, like, the volume's decreasing, it looks like it's going to reverse. We have a shift against me. If that fear is based off the outcome, like I don't want to lose money, that is going to be a bad decision. So good psychology is all about identifying if that emotion is based off the process or the outcome. If it's based off the outcome, you do not react to it, or you just accept that you're feeling fear and it is what it is. So always be curious and ask, why am I feeling this emotion? Because you feel it for a reason. You need to identify why that is, and is it based off the process or the outcome? Because that will decide how you react to that emotion. Because emotions are important. Emotions do make you profitable and a better trader. You just want to use emotions to help you to improve instead of being used by emotions. Because emotions are another source of information. It's called market biofeedback. So using how you react to stimulus information as an information source. So I'm feeling bullish. Okay, why am I feeling bullish? Well, I'm feeling fearful or hesitant to take a trade. I feel like this isn't a good trade, even though logically this all looks good. Is it because I'm hesitant of losing money? Or maybe because I just don't really like how market structure looks? And that's how you get better at trading your intuition. So as a trader as well, we're not just trading patterns in the market. We're trading patterns in our own behavior. So you might consistently lose money in certain conditions, or your intuition is wrong in trending conditions most of the time. You need to recognize patterns in your own behavior. Maybe I get triggered after 2 losses, and that's where everything goes downhill. So I need to have a max daily loss limit of 2 losses per day. Or whenever I take a win, the next trade always tends to be worse. So I need to only take 1 winning trade per day. You're trying to identify patterns in your own behavior and then set up rules to benefit you over the long term. But the holy grail in trading psychology is clarity. Your lack of discipline is a lack of clarity. You don't do things. You don't do things because you don't know what you should be doing most of the time. Like you don't clearly know what you should be doing. How are you supposed to take a profitable trade if you haven't defined what profitability means? That can only be defined through data and answering those small little questions using that data. And so closing the gap between knowing and doing is doing that hard work. If you want a goal, if you want good psychology, if you want to take good trades, define that trait or the outcome into a consistent action to take. Again, if I want to be healthy, if I want to be disciplined, define what fucking discipline means. Like you saying, okay, I'm going to lock in, I'm going to be more disciplined tomorrow. What the fuck does that mean? Like you've said that so many times, but nothing ever changed. Because discipline it's so vague. It's so vague. It means different things to different people. For someone trying to gain weight, discipline means eating more. For someone trying to lose weight, discipline means eating less. So define the goal, define the outcome, and then define a consistent action to take. And then the psychology, the discipline is all about just taking that action. And so, if I want to lose weight, if I just define healthy eating, that's not very clear. It's not very, it's pretty vague. If I define it into eating the same food at the same time every single day, I'm going to eat eggs at 11 a.m. every single day. That's very easy to do. That's an action I can actually take. It's actionable. If you want to improve your patience, one of the biggest things that people struggle with is patience, rushing the process. So what we want to define, like how can I turn being more patient into an action to take? What is patience? I like the definition of patience. I think it's from Hermosi, where it's figuring out what to do in the meantime. So all patience is about, patience is just about figuring out what to do in the meantime. So when I'm in a trade, I'm trying to be patient in a trade, what can I do instead? Like, can I do something else, or how can I figure out what else to do in the meantime? It's very easy for me to be patient, to eat my dinner. I love food, because I have all these things I want to do instead. So waiting for setups, setting alerts. How can I turn this outcome or this trait that I want? I want patience. How can I turn this into an action to take? So it might be setting alerts. It might be having clarity over, okay, when should I be impatient? Because in order to have the right trait, like patience, you need to be too impatient, and sometimes you need to be too patient. Like if you have too much patience, you will never take a trade. If you have too much impatience, you'll take too many trades. And so it's about bouncing in between these extremes and then finding the midpoint, the sweet spot. In order to master a trait, you need to master it. You need to understand the extremes and what's too much, what's too little, as well. And so define how many trades do I want to take per day? Am I comfortable with missing setups? What am I looking for? What do I do in the meantime? How can I set alerts to make it easier to be patient? All these sort of things. Make it actionable. And if you want to take good profitable trades, define what good means. Is it at a certain time, certain entry model, certain market condition, all these sort of things. So you actually need to do the work. You can't just blame it on discipline and psychology. But yeah, so that is good versus bad psychology. How most people you probably don't have a psychological problem. You need to have the system down pat first, so you can rely on that. Because a lot of stress and psychological issues in trading come from a lack of structure, a lack of systems. And if you just have a system that works and you can just follow it, it's like a clear step-by-step process, you'll fix 90% of your psychological problems. So hope you find this helpful, and I'll catch you in the next video. Okay, so now I'm going to actually talk about how to improve your psychology. A big mistake that I see a lot of traders make is that they don't actually know how to improve trading psychology, or they don't even have a accurate definition of what good versus bad psychology is, which we covered. So how do we, why do we know we should be doing things, but why don't we do it? And how do we improve that? Most people think it's about putting in more effort, willing yourself into that, using willpower, gritting your teeth, using that discipline. But that might lead to some short-term change, but it doesn't lead to long-lasting change, and it's not consistent over time. So we'll cover two main ways to fix this, and we'll break down as well. But all lasting change in life, not just trading, comes through awareness, understanding, and observation. So you can't not change something when you observe it, especially a behavior. For example, if you observe yourself right now, you are breathing. You weren't aware of that you were breathing, but now you're currently aware that you're breathing, and now you're probably manually breathing. kind of sucks. I'm sorry that you're now manually breathing, but you observing yourself breathing um, affected that behavior. Now that behavior has changed. And so in trading, we want to do these same things. We want to observe our behavior, look at is this a positive or negative behavior? And the more that we observe it, the more we can lead to lasting change and change it into a more positive behavior or break out of that cycle as well. And we covered like the way to improve your psychology isn't through watching more videos, reading more books. So many people have read Trading the Zone. I personally read Trading the Zone when I was trying to become a profitable trader. It didn't actually make me a better trader. Nothing changed. I didn't get better at the skill of good psychology because psychology is all about, it's like any other skill. You need to experience and have understanding. Information won't fix this. So we need to take action on this information to create that understanding as well when we're trying to improve our psychology. So the best way you can do that is, whenever you trade, is just to observe your own behavior. What am I thinking? What am I feeling? How am I reacting? And we'll break that down step by step in this video. So trading is a reflection of you, as we kind of talked about earlier on in the course content, is that, it has really nothing to do with trading. Like most people fail at trading, not because it's got anything to do with trading, but because they're simply human. And failure in most things that are difficult, like starting a business, having a healthy long-term relationship, or becoming a professional athlete where you're competing against others. In trading, you're competing against others. Most people fail because they're human, not because it has anything to do specifically with that endeavor. Because most people have a lot of personal problems. I have personal problems that show up in trading. So fear of risk, fear of failure, limiting beliefs, all these things show up in trading. And in order to actually improve our trading results, we first need to improve ourselves. If we want to master trading, we first have to master ourselves. And so your level of success in trading, relationships, life in general, will seldom ever exceed the level of your own personal development. So again, fixing our trading psychology issues just kind of stems to fixing our own personal psychological issues like our relationship with money, risk, uncertainty. And so becoming a good trader isn't really about analysis. It's about developing the skill to be able to go against your own human behavior and instincts. So to be human is to be a bad trader. And so we need to go against that, learn how to get comfortable with what we're fundamentally bad at, which is uncertainty and risk. And so fundamentally, getting good at trading is about getting good at what humans are fundamentally bad at. So yeah, that's sort of the baseline of it. So how do we actually fix our own personal problems to get good at trading or fix trading problems? So your personal reality is a reflection of your personality. So how you view the world, you get to kind of choose your reality by how you view the world, your sort of perception of certain events, so how you interpret events. For example, let's say you have sore legs from the gym, or walking. You can view that pain as either good or bad. One person can associate that pain with growth, like they're going to be getting stronger from the gym. Another person can associate that pain with, okay, why do I have to feel this pain? I went to the gym, I'm doing something right. And it can be either helpful or hurtful. And so personality is broken down first into that perception, how you perceive events or stimulus to be. And then you have emotion, so the emotional reaction to perceiving something to be good or bad. So how strong of an emotional reaction do you have to losing $100? Most people, 5 different people can perceive it in a different way. Someone who has a different relationship to money might view losing $100 as bad, but they won't tend to feel that much of an emotional response to another person who, they value their self-worth is directly tied to money or how much money they have. And so they might lose $100 and they might feel very painful and will negatively affect them. And then these two people might have a different emotional reaction. One person might overtrade or revenge trade if they lose that $100, or everyone reacts differently to certain emotions. And so yeah, your personality, yourself, the self who you are, can be broken down into how you perceive events, your emotional reaction to that perception, and then the behavioral reaction to that emotion. Because all motivation, every time you take an action, it is most likely in response to a thought or an emotion, pretty much all the time. And all motivation comes from pain and discomfort. All your motivation is from that. Whenever you eat food, you're motivated to eat food is because you're hungry. You're trying to avoid that pain. When you start fucking, it's because you're horny, and that's a bit uncomfortable being horny and not fucking. You need to release that tension. When you want to make money, it's because the pain of being poor is greater than the pain of working for that money. So why am I motivated to get a job? Because the pain of being broke is higher than the pain of going to a job and having to wake up early, get dressed and all that shit. And so all motivation is tied to pain and discomfort, and we'll talk about how we can modulate that and use it to point ourselves in the right direction to motivate the right behaviors. But fundamentally, if you want to change yourself, your behavior, you need to understand your perception, your emotion, and your behavior, and get awareness around that. How do I perceive losses versus wins? How do I perceive success in trading? And what are my emotional responses to these events? So do you perceive a loss as a loss means I suck, I'm a bad person, I'm not good enough? Or do you perceive a loss as this is just, trading is a game of probabilities and this is a part of the process? I can perceive a loss as a good thing. I used to perceive a loss as a bad thing. It hurt my ego. It meant I was wrong and I was, retarded. But now I perceive a loss as a good thing. This is an opportunity for me to learn and improve. But I still feel pain. I perceive it as a good thing, but I still feels a bit painful, uncomfortable. But instead, my behavioral reaction, which was okay, overtrade, revenge trade to get back out of that drawdown. Now I just journal it and learn review. So my perception around it has changed. It's a similar sort of emotion reaction, but my behavior has it's changed from reacting negatively to reacting positively. So in these 3 layers of your personality, there's 2 main ways that you can improve or influence your behavior for the better. The first way is to change or influence what you feel. So you can influence your perception to change the emotional reaction. So if I view something as good or bad, losses as good or bad, or it's not even me changing. Now I see losses as good. It might be that I see them as not as bad. So I used to view losses as I'm wrong, I'm not good enough, I'm not smart enough. Now I view losses as it kind of sucks, but it's an opportunity to learn and get better from. And that has affected, me changing that perception has affected the amount of pain or emotion that I feel from that event. And so, how do we change our perception and so we can change our emotion? This is directly tied to our expectations. So, your resilience is directly tied to your expectation. The lower your expectation, the higher your resilience, and the less you are affected by certain events. Because, for example, let's say you watch a movie, the Minecraft movie, for example. If you go into watching that with very low expectations, this looks kind of shit, trailer didn't look very good, I don't really care, I just want to go to the movies because it's enjoyable as a activity to do. So you have very low expectations, and it turns out to be an average movie that has exceeded your expectations, and so you end up feeling good about that. That was, okay, bit surprised, that was nice. But if you have really high expectations, like the fucking Minecraft movie is going to be the GOAT, it's going to be the best of all time. I've been waiting since I was a fucking 12-year-old kid to watch this, and you have extremely high expectations, and the movie's average. It's the same quality movie, but based off the expectations, you go away feeling a lot worse about that experience, and you probably feel some negative emotions from that. And so the event didn't change, your perception did based off your expectations. So in trading, the easiest way to decrease the amount of negative emotions that you feel is by lowering your expectations. And so how do we change our expectations? Yeah. We change those expectations by trying to, setting up a system viewing reality as it is. So in risk management, we talked about actually understanding the statistics, setting realistic expectations of, the losing streaks and drawdown periods, everything like that. So setting realistic expectations to actually doing the work, collecting data, journaling, reviewing, looking at the actual statistics behind it. But you can also set realistic expectations or lower expectations through doing the opposite of what you probably already do. You probably already positively visualize. So you think about, okay, if I pass this prop firm challenge, think about how much money I could make, or you're about to take a trade and you visualize how much money you could make from winning that trade, and you go into taking a trade with the expectation of winning that trade. Most people take a trade to try win, and they have the expectation that I'm taking this trade because I expect it to win, and that is the wrong thing to do. The only reason you should ever take a trade is because it meets your criteria. My goal in trading is never to take a winning trade. It's to make every single trade look the same. I'm not trying to be profitable in each trade I take. I'm just trying to be consistent and consistently take the trade I know over time is profitable and meets my edge. Is backed by data that I know works. And so I expect each trade to lose. So I go into each trade, okay, I kind of expect it to lose. It can lose, and that'd be right, and that'd be okay. And so I every single trade I take, before I take that trade, I visualize myself losing that trade in as much detail as possible. Like, would I be okay with this, risk if I lost, 5K on this trade? And then if I am, I'll take the trade. I expect it to lose. I lose 5K. Okay, kind of expected. If it, hits my take profit and I win, okay, nice surprise. And so I have a positive risk reward on my emotions. If it loses, it's okay. If it wins, even better. If I expected that trade to lose, I have a bit more of a negative risk reward. Like, if it wins, okay, it met my expectations. If it loses, oh my God, that's fucking bad. And I react negatively to that. So setting your expectations by expecting the trade to lose or visualizing the loss prior to that. Most people visualize the trade winning prior to taking the trade, and they wonder why the losses feel so bad. And so you just do the opposite of what you currently are doing, and you'll get better results with your perception and your emotions. Or expect to lose when you take a couple of trades in a prop firm challenge as well. So yeah, you can't control the win rate. If the next trade is going to be a winner, you can only control, if you're comfortable with losing. So you can change your perception, change your expectations to influence your emotions to not feel as negative of an emotion. So that's one way, is kind of in between. So changing your perception and your emotion. This is the one way to exert control over your behavior. The next way is about creating a gap between your emotions and your behavior. And so you can change how you react to what you feel, separating emotion from behavior. So it's a bit challenging to influence and change your behavior, your emotions all the time. You might still have emotions pop up, and so we can create a gap between our behavior and our emotion. That gap is kind of like your freedom and your control over yourself. And there are two ways you can react to these emotions, such as frustration, anger, sadness. There's two ways. You can either, option A, which is what most people do, they feel an emotion and then they try to reject or avoid that emotion. And you try to get rid of that feeling of pain. Like sitting in drawdown is comfortable, that is painful. And so you overtrade, you revenge trade, you increase risk to get out of that or avoid that pain as quickly as possible. And when that happens, you tend not to be trading the chart. You're not just trading your own emotion to get out of that, to avoid that emotion. Yeah. And so, avoiding, rejecting that emotion, trying to fight against it is all about effort. And when you try to control the mind with the mind, it doesn't really work. In all mental workings, effort defeats itself. And so if we act through understanding and awareness, okay, I'm feeling sadness or frustration. I took this loss. It feels painful. I'm feeling this pain. When you instead not try to avoid it and reject that emotion, which just makes the pain even worse. When you reject the emotion, it makes it even worse. You feel it even more strongly because you are rejecting a part of yourself. Do you like being rejected? If you try to, raise up a girl and she rejects you, does that feel good? No. And so when you're rejecting an emotion, you're rejecting a part of yourself, which just makes it even worse. When you do option B, which is accept and feel the emotion as fully as possible. I am feeling pain. This sucks. I'm not trying to avoid this. I'm just going to feel it. What does this pain actually feel like here? Emotions, we think of them as psychological, but they are actually physical. Emotions are physical sensations. And so bringing your perception into the body and trying to feel where that pain is. If it's anger, it might be in the head somewhere. You might feel hot-headed. If it's fearful, you fear being in drawdown. You might feel, your heart rate increasing, a tightness of the chest, your breathing getting shallower, such as anxiety of being in drawdown. If you just focus on those sensations of those emotions, you be present with that, you just feel it fully, you just sit with it, you actually start to realize, okay, this isn't unbearable. This isn't that bad. This sensation of pain doesn't actually feel that bad. When you just accept it for what it is, it'll actually start to dissipate. Because, when you feel accepted by someone else, that feels good. When you feel rejected by someone else, that feels bad. So don't reject yourself, accept yourself. And that's how we actually can react positively to our emotions, to negative emotions as well. And the thing is, emotions only last 90 seconds. The reason they last longer is because you try to distract and avoid those emotions. In the moment, emotions might feel like they'll last forever, but they are lying to you. Don't trust your brain; it lies to you. This is why, like, when I feel when I feel strong emotions, I just try to set a timer for 90 seconds and just feel those emotions fully. You don't have to last forever. You just have to last 90 seconds. And I know most of you, can probably only last 90 seconds. But yeah, I don't know what I'm talking about. But yeah, you just have to last those 90 seconds and feel those emotions fully, and they'll dissipate over time. If you've ever done meditation, you kind of know, you've experienced what I've talked about as well. But yeah, the core principle is what you avoid controls you, what you resist persists. And so in trading, avoiding loss just creates more losses, and accepting loss, feeling the pain of that loss, actually creates more consistency in your behavior as well. And yeah, all emotions are just physical sensations. If you just sit with those physical sensations and look at them for what they are, you actually realize they're not that bad. And all the negative stuff comes from associating yourself with those emotions and telling yourself a story, identifying with all these things and saying, I'm worthless, I'm not good enough. And if you just, take it to the present, you just feel it for what it is, you realize it's not that bad. As well. And you might currently be feeling some emotions. So you can do a body scan as well. Like, what are you currently feeling? Do you feel like a tightness in the chest? Can you feel your hand, your hand making contact with the air and focusing on that sensation? Because you are kind of what you focus on. You get to control that. And so a lot of getting good at reacting to your emotions is all about getting good at controlling your attention and your focus, and making sure you're focusing on the present moment and not future or past events. And so those are kind of the two ways to change: through changing what you feel, through changing your perception, your expectations, through visualization, and your thinking, or changing how you react to what you feel through separating emotions from behavior, acting through acceptance, not avoidance. And so if you want to actually do this, fucking practice it. It's a skill in itself. You won't immediately do it and then it'll fix all your problems. You need to practice it consistently, like the gym for your brain. And so yeah. Okay, so in trading, emotions are neither good or bad, they just are. Most people think emotions are bad. If I could just be a robot, I'd be profitable. But that's not how it works, because your intuition is an emotion. Your intuition is what makes you profitable as a manual trader, as someone that needs discretion. Adapting to conditions, you need that intuition. Gut is refined taste that makes you profitable. And so that, your emotion is the reason for you being profitable. And it's also the reason for you being unprofitable, because you can't stick to what you should be doing. So we don't eliminate emotions. We don't try to avoid emotions, control them, which is what most people try to do. And that's why they fail. We use them instead of being used by them. So the problem is not emotion, it's how we are interpreting that emotion or using it. So your body is always giving you feedback: fear, anxiety, greed, anger. These emotions are like biomarket feedback. It's another source of information. So when you're trading, you're not just trading patterns in the market, you're trading patterns in your own behavior. How you react to the market, there's also patterns in that, where you might react negatively to trends or positively to ranges or vice versa. And so understanding how you react to different stimulus and emotions that arise when you either take a loss or take a win, and recognizing those patterns, so you can step outside of that. You have that awareness, so you can change, break that cycle. Recognizing that after 2 losses, you feel intense emotional, intense pain, or a want to get out of that, and so you're more likely to take even more losses. So setting up a system to limit yourself after a couple of losses each day, trading that own pattern in your own behavior will make you more profitable over time. And so your job is to get good or improve your relationship with your emotions, not trying to control them, but working with them, not against them, aligning yourself with your emotions. And there's two main ways you can get better at your relationship with your emotions, because how do we use emotions if they can be both good and bad? So you can take a trade and might go into your favor, it might go into profit, and you can close a winning trade but early out of fear. And that can be a good decision, a good psychological decision, if that fear is based in reality. So if you view the markets and you see it's starting to shift against you, volume starts to decrease, and you have a gut intuitive feeling of fear that, okay, this can reverse and start to take me out. You can close that trade early for a win, a small win, and that can be a good decision. That's you reacting to the markets, how they show, like the information they're showing you. That fear is actual intuition, and that can be a good decision. But if you close that winning trade early out of fear of it turning into a loss, so it's purely based off the outcome. You're focused on the outcome, and I just don't want to lose. I don't want to give that back the money that I've made. And it's not actually based in any reality. It's not based in reaction to market structure shifting against you or volume decreasing. If that emotion is based off the outcome, that is a negative decision to be made. And so we can look at and ask ourselves, okay, why am I feeling this emotion? Am I feeling fear based off the outcome or potential outcomes? Or am I feeling fear based off reality, based off what I'm seeing? So trading what I see, not what I think, or what I tell myself about the past or the future. So all decisions made in the present moment, made of present moment information, tend to be good decisions. All decisions made based off the past or the future tend to be worse decisions. And so a lot of trading is all about mindfulness and focusing on the present moment and understanding your own thoughts and emotions and being able to step away from them, not identifying with emotions or thoughts, and just look at them as information sources, as sensations or stimulus to make better decisions. It's just you have more information to work with as well. And so those are two ways you can improve your reactions to your emotions. Is it a process-based emotion or an outcome-based emotion? And always ask yourself, why am I feeling this emotion? Because you will feel emotions for a reason. You won't just randomly feel emotions. And they're helpful. It might, like, if you feel fear, immense fear prior to taking a trade, that is an opportunity. Like, if I feel immense fear, why? Why am I feeling this immense fear? Is it because I'm over risking? Could be because of that. Is it because I actually don't know my entry model that well and I need to work on that? Or is it for this other reason here? Because, there's always going to be a reason for that. Being able to dig into why that is will allow you to improve. That's an opportunity to improve. Every emotional issue I have is an opportunity or something that maybe, I need to dig deeper down into as well. And so you can't control what you feel. You can influence it through this expectations, perceptions, but you can only really control your reaction to stimulus and these emotions. And emotions are just information. If you react unconsciously to them, they will control you. You'll be like an animal. But if you step back, have awareness around them, think of them as just another source of information, you can use them to be better as well. It's like in June, the Gong Jabbar, where he puts his hand in the box and has the needle held to his neck. And that's to prove, can he control his behavior in reaction to pain and emotions? As anyone who can't control the reaction to pain, like an animal stuck in a bear trap, will gnaw off their own leg to get out. That is separating animalistic behavior through in comparison to human behavior, where you can have control over your pain, your emotions, and your reactions to that. That's a bit of a tangent, but I digress. So that's emotions. Kind of leads us into pain. So in trading and in life, we like to think that we will be able to avoid pain, but unfortunately, life is pain. Life is suffering. And the quicker we get good at that, we realize that, we understand it, and we don't try to avoid pain. We try to change our relationship to that pain. That's when we start to get success. And this is probably why, most people fail, not just in trading, but in other things in life, is that the most important things tend to be the most painful things to do. The success you want in your life and in trading is on the other side of the work that you are avoiding. And you tend to avoid it because it's painful and important. It means a lot. So good trading, good trade management, good psychological management is all about good pain management. You can't avoid pain, but you do get to choose it. I can either choose the pain of going to the gym or the pain of being a chud and overweight or, not aesthetic, and getting fucking frame mogged and, I don't know, frame mogged. Yeah. So you get to choose either the pain of regret as well or the pain of patience. And how you use pain as well, instead of being used by it, is important, as again, all motivation comes from discomfort and pain. And so having negative goals tends to be better than having positive goals. Like instead of, I want to be rich, maybe have a goal that I don't want to be broke. That can be helpful. So a lot of motivation, like, you can modulate your own motivation by putting pain behind you and pointing yourself in the right direction as well. And you get to choose how you associate with that pain. You can look at that pain as the pain of growth, or the pain of failure and shame. I guess, for example, let's say you have sore legs from, you have sore legs one day, and, there's two different ways we can look at that pain. Let's say the day prior, you have sore legs. It was because you lifted up a car and saved a child that was stuck under the car that was on fire and was about to explode. And the next day, you feel pain from having to squat up that fucking car. You locked the fuck in inhuman strength. And so you kind of maybe torn some muscles. It feels a bit painful. But the next day, like, that pain will feel good. You'll feel proud of that pain. You saved someone's life, and that pain is a badge of that. And it feels good. You associate that pain with a good thing. But, what about instead that pain was from rubbing a person, and you rubbed a person and you fucking kicked them, and then you have to run away from the police, really fast, and you kind of have that pain, muscle pain in the muscles from all that running away from police after committing a bad act. And that pain might be associated with a bad thing. You might feel some shame around that as well. And so you can have the same pain in your legs, but you can associate both good or bad based off what the story you tell about that pain. So you get to choose how you associate it. You can look at the pain of a loss as, this is the pain of growth, of learning. Every loss I take is an opportunity to learn and improve. It's another data point in my journal, in my system, and that is painful, but it's pushing me closer to my goals, and I can feel good about it. And so you are fully in control of that and your perception. And most traders aren't really bad at trading. They're bad at managing their pain and their relationship to pain as well. Trading's kind of like similar to League of Legends. You just need to not tilt, and then you'll start to climb. But yeah, so this is kind of goes into a book called The Dopamine Nation, and so finding balance between pleasure and pain. If you pursue more pain in your own personal life, you will get better at handling more pain. You'll build up a tolerance to pain. And the opposite. So if you're constantly chasing pleasure, you're constantly chasing comfort and avoiding pain in your own life, gym or relationships, putting yourself out there in work, you'll be worse as a trader. You'll build up a tolerance to pleasure, and you'll need more pleasure to feel pleasure. It's kind of like a drug. The more you indulge in pleasure, the more heavier stimulus you need. It's like when you take a drug for the first time, you have such a big reaction to it. But as you continue taking that same dosage, you need higher and higher dosages to get the same reaction, or the same feeling from that for that drug. With pain and pleasure, it's the same thing. So in order to if I have a certain dosage of pain in trading, if I keep on losing $100 again and again and again, I have that same dosage. I get used to that. I build up a tolerance to that pain, and so that can be actually a positive thing. I can build up a tolerance to pain, and so I need higher and higher dosages to feel the same amount of pain. And that's how we actually get better at handling bigger risks and bigger pains through taking smaller pains and progressively overloading, like we talked about in risk management as well. Or you can use other sort of pain sources in your life to get better at. But the thing is, the more you push down on pleasure, the more pain you feel. So the more I try to avoid things, avoid pain, and distract myself with pleasure through TikTok, gooning, or watching YouTube, and having that pleasure, that stimulus, that dopamine flood my system, the more I start to feel existential pain after that. So when you um, you know goon for fucking the first 8 hours of the day, later after that, you're probably going to feel pain, such as maybe a bit of shame or anxiety, or you have a bad attention, or if you take a bunch of drugs, you have a lot of pleasure, but then that pushes down that pleasure, which pushes up that pain on the other side of this balancing scale. The more pleasure you have, the more it'll push up the pain. Taking all these drugs here, and so you start to feel craving. You'll feel bigger cravings in relation to the amount of drugs that you take, and that craving is uncomfortable and is painful. And then the vice versa. The more you kind of push down on the pain side, you build up a tolerance to pain, and so things feel less painful. But that also pushes up pleasure, and so it feels more pleasurable to do the hard things. And that's how you can have like a self-fulfilling cycle of getting better at handling pain and actually feeling more pleasure from those hard, painful things that you're doing, like the gym. Where the gym in the beginning feels like shit, but if you go for 3-6 months, you get used to that pain and it actually feels more pleasurable and enjoyable. This is why it's so hard to start. But once you get the ball rolling, it's a lot easier. And so, the biggest mistake in trading is, good psychology isn't about not feeling emotions, it's about how you react to these emotions and how you react to that pain. And so pain management is the real skill in trading and in life. Everything you want is kind of on the other side of a lot of pain. So gym, putting yourself out there, social pain of putting yourself out there for relationships and dates and stuff, even business as well. There's a lot of pain. And so not trying to avoid that pain, looking at it not as like an obstacle, but as the path. It's the price to pay to get what you want as well. So, fear of missing out, pain, regret, feeling behind, overtrading, impatience as a pain, all these things, all motivation is just pain-based. And being aware of that, not trying to avoid pain, but actually seeking it out to challenge yourself. You are like a sword. If you want a sick-ass katana, what do? You fucking stick it in fire, you put it in fire, and then you smack it a lot with a hammer. Does that sound very enjoyable? Does a katana like that? I don't know, but probably not. Would you like being put in a fire and then smacked with a hammer? No. But in order to have strength, you need to go through painful situations and temper yourself. You need to temper your own psychology. And so the only way to get better at your psychology, at good psychology, is to experience pain, experience loss, failure, and have understanding of it's actually not that bad. And associate growth with that pain. That is the only way to improve your psychology, is through experience and understanding, not through fucking reading books. And so, suffering in trading isn't anything wrong with that. It's just a part of the journey. And trading is really, really fucking painful. It's suffering. I've suffered for fucking the first 2.5 years. It was probably one of the worst periods of my life. Completely ruined my life, but then it completely saved my life because I stuck with it. I learned to associate that pain with growth, and I needed that understanding. Not every lesson can be taught, but every lesson can be learned. Sometimes you need to make the mistakes yourself to feel that pain, that emotion, to change. And so, coming back to this, a lot of improvement in trading comes from improving yourself and the skills over your emotions, controlling your impulses, or having awareness and understanding about why you do what you do. And so the self, or you as a person, can kind of be broken down into this nice little pyramid. Most people focus on here, the unprofitable trader tends to focus on the outcome. So trying to win a trade, learning to trade, trying to focus on making money trading. You start to get a bit more profitable when you focus on your execution, technical skill, trading systems, all that type of stuff. You start to get even more profitable when you focus on your own actions and your behavior that lead to those positive outcomes. You get even more profitable when you focus on your thoughts and emotions that lead into your actions and your behavior. Or every time you take an action or behavior, it's always a reaction to a thought or an emotion that precedes that. And so being able to control your behavior is all about being able to control how you react to those thoughts and emotions. Because you can either unconsciously react to them or consciously be aware of them and accept those emotions instead of trying to avoid those emotions. So learning how to learn, learning how to improve, learning how to control your own behavior, learning how to put in the fucking work will lead to a lot of those good things as well. And so the profitable focus is on improving yourself first and mastering the self so you can then master trading. And yeah, all your thoughts and all your thoughts, your emotions are kind of reactions again to your beliefs, expectations, attitudes, your own identity. So identity-based change is quite important. And this is kind of all goes back down into your own personal experience. So you view reality through the lens of your own personal experiences. And everyone has different personal experiences, so everyone views reality differently. So understanding your own experience, what are my own beliefs? Do I believe making money is a good or bad thing, makes me a better or worse person, or does it have nothing to do with it? Do I attach money to my own self-worth? Do I view losses as a bad thing? This is why doctors tend to be the worst traders, because being a doctor is all about being right. If you're wrong, someone dies. In trading, being right or wrong doesn't really matter. It's all about having probabilities in your favor. And so having that belief that I need to be right and applying it to trading, they tend to have the worst outcomes. They tend to lose the most amount of money. And so they have these negative beliefs that lead to negative thoughts and emotions that lead to negative actions and behavior, which just fucks everything up. So your outcomes in trading go all the way back down into your expectations, your beliefs, and then your past experiences that build those beliefs. If you want to change beliefs, you need to have new experience and update those beliefs as well. So yeah, hopefully that gives you a bit more awareness and understanding about yourself, why you make certain decisions, how can we change. Think about what you can actually take action on. So the next day I trade, how can I be more aware of my feelings and the sensations in my body, what I'm feeling, why am I feeling these emotions, and yeah, so that's sort of the breakdown of how to improve through awareness and understanding. There's also the Bulletproof Psychology Handbook that goes through a bit more protocols such as meditation, journaling, cognitive reframing as well. If you want to have that handbook, that's in the WAP, I think under this video. Maybe at the end of this module, which you can cover and review as well. That can actually, these are actions you can take to actually improve your psychology. But most of your psychological issues will be covered by your system and your journaling process, which we'll cover in the next video. About how do we avoid mistakes. Okay, so now we're going to cover mistakes and how to avoid them. So, as we covered, psychology is all about, closing the gap between knowing and doing. A mistake can be like, you should be doing something, but you don't do it. That is a mistake. So how do we avoid mistakes? So mistakes can kind of be broken down into two main reasons, like why are you making these mistakes, or two types of mistakes. First is a system error, where you don't clearly know exactly what to do. So going back to this chart, so if you don't clearly have like a system, you don't clearly know what you should be doing, that is why you'll make an error. So most people struggle with trade management. They close their trades too early, simply because they don't know when they should actually close their trades. And so when you don't know, what exactly you should be doing, you will take the path of least resistance, which will be closing it early, because it's more uncomfortable to hold a winning trade than it is to close it and have that instant gratification. And so most people have a system that is not clear enough, so they don't actually fucking know what they should be doing in every single step of the trading process. Or B, the system is too complicated and it's too hard to consistently execute. For example, if my goal is to be healthy and I keep on making the mistake of not eating the right foods every single day, probably most of the time it's probably because you haven't defined what the right foods are. You just have this goal of, I want to be healthy, I want to eat healthier. But if you don't clearly define what that means, if you don't define the outcome you want into an action to take, you will not take the right action. You will take the path of least resistance. And so you need to define how do I get better at taking good trades, and how do I avoid taking bad trades? The only way to do that is to fucking define what good means and what bad means. But you haven't done that. You don't have the data to back up what good means and what bad means. You don't know the variables. You haven't done the work So you deserve to have bad psychology. You deserve to continue making system errors because you don't have a system. And so, like, most people judge the quality of a decision based off the outcome. So if I close this winning trade early and it reverses, and that was a good decision. If I close this winning trade early and it keeps on going, that was a bad decision. But you need to, validate the quality of a decision based off the process, doing it consistently. The biggest mistake people make is that they want to have the cake and eat it too. They want the biggest win rate, but they also want the biggest risk reward. And so they're constantly stuck between these two things. And it just leads to, stress and suffering and pain for no reason. So you're not trying to be the most perfect trader. You're just trying to be consistent. And so having a consistent system that is clear and that you can stick to will fix a lot of your psychological issues. Because if you don't know, again, what the fuck you're supposed to be doing here, how are you supposed to do it? So you hesitate because you don't know clearly enough what is the right entry model or when you should be entering consistently. This is, most psychological issues is an issue with clarity. You don't have enough clarity over what actually works because you haven't done the work, you haven't collected the data. So if you can't, define actually what leads to a A+ setup and break it down, you don't deserve to feel confident because you haven't done the work. Okay, going back to that was a bit harsh, but B, the system is too complicated. If you have 10 different steps over fucking 5 different time frames on 3 different pairs that you're looking at, you're going to overload yourself with all this information. And when you're overwhelmed, when you're overloaded, you again take the path of least resistance. You just do whatever's easiest, or you'll shut down, you'll hesitate, and you have analysis paralysis. So make it simple, easy to execute, and that'll make it consistent. So again, make it definable, make it clear, make it simple, make it easy. If you have too much information, if you have 10 different things that you need to be doing at the same time, there's 10 points of failure. If there's only 4 things that you're doing at the same time, there's only 4 points of failure. It's a lot easier to do that. It's a lot easier to eat the same things at the same time every single day than making this massive big meals that are very extravagant and have 10 different steps to make them and are really complicated. You won't consistently do that. It will require too much willpower and discipline over time. And you are not perfect. I'm not perfect. You want to create a system and a plan that you can execute on your worst day. Plan for the lower self, not the higher self. And so system issues are the first thing. We kind of talked about this in actually creating your trading system. If you have this down pat, if you generate your trades, collect data, give a trading plan, you shouldn't have these issues in your psychology. Okay, the second type of mistake is a focus-based mistake. This is when you focus on the outcome and not the process. You make a decision to try to force an outcome and you don't really care about the process. So like I'm trying to win a trade. And so I just want to make sure I win this trade. So I'll remove my stop loss. That is a outcome-based decision. You can't consistently make money without, risk management. You'll just eventually lose everything. And so every time you focus on the outcome, you were once giving 100% of your brain power to the process. Now maybe that's split in half or that's a bit less. You're going to be acting a bit more retarded because you don't have that brain power. And so all attention and focus that goes to the outcome is making you more retarded. And you don't want to be doing that, obviously, because trading's already a little bit difficult. And so that's just making it even more difficult as well, because you can't control the outcome. You can only control the process and your decisions and the actions that you take. And so you are, what you focus on. If you focus on improving, getting better, learning over time, you'll get the outcome that you want. When you're trying to, do a good swing in golf, if you're focused on the hole, onto the green, if you've got your eyes on the green, you're probably not going to hit the ball very well. If you focus on the process, if you've got your eyes on the ball, you're probably going to hit the ball a lot better. So you go to where you focus on as well. So focus controls the actions you make. It's kind of like, when you go trade on a demo account, it feels really easy because you have nothing to focus on but the process. The money isn't fucking real. It doesn't exist. So it's very easy to trade. As soon as there starts to be attachment to the outcome, as soon as there's money on the line, that's when trading feels a lot harder because you were once working with 100% of your brain power, focus on the process, doing all that analysis. Now half of that is to making sure you're winning, making sure you win that trade. And so all focus on that outcome is wasted focus. You're halving the amount of brain power. You're doubling the difficulty of trading by splitting your brain power between the process and the outcome. as well. And so how do we get better at our focus? Again, this kind of goes back to expectations. So if I expect to lose, if I'm not trying to win, if my focus is on taking a good trade, or taking a good loss, it's a lot easier to just take a good trade. So like I'm not trying to make money anymore. So be mindful of your thoughts, because they will, you'll react to those thoughts, or those thoughts will lead to emotions, and those emotions will lead to your actions and your behavior. And so always be mindful of whatever you're thinking, especially when you're trying to trade a prop firm. Like, you might be 1% away from passing a prop firm challenge. And you might think about how much, money you'll be able to make once you pass that, all those payouts and all the good things you'll be able to buy. And you'll create that fantasy in your head that you'll attach to. And the more you think about that, the worse it gets. And the more you'll try to force a winning trade. And this is why a lot of people, blow accounts when they first get funded. There's a massive drop off between getting a payout and getting funded, even though, it's not that much harder, because they start to focus on the positive, focus on the outcome. And so negative visualization, again, focusing on doing everything you can possibly do right and still losing, and being okay with that, being okay with the worst case scenario, and setting that expectation, and just focusing on what you can control will alleviate this as well. So you're doing the opposite of what you normally do, focusing on the good things, positive visualization. You're actually doing the opposite. You're negatively visualizing and being okay with that. Because true resilience, true strength in trading, isn't about, avoiding the worst thing happening. It's about being okay with the worst thing happening. That is like true strength. And so, the only way to do that is to practice, visualize it. Your mind can't tell the difference between what is imagined and what is real. You might, visualize or think back to an argument that you have with someone, and you might feel that same anger and frustration, because your body can't tell the difference. And so if you want to practice getting better at your emotional response to events like losses, start to visualize losses and you start to feel the same sort of emotions, and just practice being okay and sitting with those emotions. And so, negative visualization is a big help. And so, those are two sort of things. You are what you focus on. Again, if you're trying to hit a fucking bullseye to win a gold medal, you're more likely going to hit the bullseye if you're focusing on the bullseye, so you can win the gold medal, and not focusing on the gold medal. If that makes sense. So keep your eyes on the fucking ball. Protect your focus. Your control over yourself is directly related to your control over your own attention. The most important resource you have is not time, it's not money, it's your attention. Because your intention affects how you spend your time, which affects how you spend your money as well. And it's easier to focus on one thing than it is 10 things. So make your fucking strategy and your system simple, that you're only focusing on one thing. Your focus like a beam of light. You don't want to disperse your focus. You want to focus in, pinpoint it on one thing. Again, energy going in one direction, it'll push you further than putting it in 10 different directions. So do less and you will get more out of it. So again, all mistakes come from either a system issue, you don't know clearly enough what you're supposed to be doing, or you don't know why you should be doing it. Most traders don't follow their rules because they don't have a fucking good enough reason to follow their rules. And they don't have a good enough reason to follow their rules because they don't collect data. They don't actually know why. And so how can we make the bad things as obvious as possible just to avoid them? And then, being able to control your focus is your control over your own life. So what can help you improve your attention control or your focus? Reading can help. Meditation is the act of controlling your attention and not trying to be distracted by thoughts that pop up. And so these are things that can help. But all mistakes come from these two issues. If you make a consistent mistake in trading, think about why am I making this mistake? Do I clearly not know what I should be doing? Or am I just focusing on the outcome too much? Do I need to decrease the risk? So focus less on the outcome, or anything like that. So a big way to improve not attaching yourself to the outcome is to diversify your own mental capital. If trading is the sole thing that you attach your own personal well-being to, your self-worth to trading, you're going to fucking suffer and you're probably not going to be profitable. The more you need trading to succeed, the more you need to make money from trading, the less likely you are to succeed and make money. Because you'll focus on the outcome. You need it to succeed, so you'll focus. The best way to fix this is to diversify your own mental capital. So becoming a good trader is about having a good life, have good relationships, Have other hobbies outside of trading that you want to do instead of trading. Most overtrading and issues come from boredom because they have nothing else that they would rather be doing. They're kind of addicted to trading. I first became profitable after blowing through 6 prop firm accounts. I used to cry after I blew prop firm accounts, like, because it was $100 for like a 10K, but I didn't have much money. I was broke in university. And so like every time like I blew it, it'd feel extremely painful. I did not have much money at all. So I was really attached to the outcome. The first time I passed a prop firm challenge wasn't because I used a different strategy. It was simply because I was addicted to League of Legends. It's as simple as that. There was something that I wanted to do more than trading. I wanted to climb League of Legends. I wanted to get to Diamond. And so there was more focus on League than there was trading. And so I was just focusing on the process. I was just trying to take my trade, be done for the day, so I could then go play League of Legends. I wasn't necessarily the happiest at that time, but I wasn't overly obsessed with the outcome of trading. I didn't directly tie myself into trading. And that's when I actually passed that prop firm. I got consistent payouts. And that was the first time I was consistently profitable for 3 months. And then I blew that account and I had to restart again. But yeah, that was a good learning around not attaching yourself to trading. You need to have a good diversified life where your self-worth is not just tied to trading, but other things, other people. It shouldn't just be the one thing. It's like a relationship. If all of your self-worth and your happiness comes from one person, one relationship, it's not going to be a healthy relationship. So you need to have a healthy relationship with trading. It can't just be your sole one way out. That is very unhealthy, and you just make it harder than it needs to be. And so, bit of a tangent, but hopefully this is helpful. And those are the 2 types of mistakes. Really think about, when I'm making a mistake in trading, why am I making this mistake? How can I fix that as well? So I'll catch you guys in the next video. Okay, so now we're going to break down discipline versus decision making. So discipline in trading is a trap. Discipline is innately short-term minded, short-sighted. A lot of people think, yeah, got to use discipline over motivation. Motivation is short-term. Just put in more effort, use more discipline. But also that is also short-term. The best way is to set up systems to support you and set up an environment that supports positive behavior. The best way to win a game is to cheat. Set up the game so you win. Don't play the hard game, which is what, if you do discipline, play the hard game, you just make it harder than it needs to be. So when most people try to be disciplined, they focus on putting in more effort, more willpower to do the right things. Instead, the person who succeeds makes doing the right things so easy and so obvious that it actually requires less effort, less willpower to do. And so how can I make the default thing that I do the positive thing, the right thing to do? So for example, let's get this up here. We want to optimize for easy decision making. So discipline is about making the right decisions, or making decisions that stick to the process and not care about emotions or short-term things. You focus on the long-term process, and discipline uses willpower to do that. But we want to make the right decision making as easy and obvious as possible. And so the best way to do that again is to remove options. Most people have issues in their psychology simply because they're trying to do too many different things, using too many different strategies, too complicated, overly complex. Trading is very similar to League of Legends. If you want to succeed in trading, if you want to climb the League of Legends ladder, you need to one trick. I one trick to champion. I one trick to roll. In sport, I one tricked as a back rower, number 8 in rugby. Everyone who succeeds in something specifies. And so you need to specify your trading. I only trade one pair at one time using one strategy. I only trade reversals in ranges on gold in Asia session, sometimes London, but mainly in Asia session. And so removing as many options as possible, because it's easier to pick between 2 things than to pick between 100. If you've ever gone to a restaurant and saw a massive fucking list of all the different foods, it's overwhelming. You can't really choose. This is because there's something called the paradox of choice, another good book. And this is why more is actually less. So when you see a massive fucking menu, you think of this as a good thing. You think of more options as a good thing. And it raises your expectations, which is what we don't want to do. And in order to choose one option, there's now a bigger opportunity cost. If you choose between 2 things, there's only like one other thing that you don't choose. So there's less of opportunity cost. And if you choose the wrong thing, there can be a bigger regret because you have higher expectations and that bigger opportunity cost, which can lead to self-blame and just negative emotions. And so more choices are actually negative. Want to remove as many choices as possible because that makes decisions a lot easier and a lot less stressful. So you don't want setups all the time. You don't want too many times to trade or too many markets, too many maybe trades. If you find that like there's also always going to be a setup, there's always a move that you can take. There's a system, like there's an issue there. Like most of the time, I have no fucking idea what's going on in the markets. Maybe 2% of the time I know what's going on, and that's when I trade. I don't try to take good trades. I don't look for reasons to trade. I do the opposite. I look for reasons to not trade. I remove all the bad options, all the bad trades, and I just focus on what is left. And so fewer choices equals easier decisions as well. And so you don't want to be flexible. You don't want to trade everything. And it's okay to miss opportunities as well. So yeah, make it as easy as possible to just do the right things. So remove options. I only take reversals and ranges, one type of trade. All my trades look the same. Like my goal in trading is not to take a good trade. It's not even to take a profitable trade. It's to make every trade look the same. And so obviously I need to remove options to do that, to make it look similar. So one session, one strategy, one asset, reversals and ranges at the same time every single day. I'm just not trying to be the best trader. I'm trying to make trading as easy as possible. I'm trying to be the most consistent trader, which is what we kind of talked about is important in the risk management section. And so once we've removed options, to make decision making even easier, to reduce decision making fatigue and overwhelm, we want to make decisions that remove future decisions. If I can make a decision once and that removes the decision from the next day and the day after that and the day after that, that is a positive thing, because every time you make a decision, that leads to decision fatigue. The more decisions you make, the quality starts to decrease. And so we want to just decide once, not all day long. So if you're constantly making decisions, that is very draining. This is why CEOs or Steve Jobs wear the same thing at the same time. He wore the same things every single day, like the jeans and the shirt, the same things to remove that decision fatigue. And so just don't keep on deciding over and over again. It's very draining, and fatigue makes cowards of us all. So the more tired you are, the more likely you are to make a bad decision. And so that's why I just stick to one thing and I just do it every single day. It's a lot easier to eat the same thing at the same time and be healthy with that than to constantly having to decide what to eat, for breakfast, lunch, and dinner. That's very draining, and you're more likely to deviate from your plan if you're constantly deciding. And decisions in trading are emotional decisions. And so you should only really be focusing on 1 or 2 trades per day. So make less decisions. In order to optimize for easy decision making, we want to make the least amount of decisions possible, because every decision we make is an opportunity to fuck up and make the wrong decision. So we want to set systems and remove decision making as much as possible. Again, thirdly, we want to kill all ambiguity, make it as clear and as easy as possible to make the right decision. How do we do that? We need to know why we're making a certain decision through having data, collecting data that, trading reversals at the halfway point of the hour is better than trading reversals at the first 10 minutes. If I have data that backs up that is true, I'm more likely to follow that because I know why. And we want to make trading very clear. If I get this up here, if I can find it, hold up. So we want to make trading so fucking clear that taking a bad trade is as obvious as putting our hand on a hot stove. And the reason, it's not as obvious is because, trading is a game of probabilities, and there's a bit of a disconnect between you taking the trade and it resulting in pain. And so that can be, a bit less clear, but we want to make it as clear as possible. So, how to define what a hot stove looks like when we're taking a trade. Make it as obvious to do that, because, it's not that hard. It doesn't take that much discipline to not fucking burn your hand on a hot stove, because it's very obvious. And again, it's similar to, the game of picking the M&Ms. And we just want to make, that obvious. Like, what is the difference between green? How do you define green versus red trades as well? So, kill all ambiguity here. And so defining the outcome you want into an action to take consistently. If I want to be healthy, maybe, defining, eating the same things at the same times, every single day, making that decision once, removing options. So for breakfast, I might, I can have oats and protein powder and some, fruit. That's one option. And then the other option is I can have eggs and toast and a kiwi. And that's so like two options for breakfast. Maybe I have two options for lunch and vice versa for dinner. And so making it, removing all options, complexity, making the same decision that removes future decisions and make it, clear and easy, makes it so much easier. And so most people's rules in their trading plan are too vague. Like, I want to trade with the trend. Okay. How do you define a trend? Is it a lower time frame, middle time frame, higher time frame trend? Where do you want to enter with that trend? When do you want to enter? You need to be more defined and be more clear on what things fucking mean. So being patient, what does being patient mean? What are you waiting for? And what is being impatient? So most people, haven't clearly defined it. Like, if I tell you to be patient, like, what action is there to take from that? There's some action you can actually take. Be patient. Being patient means waiting for something, waiting for the right thing. Okay, what are you waiting for? And again, managing trades better. Most people have issues with managing their trades because they have like, when they make a mistake, they say, okay, I closed too early. And they just keep on saying, okay, I closed too early. Okay, that's fucking very vague. When was the right time to close? How could you have known prior to closing that you were closing too early? Like, how can you be more clear on exactly when you should be closing a trade and be consistent about it instead of just having vague shit, which is a big mistake that people make as well. So most people, struggle. Their lack of discipline is actually a lack of clarity. They don't clearly know what they should be doing. They think they need more discipline, but they just haven't decided what they're actually supposed to be fucking doing. So if you don't know when I'm supposed to close the trade, how am I supposed to close it at the right time? So yeah, defining, healthy eating, covered that, and then having, specific standard operating procedures, knowing very clearly what you're fucking looking for. So I've already broke that down for me, and my CBR model. And yeah, we've already covered that here as well. So those are the three main ways that we can make decision making easier, make it easier to make the right decisions. And again, we kind of covered this: why you self-sabotage, why don't you do this, to either avoid pain. Covered this, trade-off choosing your pain. Every issue, every strategy you use, every trading system you use, will have pain, will have a problem. Like, if you have a high win rate, low risk reward system, you'll be having to experience the pain of watching a winning trade go on you after you close, like, very often. If you have a low win rate, high risk reward system, you'll have to experience the pain of more losses and the pain of watching a trade go in your favor and then taking you out after it was in profit. And so, you can't gain something without first giving something in return. To obtain something of equal value must be lost. There will always be pain with whatever choice you make. There is no perfect decision. There are only trade-offs. If you accept those trade-offs, that is the right decision. If you don't accept those trade-offs, it's just going to lead to more suffering. And so accept the cost of whatever decision you make. Trading isn't perfect. It's not the most amazing sort of endeavor. There's lots of pain that comes with it. So do you accept that pain, or are you trying to avoid it? Most people try to get what they want without paying the cost. I want to have a six-pack. I want to be, I want to lose weight without the pain of hunger. And so let me just take Ozempic. I just inject that shit or snort that. And then them trying to avoid that, there'll be another cost. There'll be there's still going to be a cost. There can be health issues that arise from taking Ozempic. There could be other, losing, a lot of people lose muscle mass when they take Ozempic. There can be other costs that you might not have, thought about. There is always something to be given to get whatever you want to obtain. And so just make sure you do things where you're willing to pay the price. Do you actually want to be a profitable trader, or do you just like the idea of it? You're not actually willing to pay the price. If you're not willing to journal your trades and accept that pain, you shouldn't be trading. You should be doing something else, because there's a lot of easier ways to make money. Trading is pretty difficult. And so if you're not willing to pay the price, you're wasting your time. So yeah, that's just the truth. It might be a bit harsh, but a lot of people don't make clear decisions Because what if I'm wrong? What if I choose a system, I choose a strategy, I do everything right, and I still lose? I stick to this and I still don't make money, and I fail. Great, amazing. You figured out what doesn't work, so you can not do that in the future and do something else. I could only become a profitable trader taking 30-minute reversals if I failed taking continuations at 30 minutes. So I could do the opposite. So I tried to take continuations around the halfway point of the hour. I fucking completely failed. That allowed me to learn from that, do the opposite. Now I take reversals around 30 minutes and I'm profitable. You need to fail in order to succeed. You need to learn what doesn't work in order to learn what does work. You will make the wrong decision. That is fucking guaranteed. You will fail. You will make mistakes. That's a good thing. It gives you data to learn from and avoid doing it in the future or do the opposite of it. Because setting up a system, like this is a system again, going back to what we previously covered here, if you skipped over this and you're watching this video, didn't watch the system, like please go back and watch it. But every system here has a set of rules, a plan to follow, and it has a feedback loop, the journal that you're collecting data on. And so your decision, the decision that you make, the choices that you make will evolve over time. Like your plan, your process will change over time in reaction to that feedback loop. You collecting data. Nothing is set in stone. Things are always constantly changing. And so what you do now won't be what you do in a year. It'll evolve over time. That is what it means to be a trader, is to adapt to the markets and change over time, to keep on getting better and learning more from the data that you collect. And you just keep on getting better and better and better. And so again, if you want to, get better results, follow your process better, you need to more clearly define the process, make the right decisions easier to make instead of trying to rely on more willpower to just force yourself to do the right things. And your lack of discipline is actually a lack of clarity. You don't clearly know what you should be doing, so you don't do it, or you don't know why you should be doing it because you haven't collected the data, so you also don't do it. Make the consequences more real. The reason, like smoking was such a big thing back in the day, where it's not as much of a thing nowadays, is because the consequences weren't as well known. Everyone used to vape, in the beginning, because the consequences weren't as well known. If you can make the consequences of the wrong decisions, bigger, if you can make it as obvious as putting your hand on a hot stove, you will not do that behavior. You just don't clearly know what the wrong decision is. You don't have enough data. Why it's wrong. And again, another sort of thing is that there's something called second order consequences. So if I remove my stop loss and that leads to me winning a trade here, that is the first consequence. So I removed my stop loss, it won me a trade, and I got positively reinforced for a bad behavior. And so the next time I'm likely to lose, I remove my stop loss again to avoid that. And so the consequence, the first consequence of me removing my stop loss is that I won. The consequence of me winning when I had a wrong behavior is that it reinforces that behavior. And so I'm more likely to remove my stop loss in the future. This is why a lot of people struggle with bad behaviors, is because they were previously reinforced positively on those bad behaviors. Most of the people that have gambling issues, in the beginning of their gambling careers, they won a lot of money. And so they got positive reinforcement for that negative behavior, which then led them to keep on gambling. Mr. Beast, like most people quit YouTube in the beginning because they get all this negative reinforcement. They try to create YouTube videos, most likely they fail because they suck at it. But Mr. Beast, one of his first YouTube videos popped off, got a lot of views, and that had that positive reinforcement in the beginning. So he kept on making YouTube videos, even though he sucked after that for years. And then eventually, he kept on doing that because of that second order consequence. And so being really mindful of the behaviors you make, the consequences of those behaviors, and then the consequences of those consequences as well, to not positively reinforce negative behaviors. So that's something also to be mindful of as well. But that's sort of discipline versus decision making. If you just do that, everything just kind of goes back into having a clear system, having very clearly what works, doing the work, putting in the work, and you'll fix most of your psychological issues by doing that.
Holy shit, you've actually made it to the end of the course. That's better than probably 95% of people. They dropped off halfway through or just too much for them. So good job. I'll give you a clap there. And so now it's your turn to actually execute on the information I provided. Nothing changes if nothing changes. If you don't act on this information, nothing's going to change in your life. And this is all the information I ever could have wanted when I first got into trading. Would have saved me so much time and effort. But some of you might be thinking, holy shit, Tom, this is a lot of information. I'm overwhelmed thinking about all the work I need to do. It's just too much. And that's where my mentorship is here to help. We provide direction, guidance along the way to becoming a profitable trader, passing prop firm challenges, getting payouts, and scaling up your trading. If you want hands-on help, one-on-one access to me and my coaches, to get access to my personal playbook, systems, my journal, my data, that saves you years of having to collect all that data yourself. Or if you want feedback on actually trying to execute the strategy, where you can get me or one of my coaches to personally review your trades and give you feedback on actually what to do next and how to improve every single week, well then just click the link in the description below to apply to work one-on-one with me. And if we don't work together, that's fine. I got so much value out of creating this course. I learned so much. Literally, the best way to learn is to teach. And so share this course with anyone that is stuck. Try to teach them the things that you've learned in this course. That is one of the best ways to learn because again, it's free. So send it to any of your trading buddies or post it in a Discord if you found it helpful so you can help someone else out. And so thank you again for watching this whole thing. That alone puts you in the top 1% of people. So just please make sure to do the boring work. It's tedious, but that's how you actually get results and outperform 99% of traders. And if you get good results, you pass your first prop firm, you get your first payouts, let me know. Join the Discord or DM me on Instagram because I love seeing you guys get success from what I teach. But that's it. I hope you've enjoyed. If you like this video, like, subscribe, and I'll catch you later.